Good morning, ladies and gentlemen, and thank you for joining day two of the Fundrock Global Investment Conference. On screen now is the agenda for the day. We have another lineup of some of the top global fund managers to share their views on double fixed income and double multi-asset funds. We will also be joined by several of the top hedge fund managers in SA and some dialing in from abroad as well, to unpack their strategies in discovering how it can add value to investors and their portfolios. They will also be joined by some of the DFMs in SA to moderate this as a session, similar format to what we had yesterday. And by now, as the audience should know how it works, the Q&A bubble there for you to participate. We'll try to address as many of those questions that comes in from the audience as possible. Today's session will be very fast-paced, but we will have time for questions by the moderators as well. And like we normally do, these sessions are being recorded, and we will be sharing the recordings with you afterwards as well. But before we get going, I want to invite Dan from Excel Academy with another free gift from our audience. I think a lot of you know Dan by now. For those of you who don't, they do a lot of wonderful things on training sessions on Excel, hence the name Excel Academy, but they also do a lot of training on AI, and they also run the mechanics of our session on the back in Zoom. They are true experts on that, among other things. Good morning, Dan. How are you?
Excellent. Thank you, UT, and great to be here. Thanks for the opportunity to jump online now. As we often do, we're offering a free gift as a thank you, and you can see here from the conference room to your workflow, because what we've seen over yesterday and today is there's a lot of talk about AI in your portfolios, and we specialize in helping people to start adopting and embracing AI as an actual partner in a safe and responsible way in their day-to-day workflows. So next Thursday, the 11th of June, is a big day for two reasons. Firstly, we've got our session, 10 o'clock till 11 o'clock in the morning, as a curtain raiser for Bafana against Mexico, which is at 9 p.m., the opening game. So big day. Make sure to scan the QR code. My partner, Abby, will pop the link to register into the Zoom chat, and you can share that with your colleagues and friends. There it is. And it's going to be fun and practical, focusing on the mindset shifts, the behaviors and habits, and the real practicalities, getting really practical, rolling up our sleeves, and looking at how AI can enhance the way that you work on a day-to-day basis. So looking forward to seeing you then. Thanks, Eugene.
Dan, thank you so much. And Dan's also joined by his colleague at the back, Avi. We never see Avi, but he is there. And Avi, thank you from our side for making everything runs so smooth. Right, let's get proceedings underway. It is my pleasure to welcome our moderator for the first session this morning on global fixed income, Jessica Fannin from Amity Investment Solutions. Good morning, Jessica. Thank you for joining us this morning.
Morning, thank you.
Jessica will be joined by Anthea Gardner from Cartesian Capital and Bruce Thistlewhite from Oak Haven Capital. Jessica, I will hand over to you to introduce the topic of your panel, and then we're off. Thank you.
Great. Fantastic. Yeah, just to illustrate the importance of fixed income and understanding the asset class at the moment, if one looks at the ASISA category statistics to the 31st of March, which were just recently published, what you'll notice is that the multi-asset income category, which is largely used as a diversified fixed income bucket for clients to enhance on cash and, give you some level of duration. When you consider that category, it's currently the second largest in the country. And it shows how important different fixed income skill sets are because of how they are used in client portfolios. It's also one of the ASISA categories where manager selection is absolutely critical, because there really are no passive options, and that's not typically common. This panel seeks to unpack fixed income in terms of the views and opportunities, and fund managers in this category work incredibly hard to smooth the return profile experienced by clients. by selecting a wide range of different fixed income sub-asset classes. From a macro perspective, we have the benefit of the South African Reserve Bank being incredibly disciplined in terms of how they target inflation. And that credible monetary policy, as tough as it is for us as consumers, it does give us the benefit that actually we can access real yields on behalf of investors with a fairly stable currency. And to traverse all of this and more, we have two outstanding voices today. So if I can introduce them both. Both speakers have experience managing hedge funds and as well as long-only mandates, which makes them incredibly well qualified to understand both the ups and downs in this asset category. Anthea Gardner, she will be our first speaker this morning. She's the founder and portfolio manager at Cartesian Capital, which was founded in 2014, and brings a rigorous data-driven perspective to global and local fixed income. She manages fixed income hedge funds, balanced portfolios, corporate cash solutions, and more. And following her will be Bruce Thistlewhite as managing partner from Oakhaven Capital, with a very strong track record in South African fixed income. Oakhaven's BCI Core Income Fund, which some of you might be familiar with, has delivered first quartile performance across a number of trailing periods. And Bruce is deeply practical in his insights to bond supply and demand dynamics and how that relates to return outcomes for clients. So it should make for interesting conversation. Following the presentations, I'll be fielding some questions to the panelists, so please send in your questions as the presenters share their slides and move through their content. So Anthea, over to you.
Good morning, everybody. Thank you very much, Jessica. So my job today is really to give insight or background into the fixed income, the global fixed income market, and also to give you an update. And of course, I can't help myself, so I'm also going to tell you where my team and I think there are opportunities for generating returns, whether they're yield or capital in nature. And what we've noticed in the past year or so, I'd say, is that fixed income has evolved from really a defensive anchor to a source of primary real returns in because of this higher yield environment. We've seen yields blow out when the US-Iran war broke out. And because of this, capital deployment, and I think you mentioned it, Jessica, has to be intentional, valuation driven, based on macroeconomic fundamentals in order to reach or even to beat your benchmarks. And so for this, really, we need an emphasis on real yields, credit spreads, curve shape, and policy credibility, which I will show you South Africa really is doing its best. And this needs to be like over the narrative. I think the fixed income market in South Africa earlier this year was driven by both fundamentals and narrative, but a lot of narrative and sentiment. So in other words, what I'm saying is that where we are now, we have to get back to data-driven fundamentals. That's the only way forward for us. So bond yields have risen to pre-crisis levels, making income really the main driver of total returns instead of capital gains, which we saw earlier this year. And as money managers, we need to think about diversification across geographies, sectors, and issuers. I mean, this is where active management really flourishes because we reduce risk through our diversification strategies. And then, of course, central banks globally are currently following very different policies and rate trajectories. And obviously, due to this inflationary and fiscal pressures, and of course, not forgetting the geopolitical uncertainty, which comes up in every conversation. And I guess you would have already identified this when speaking to your managers. This leads to higher risk premia that your active manager really can take advantage of. So just to make a point, undoubtedly by now, you've realized that I'm using mountain ranges as my analogy for the fixed income market, and I'll be using climbing those mountain peaks as the investment environment. Just to explain a bit what I'm thinking what my thoughts are, what I thought was a good analogy. The base camp is your cash safety, but even that, it does tend to be a risk, right? We think money market, no risk. But actually, I mean, just to use my analogy, Everest Base Camp is over 5,000 meters high. Johannesburg is 2,000 meters above sea level. And if there are any runners amongst you, you'll know how thin the air is up in Johannesburg. But so from a global perspective, cash acts as really this safe, in inverted commas, base camp, offering accessibility, but really limited returns due to the low real yields. Let me clarify, because in some markets, like South Africa, I'm delighted to say, you can actually get real yield in money market instruments because inflation is well in check at the moment. So our BCI money market fund is returning over 7%. And when you think that inflation's 4%, giving you a real yield of 3%, that really is actually a great safe haven base camp. Then the short dated bonds, high quality, and it has to be high quality credit, represent the foothills. So still just at the bottom of the mountain with improved income and controlled risk. But note how that word risk is suddenly creeping into my lexicon. Then the ridges and the higher peaks are longer duration bonds with obviously fairly impressive yields, but that comes with high volatility and fairly acute policy sensitivity. There we go. And just to touch on developed markets before I get to South Africa, the yield curves have really re-steepened, for want of a better word. I mean, so it offers attractive income opportunities, but we're looking towards generally restrictive monetary policies. So I'm sure some of you will remember the inverted yield curve, which had everyone worried about recession. So that seems to have reversed. I'm not sure that the recessionary risk or the pricing of recessionary risk has reduced that much. And because of the US-Iran war, everybody's trying to figure out, where to from here, what longer term, medium or longer term, I should say, impact this war is going to have on our fixed income market, our economies in general. So volatility remains high. And a buy and hold strategy is good because upfront, generally, I should say good, because upfront what the yield or what yield you're going to get. But a buy and hold strategy is going to be nerve-wracking. As the mark-to-markets move, there's no doubt this will impact your daily fund valuations. So for anybody who needs a monthly income drawdown, this is not the best strategy. But it requires, I should say, strategic timing, curve positioning, really the best strategy for bond investments at the moment. Okay, am I making sure I'm on the right slide? In the credit space, let's talk about developed markets first. So in the credit space, we're seeing really tight credit spreads. In other words, investment grade and high yield spreads remain quite low. And this just speaks to high investor demand. But the problem is it comes with limited risk buffers. So you want kind of the investment grade high yield, but you also want some sort of stability. And although default rates are low at the moment, I think rising refinancing costs and leverage metrics will significantly increase financial vulnerability for issues, which really points to the fact that when you're buying credit, you just want to you want to analyze those cash flows very carefully and make sure that you're kind of with a high quality issuer. So just again, I feel like I'm repeating myself a bit, but we need to emphasize selectivity and quality and to identify where risk compensation is genuine, where I can get that nice yield, but not with having to take too much risk. And of course, my favorite subject, let's get to the emerging markets, where the picture is quite different, by the way, globally. So as you can see from the graph, emerging markets offer positive real yields, and more than positive, much better real yields than the developed markets at the moment. So in my opinion, if we can maintain our credible monetary policies, investors can expect attractive returns with less volatility and risk. Global investors, I think, will continue allocating to emerging markets with stable currencies and structural reforms, or more importantly, not just good reform policies, but actually the ability to implement those reforms or structural reforms. And of course, I mean, I don't want to look back, but South Africa does have an implementation problem. Let's not be silly about it, not too naive about it, I should say. But like just by eyeballing the graph, you can see that emerging markets and South Africa particularly is well placed to receive global investor allocations just because of the real yield differentiation between us and the developed markets. Still on South Africa, and when I talk about real yields, I'm just giving you an example here. The nominal yield on the 10-year bond, government bond, is about 8.5%. And if you think that inflation target of 3%, South Africa offers some of the highest real yields globally, making it a very attractive investment opportunity. And this is kind of tongue-in-cheek, but I don't agree that the Reserve Bank should have increased rates last week. Kind of tongue-in-cheek, but actually it's not. And actually, I thought the rate hike last week was a bit unnecessary. Look, I understand that the Reserve Bank, or what the Reserve Bank were doing, was offering this kind of giving this market a sense of inflation targeting credibility and saying to the world, we're very serious about this 3% inflation target, right? And that should give global investors a level of comfort that we can maintain this real yield that I keep going on and on about. So hopefully we'll get some international flows from that. And then just to add to my positivity, because it's all positive today, we've got a positively sloping yield curve. So decent yielding, long-dated bonds offering carry and good roll-down benefits for investors. The curve shape really reflects inflation expectations, which are in my opinion, within target band. And no, actually not even my opinion, it's a fact. The inflation is within the target band, and expectations, I believe, are still going to be within the inflation band. And then not only is the yield curve, which you're looking at now, showing that, but it's also showing that long-term fiscal risk pricing. So pretty good, I mean, I just keep saying this, good investment opportunities across the curve in South Africa. Oops, I think I might have jumped ahead there. Or backwards, wrong way. There we go. Sorry about that. So, look, I believe fixed income strategies should prioritize consistent income over opportunistic duration bets. Global investors should emphasize quality, liquidity, selective decisions to capture market dispersions, and so when we're looking at this, we're doing an overview of the global fixed income market. And the question has to be, what could possibly go wrong? I think the credit market in South Africa, let's talk about South Africa for a second, it does remain vulnerable despite this current high demand. And as always, the case in South Africa, local fiscal and currency risks are always on the table. We just don't seem to have the fiscal discipline, although we're in a really good position at the moment. Historically, we haven't had the good fiscal discipline and reform execution. And quite frankly, I have to admit that I'm really nervous about the local elections in November, because it doesn't change the overall political environment, but what it will be is a really good indicator of where politics is going and what will happen in national elections. And to be honest, it's kind of not where I'd like to see it going. In fact, yesterday I was speaking to a political analyst, and he was saying that he doesn't think the GNU will survive to February 28. he doesn't think that the next president will come from Ramaphosa's faction. So where does that leave us? And in his opinion, and maybe he just said it for shock value, I'm not sure, but he seems to think that Paul and Fikile will make a deal. One of them will be president, one of them will be deputy, you decide which one. And then those two will coalesce with the MK and the EFF. Now, when he said that yesterday, the entire room bristled, right? I'm not sure I agree with him, but the reality is that it is an option, and the market just, I don't believe the market will like that very much. So how do we navigate this market? There's a couple of things. We have to be income focused. As I said, you've got real good yields coming through. Your global investment priorities have to stay in place. Of course, South African government bonds, I don't for a minute think we're going to default anytime soon, so we're pretty safe there. And we just need to stay disciplined and market focused. So I'm not saying this because we manage the Cartesian BCI money market and interest plus funds. But if I was a financial planner, I would definitely be looking at these funds for low risk, low real yield investments for my clients. So the money market fund is on a 7.3 approximately yield, and the interest plus fund is on the 8.2%. So these are funds that sit in your base camp and offer real good real yields. So thank you everyone for listening. I hope you have some questions, but for now, I'm going to hand over to Bruce from Oakhaven.
Perfect. Thanks very much. So as was referred to by Jessica, I think it's important to understand sort of where to invest in and what to invest in. So within South Africa, obviously there's the money markets, there's short-term investments, variable term, and then there's the multi-asset strat. So I think the important thing to notice here is, as was pointed out, the multi-asset income fund is very big. It's almost at 500 billion. What you are allowed to hold in that is up to 25% property and 10% equity. So what you will notice here, when you look at your short terms and your variable term, what you're going to see is that their dispersion is actually quite tight. And the main reason being that their dispersion is quite tight is when you look at short term, generally what people are buying is they're buying 5-year paper that's linked to JIBAR or to Zionia nowadays. And what that does is it gives you quite a stable income. And when you're looking at variable term, what people are doing is they're always benchmarking themselves to the Allby ultimately. And so that also gives you quite a tight return. And as Jessica pointed out, when you look at the multi-asset, you've actually got to be a lot more specific and do a deeper dive into your managers to see what is the investment strategies and where are they going to be investing in your money, because ultimately they could be investing up to 35% of your funds into equities. Now, if you look at it, you'll see the mean for your short term was 7.9 and your mean for variable term was 11.3. So basically what that means is to get a multi-asset income down at 8.7, it's about 3/4 of it is income and 1/4 of it is bonds. And if you did that and you amalgamated that, that's more or less what you're going to get from a multi-asset. Obviously, that's now excluding the fact that maybe there's a property allocation or there's maybe an equity allocation. Just to highlight there that we've got two funds at the moment. We've got an core income fund, which has been in the first quartile since existence, and we've got a BCI Oakhaven bond fund, which has been in the first quartile for this last year and in the top third for the 3 to 5 years before that. So how does a bond fund actually derive 25%? And I think it's very important to understand the mechanics of how a bond fund can do 25%, because not a lot of people, and this is what it did last year, sorry. So when you look at the Allby basically 6.5 years, that's its duration. And what people don't understand about duration is actually a leverage play. So because it's 6.5 years, what that means is for every 1% that the Allby moves, what's going to actually happen is that your fund is going to produce 6.5%, because that's how the duration impacts the leverage that you're running. So last year, what happened was the bond market went from 12% down to 10%. So call it on average, you accrued 11%. and then it rallied by 200 basis points. And that 200 basis points is 2 times 6.5, which is 13. So 13% plus 11% gives you your 24%. And that's how bond markets can derive 24%. Now, we don't think it's over yet. We actually think we're actually quite positive. We're on the same bandwagon as Anthea. We still like South Africa, and you're going to see that we've got quite a good few things that we like about South Africa. Now, at the risk of going back to economics 101 for you, demand and supply. So in South Africa, we've got a really interesting scenario where the supply, specifically the nominal supply, is actually reducing quite rapidly. So what you will know is in 2013, the way the government funds itself is it does an auction every week, and the players in the market go and bid for those bonds. So in 2013, there were about 2.35 billion bonds up for auction. At the height of COVID, there was 6.6 billion, because obviously what happened was the government needed a lot of funding to fund all of the programs that had implemented. What we're now down at is we're now down at 2.5 billion. So we almost, the government's issuing the same amount of nominal debt as it was 13 years ago. So the supply is really drying up. Not only is the supply drying up from a nominal perspective, but they've got a new line called floating rate notes, which they never used to issue, and they're issuing floating rate notes, which means that they've opened this whole pool of income funds into government bonds, whereas previously they couldn't really access government bonds because of the duration play and because of the risk associated with it. So when you look at it, the other thing that they can also do is treasury bills. So if you look at the amount of treasury bills that they're issuing, you can see that they can issue up to 15%. At the moment, they only issue 10% of their debt in treasury bills, and they're very much issuing the front end of the curve at the moment as well. So this, again, what comes down to the fact that the nominal bond issuance is drying up. And a very simple calculation tells me that over 48 weeks of auctions, and they're issuing 2.5 billion at an auction, that's 122 billion. Then what they do is they'll give you a non-compete, and what that means is you can pick up bonds at a non-competitive price 2 days later, which is normally a take-up of about 40%, and they're issuing them at about a discount of 5%. So ultimately, what it actually means is that they are issuing 163 billion of nominal bonds a year. But the coupons, just the coupons on the outstanding debt that they currently have, is 295 billion. So what that means is, if I'm a bond fund, if you look at the income funds and you look at the multi-asset funds and you look at the bond funds and you say, well, these guys are already issuing, they're already in that pool. Now, they can't even make that pool bigger because there's not enough issuance in that pool. So there's 132 billion of under supply into the market. So that's on the supply side of things. On the demand side of things, if we look at foreigners are the biggest yo-yo in our demand factor. Historically, we always look specifically on nominals, not on like inflation linkers as well. Most of the numbers that get reported include inflation linkers. But on nominals, historically, they own more than 50%. At the moment, they own around about 30%. And I think the big thing to bear in mind here was the market dislocation that we did have during COVID, which tied into us getting kicked out of the World Government Bond Index, which was exactly March 2020. So there was a lot of exaggerated moves that took place over that point in time. So that's on the demand side of things. We can see foreigners coming back into South Africa. As we've said, National Treasury are now issuing floating rate notes. I think they can almost issue more than what they are issuing at the moment. There's a lot of demand out there for them. As I mentioned, the coupons is from a demand perspective, there's 132 billion too much money for the amount of bonds actually being issued. There was a good graph by Anthea there about the inversion in the bond curve, which actually comes back down to the fact that people are looking for duration. So, we've got all our pension funds and our life insurance, and everybody are looking for funds. So they're buying a lot of duration in the back end. That's why our yield curve is inverted in the back. Now, one of the things people will tell you is, look, we've got a fiscal problem coming up in 30, 31, 32. There's a massive redemption profile coming through. But at the moment, South Africa is funding itself pretty easily. We're doing 70 billion versus 70 billion of switches every year, quite easily. We're going to be able to start switching the 30s and the 31s within a year or two anyway. And generally speaking, in South Africa, we're quite comfortable to pick up a maturity profile of about 60 billion on any bond that comes through. So just why are we so positive? Well, I think fiscally, you can see that we've at long last we've peaked out. Next budget is going to be a much lower budget. Our debt to GDP is going to be lower. This is the first time in 13 years that this has happened. And what you can see, that commodities terms of trade coincides with our credit ratings. And our credit ratings, at the end of the day, are now starting to show up. We're starting to get S&P and Moody's have got us on a positive outlook. Finch, we're just waiting for Finch to maybe give us a positive outlook. So from that perspective, we think we're in a really good scenario from a terms of trade perspective. And I'm going to mention oil once, and you can see here that our commodity terms of trade was really high, and oil actually brought it back down a little bit lower. So even with oil being as high as it is, South Africa's commodity terms of trade is really, really good. And then Operation Blue Lela, at the moment, you can see that we're actually starting to get quite a bit of traction in what they are putting through. So for once, the good is all South Africa related, which is a very good thing. I do agree that South Africa's municipality accounts are maybe in a bad scenario, bad status. We do have the election coming up. There are a couple of credit funds gated in the US. And locally, South Africa is going to get a 5% handle on CPI, which in the near term is not going to be great, but this is a supply-driven impact, not a demand-driven impact. And actually, for once, all the ugly actually relates to developed markets and to the fact that their debt to GDP is so high and they got no political tolerance. One of the things that we do look at from a macro perspective is the Fed. We think that Walsh, at the end of the day, we know that he wants a smaller balance sheet. So we do think that he's going to reduce his balance sheet size going forward, which is quantitative tightening. So off the back of that, we think that maybe rates don't go up as high. And then lastly, just to look at why do we like back-end bonds? Well, if you look at it, your monetary policy has very little impact on your back-end bonds. It's mainly decided by your debt burden and your debt and what's taking place on your fiscal side of things. This over here is our bonds versus our swaps. And if you look at this point in time, when we were issuing a lot of debt, it was costing South Africa almost 250 basis points more than the swap curve to issue money. That's come all the way down to 50 basis points. And that's because of the lack of supply into the market. Obviously, we've got to take heed of the fact. That all developed markets are at the top end of their curves. And if you look here, you can see that's because the real rates are negative. As Anthea pointed out, in South Africa, we've got a really good positive real rates, which is a really good buffer for us going forward. So if you look at South Africa and you look at Hungary and you look at Chile, you can see that we are down on the bottom left side of the curve. And we anticipate that we will actually still strengthen off the back of that. So we're quite bullish on that. And that's just our fund return. Just to note there that our fund has returned 9.23%, which versus the multi-asset at a mean of 8.7 is actually better than the multi-asset return in that category.
Fantastic. We've got a few minutes to ask you both some questions, and some very interesting views were shared today. So Anthea, just starting off with you. You expressed your view that actually you don't agree that the SARB should have hiked rates, but we know that they tend to be cautious and front-run inflation. What do you think we can expect in terms of rate hikes later this year? And maybe if you can sort of expand, what do you think the market has priced in terms of those rate hike expectations locally?
So I'm not sure that thanks, Jessica, that the SARB is a front runner. You know, they're always referring to data-driven decisions. So they want to see data going in. So I was rather surprised this time for them to be saying that they're acting ahead of the curve. The problem we have is that the inflation increase or the inflation shock is exogenous, right? It's driven by outside factors. So interest rates are like they're a blunt tool. You cannot use interest rates to change the inflation trajectory when the reason for it is coming from outside. And the problem not the problem, actually the in this case, benefit we're seeing is that there's already been demand destruction, and that should temper inflation. So I heard Bruce mention that he's expecting a 5 handle on inflation. We're not expecting a 5 handle. We think that once this war comes to an end, and it has to come to an end, Trump's ego cannot handle this anymore. He has to end this war. And the minute he does that, you'll see oil come off dramatically. And then the demand destruction will keep inflation in check, and we'll be fine again. That's where we're going with this. We thought only one rate hike in July, but then they hiked in May. So now we're kind of like, what are they doing and why are they doing it? It was unnecessary. That interest rate hike really was unnecessary because inflation should come down again. But this war really has gone on for a bit longer. The market is pricing in three rate hikes. The FRA curve, the forward rate agreement curve, was pricing in 3 interest rate hikes. And I know, look, Jessica, I know that it's not the SARB's mandate to manage GDP growth, but they cannot deny the fact that we're so close to a stagnationary environment that if GDP, we're such high employment, and if GDP comes off any further and inflation spikes, then stagflationary is what we'll have. And that's a very difficult environment to manage yourself out of. So I would like to think that they won't hike again this year anyway.
Yeah, great. Bruce, on to you. A question for you. In your presentation, you sort of highlighted the bond supply that has dropped, and obviously the fact that demand is actually rising for these bonds. And it's highlighted as quite a structural thing to our local fixed income market. Do we have that right, or is it more cyclical? So, I mean, obviously, as Anthea sort of stated, you know, our economic growth is under severe pressure at the moment. But there is a case that actually, as an emerging markets, and as, you know, our terms of trade continue to sort of trend in that upward trajectory, and we have some sort of tailwinds from the demand for our resources, that we might see an improvement in economic growth. Would that then push the government to start actually to issue, you know, more bonds in an effort to fund some of their spend in terms of infrastructure and that type of thing? Can you sort of comment on how structural versus cyclical this is and what might change it?
Yeah, so Jessica, I think at the moment our GDP is actually understated in South Africa. So when you talk about debt to GDPs at 76 or 75% or whatever, I think they're understating our GDP. I think that the economy, the sort of informal economy is not being measured correctly. And I think that there's a lot that's coming through in that. You can see now on the latest, the first month of the fiscus has just taken place. Their revenues are ahead of where they thought they would be. So fundamentally, I think we're back in a 2006, 2007 scenario where we're paying down debt. And I think the important thing to understand is when you get a credit review, the creditors look at two things. They want to know, do you have the ability to repay down your debt? And do you have the fortitude to repay it? We've always had the ability to repay our debt. And only now do we have the fortitude to repay it. At long last, we said we've issued enough debt. We're actually now going to sort of reduce how much we're spending.
No, great. And that I think is fairly positive. You know, it's fantastic to hear the backdrop being fairly positive for the asset class widely. I'm going to ask one more question. I am aware that we are now entering someone else's time allocation. Anthea, just for you, you talked about, the base camps, the foothills, the ridges, and the peaks, and you're actually fairly positive right up, to the peaks, those longer duration bonds. Structurally, how actively do you move between those sub asset classes, and how, or do you stick quite closely to strategic allocations across your range of funds? Just maybe give us that.
So, Jessica, we're very mandate driven and it depends on the fund. So in the money market fund, by regulation, we are restricted to no more than 13-month maturities. And so obviously we play in that very short dated space. In the unconstrained bond fund that we have, we play across the curve. And obviously we compare the risk and the return across the curve and decide where we want to be. Admittedly, recently, because real yields are so good and because we don't need the extra longer dated to take on the longer dated bond risk, we have been shorter duration. And in the belly, I should say. It's so short and belly.
Okay, fantastic. Thank you so much both for sort of sharing the inner workings of your portfolios and your thoughts on fixed income. Thank you to Eugene for the opportunity. Just to hand back to you. Appreciate your time.
Jessica, thank you for making for a very interesting conversation. And Anthea and Bruce, thank you for joining our call this morning. We really appreciate your time. And Bruce, thank you for pushing through. I could see you struggling there at a moment, but we're really grateful. Thank you so much. Right, we're moving on to our next session on global multi-asset funds. Always a fun part of a discussion where everything tends to come together. And joining us now is JD Hayward from Flagship Asset Management, Fanel Tigere from Balondolozi Investment Services, and Paul Fischer from New Road Capital. And here to moderate the session is Yunel Mattia from Cogence. Yunel, you made it in the nick of time. I know you're still traveling this morning. Well done. I'm not sure where you are at the moment. I suspect at the airport still.
At the beer company at the airport. That's the most quiet spot.
Well, good spot for so early in the morning. But yeah, thank you so much for making it in time. We're really grateful. Thank you so much.
Thank you, Eugene, and thank you to all my panelists joining me. And I think just setting the scene of what we've seen this year, it's actually been a year of two halves. We've seen pre-war and we've seen post-war. And I think this panel is always one of the most interesting panels to be part of because there's a wide spread of asset classes that you can use. And it's always fascinating to see how different people actually use this to add value. So a lot of volatility that we've seen in the market. There's been ups and downs. I think one of the most important things that was shown again is with the dip in March is the importance of staying invested through this uncertainty. And I think the most important also is there's a lot of uncertainty in the market, but with uncertainty and volatility, there's lots of opportunities. So looking forward to hear how all of you are positioned to go through this turbulent times and also what the outlook is going forward. So JD, I'm going to hand over to you and then Fanel, you can follow, followed by Paul, and then we'll open for some questions at the end.
All right, good morning, everyone. Thank you very much, Nal. My name is JD. I'm the co-manager of Flagship's Global Strategies, along with my colleague, Phil Short. Just a brief introduction. We are a Cape Town-based boutique. We've been around for 25 years. We are 100% owner-managed, and we offer three distinct global products, a pure equity fund, a worldwide flexible fund, and a fund of funds. Right, let's get into it. On the screen, we've got the blended forward PE ratio of the MSCI ACWI over the last 15 years. The dotted line would be the median, and the solid lines are one standard deviation above and below the average. Now, what this chart shows us is that ACWI, on a blended forward PE of roughly 18 times, is currently at a 15% premium versus its median. So slightly expensive, but nothing ridiculous. And I'd like to start with this slide just as a reminder of where valuations stand. And although this is not cheap, on this metric, it doesn't look extreme. Several other metrics that you might look at, price to sales, the CAPE ratio, Buffett indicator, etc., look much more extreme. Right. So if we look at the PEG ratio, however, so price to earnings to growth, we see that the current PEG ratio at around 1.4 is right in line with its own medium. So slightly expensive on one measure, not so much on the other. And what does that tell us about growth? So let's take a look. It tells us this, that earnings growth has been tremendously strong. We're looking from 23 to 24 to 25 at 10% and 12% growth, year-over-year growth, respectively. And then expectations of about 14% and 13.5% for the next 2 years. So despite markets being, by some measures, relatively expensive, we see that given continued earnings growth, those valuations have held up. And in fact, in some cases, they've actually come down. Now, the takeaway here, and you just mentioned this, is that sitting on the sidelines for too long or with an equity weighting that is too low can be a very dangerous game to play. This does, of course, assume that EPS growth remains resilient. What could potentially derail this party, though? What factors could derail this? And the one that we're keeping an eye on is decreasing liquidity. So this relationship right here. Inflationary pressures putting upward pressure on borrowing rates, which then decreases liquidity available in the market. Now, until now, markets have been buoyed by, as we mentioned before, strong realized and expected future earnings growth, but also by abundant global liquidity. So the question is, how much longer can this party go on? On this chart, we've got global liquidity in the red. And as you can see, over the last 15 years, since the GFC, basically, there's been a very steady increase. Now, global liquidity here is measured as the M2 money supply of the 13 largest central banks around the world. So basically all cash and cash-like instruments in circulation. In this chart now, we've got the same global liquidity, but we've got the S&P 500 on the right-hand side in gray. So basically lowering interest rates and printing money increases global liquidity, and that will drive equity markets higher, or else being equal. You can see there's a pretty meaningful relationship. Now, it's not perfect, but I certainly wouldn't ignore it. And given this fairly tight relationship, let's look at what can derail this. Controls money supply. What's their current stance? And the main driver of global liquidity is central banks via interest rates, QE and QT. So let's take a look at that. Here we've got the net proportion of global central banks whose last rate move was a cut. So anywhere the red line is above the zero line, it was a cut, and where the red line is below the zero, it was a hike. As you can see, currently sitting at a spot in the cycle where 86% of central banks' last move was a rate cut. And it's also quite clear to see that this moves in cycles, and we appear to be fairly close to the top of another. We've in fact already had hikes or futures pricing in hikes in the US, Brazil, the entire EU, Australia, Japan, South Africa. And there's some cuts still on the cards in China and Mexico, but they really are in the minority. But why is this the case? What's driving this? And we believe one of the main factors is commodity-driven cost-push inflation. On this chart, you can see the relationship between the Bloomberg Commodity Index in red, which has obviously seen a very sharp increase of late, and then US inflation in the gray. On the right, we've got the commodity basket. So about 30% energy, 20% precious metals, 20% grains, etc. And generally, when commodities go up, it gets more expensive to manufacture goods, it gets more expensive to deliver goods, which is certainly what we are starting to see. And if this relationship holds, we can see that inflation in gray has a very long way to climb. Now, why is this that concerning? And some of you have probably seen this graph. It's concerning because of this. This is US inflation from the mid-1960s to the mid-1980s. You can see that there was that first spike, thought they had it under control, and then the second, even bigger spike came. Now we've got inflation today in the red, overlaid on the exact same chart. So this is inflation from about the mid-2010s onwards. Now note it is a different scale, so we're certainly not expecting inflation to go back to 14 or 15% like in the 80s, but we can see that there is a path or a pattern that is eerily similar. The similarities don't stop there either. In the 1970s, the first wave was basically driven by the Arab oil embargo due to the Yom Kippur War. The second wave started right around the time of the Iran-Iraq War. If we look at the red line today, the first line coincides with the Russian invasion of Ukraine, and the current spike is certainly in part, at least, due to the US's war with Iran. So in both cases, we've got major energy disruptions causing wider economic issues. Now, noted, there is quite a number of differences as well. So US oil production today is on a completely different level than it was during previous oil crises. There was the scrapping of the gold standard, fiscal pressures due to the Vietnam War, etc. So definitely not saying it'll go that high, but there are similarities to be aware of. So if that's our view, how has this increased or affected our asset allocation? You can see over the course of the last year, we've actually increased our equity exposure, which might be surprising and some might think is risky. However, a couple of months ago, a year ago, let's call it a year ago, we could clearly see a path to higher liquidity in the market and earnings growth remaining resilient. That gave us, comfort in increasing our equity exposure, which has arguably been the correct cause. ACWI is up about 28% since then. Our visibility now, however, is certainly getting shorter and much hazier. You might notice on this chart that there is 0 bonds, which is probably different to many of our peers. So why is this the case? Well, we basically just don't find them all that attractive at the moment for the following reasons. Fiscal discipline in the US, a debt burden of $38 trillion and counting. Inflation in recent months has continued to see an uptick in CPI, and now we've seen quite a meaningful uptick in PPI. So that's probably going to feed through. Economic policy in the US is very unclear at the moment. Now, are tariffs coming back or not? Is the Trump administration going to try and influence monetary policy or let the Fed operate independently? And all of this basically introduces more risk, whether real or perceived, into the US system, and investors typically require a higher yield to be compensated for that perceived higher risk. So just to sort of wrap that all together, in terms of valuations, we think the market is somewhat expensive, but there are certainly still opportunities, especially when investing globally. On the inflation front, commodity prices are driving cost-push inflation. However, on the flip side, AI productivity and its downward effect on inflation remains to be seen. Liquidity. If we have higher inflation, we're going to have higher interest rates, which will lead to lower liquidity, which is a negative drag on the markets. And then we are currently, as we saw earlier, approaching the peak or the final innings of the current global interest rate cycle. So if that's our views on the market currently, why do we think we are well positioned to capitalize on that? Well, firstly, we actively manage risk with a system that's been designed to remove emotion and bias from our decision-making process. This allows us to run equity-centric portfolios, which over the long term, is by far the best performing asset class. We run unconstrained portfolios, so we can go after the best opportunities we find wherever they are. And to do that, you have to be nimble. We can make substantial changes to the portfolio within a short space of time if that is required. We are truly global. So South Africa accounts for less than 1% of global GDP. There are entire industries, aerospace, defense, semiconductors, to which we do not have access in the local market, and we want to offer those opportunities to our investors. And then experience. We've been investing globally specifically for the last 25 years. And then just looking at how the funds have performed, especially over the last 3 years since myself and Phil have taken over management of these funds. Even though it officially has a benchmark of SA CPI +3, we aim to significantly outperform that. And the fund has meaningfully outperformed SA CPI +5, which is far more punchy, as well as the average of its global multi-asset peer group. So quite satisfied with that performance. These numbers, of course, in ZAR, if we just look at the underlying performance, because there's obviously been some rand volatility of late. So we can just look at the US dollar funds entry point to get a better idea of the underlying performance, where we can again see that the fund has meaningfully outperformed US CPI +3 and +5. And that is pretty much it from my side. Thank you very much.
Thank you, JD. Fanel, I'll give over to you now. Just see if the presentation come up. Okay, we can see you. There we go.
Thank you so much to JD, and thanks, Jonelle, for the introduction. My name is Fanwell, representing Balondolozi as the Chief Investment Officer. The structure of my presentation will briefly introduce ourselves, look at the global outlook, and also just see the trends that are in the market, and just have a view on how to diversify efficiently given the volatility and uncertainty in the market. So in the next slide, we started our operations in 2010, so we've been in the business for 16 years, and we follow a systematic approach and a quantitative approach where we blend both the top-down and the bottom-up processes to systematically identify our instruments and positioning. So in terms of our core strategies, we do offer multi-asset, equities, fixed income, and cash. But of importance for today, we do offer 2 global funds, the Balondolozi BCI Global Equity Fund and the Balondolozi BCI Global Bonds Fund. And as we look at our investment, we're signatories of the UNPRI, and we also give back in the education sector as a way of giving back to the community. I'll then start in terms of our outlook, looking at just 2 scenarios. Our broader view in the next slide is that the traditional assets are under. There's a lot of challenging. The outlook is quite challenging in the coming 7 to 10 years. So on the right, we've got the expected returns over 7 years, which is mainly influenced by our starting points on the valuation according to history, and on the x-axis we've got the volatility, and you'll find that there we see opportunities in emerging equities, your international small caps that's outside the US, and your international large caps. And then on the fixed income end, we see opportunities in bonds. Just using valuations with using valuations as well in the US, and the growth in earnings over a 7-year period, using the expectations or history, we think there's a lot of pressure in terms of US large caps. So that this might influence the MSCI all country world over the 7 years, where the real returns are expected to be lower than the rest. Then if you look on the chart on the right-hand side, still sort of the same Same concept. You've got your annualized returns on the y-axis, and you've got your volatility, annualized volatility on the x-axis. What we're just trying to show there, the outlook is that expected returns from traditional assets, your US equities, private debt or private equity, the expectation is that the returns will be lower as well. And save for your commodities, your broad commodities, that's where the expectation is for returns or real returns to move away from negative returns as expected, as experienced in the past 14 years, and that return being positive. So we think there's pressure in terms of returns, and other than the pressure, there's also increased volatility or expected volatility in terms of the asset classes. But what we've seen over the past 14 years, in the next chart, if we look at the next chart, just to see how investors have been reacting, the next thing that we've seen in terms of looking for alpha opportunities, we've got a chart on our left-hand side where we've got blue and green bars. This obviously from Morningstar data and MSCI. The blue bars just show the amount of allocations to investor funds, mainly in the developed markets, which shows that large cap, US large cap, that's about 50% of allocations. And you've got most of the allocations even outside the US with 15%, emerging market at 10, the blue bars. And the green bars, they show just the success rate in terms of hunting alpha there in the particular sectors. So, and that's over the past 15 years, ending end of 2024. What it shows is that from 2010 up to 2020, end of 2024, the success in hunting alpha wasn't as much. If we look at the extreme left there, your success in US large caps, that's an alpha above the composite passive benchmarks, has been just over 10%. But then success in terms of other markets, whether it's emerging markets, Europe or ex-US, the success has been slightly better there, or has been better at about 30 to 35%. So there's pressure in terms of the traditional assets, especially large caps in the US. And the other thing is the opportunities of being able to pick the right securities. The success rate there is also quite low. Obviously, outside the US, we see the success is a lot better, but most of the funds are allocated, the global funds are allocated to the US large caps, as we see from that analysis. So on the right-hand side, we just saw the conundrum. We're just trying to show that in terms of how the paradox where large cap or large AUM, the potential alpha is potential alpha. We're not saying large cap funds, they underperform, but the potential alpha is probably expected to be lower than what you'd get from funds that have got small AUM or that focus on your large caps, on your smaller caps there. So we've established that there's pressure on traditional assets. Expected returns are expected to be lower than what we've realized since 2010. And the success rate of picking instruments there, again, is also lower in the large caps. So there's been a marked shift in the pension funds in the next slide on how pension funds allocate risk. And I mean, we're talking about the outlook, which we appreciate, but there are some market trends that also have been influencing returns or positioning that probably might not have, they're not directly influenced by the investment outlook. So we've got three charts there. I mean, probably I'm repeating that what we've seen, where investors from 2000 pulled about 6 trillion, apologies, from active funds, and those have been allocated to your passive equities, about 7 to 8 trillion allocated there. And then you've seen that because of but the difficulty in getting alpha in the traditional assets, you've seen the growth in the hedge funds, private equity in the chart right in the middle there, where most of the stuff has gone to private equity, and hedge funds since 2016 haven't grown as much as the private equity. But obviously, we've seen how the private credit issues have started to emerge from late last year, and investors are looking for alpha somewhere, and alternatives seem to be the preferred spot, and not necessarily the active equities. And then on the extreme right there, we just look at the risk contributions of the asset classes that we look at, that in pension funds, mainly that's from the North America, the developed market. You'll see that the share of risk contributed by active equities has been falling. So these are just broad trends, and you'll see that the risk contributed by passive equities in the alternatives has been growing. So to counter the difficulty of getting alpha in the large caps or in the developed markets, people seem to be moving towards passive equities. So in terms of passive equities, and your private markets or alternatives. So in the next slide, we just look at the next bit in terms of the persistence of alpha in those in the markets that I'd looked at in the previous slide. You'll see that your excess returns over a rolling 3-year period, again, large cap, on average, that's the average active manager compared to your average passive benchmark. You'll see that US large caps have been struggling to outperform their benchmarks. In your alternatives, equity market neutral, that's your median hedge fund in that bit, you see that the persistence, the green line, the persistence of alpha there has been quite encouraging. And obviously your small caps, that has been positive as well. But again, the theme there is the asset classes that get large allocations to get sustainable alpha is quite difficult there. So on bottom right, it's the same thing, just the success rate. You'll find that it's a lot better, intermediate in ex-USA or ex-large. That's what we're seeing. So we think portfolios should be structured for alpha and not just for scale, just to counter the moves in passives. And one of the ways to take advantage of the success in the intermediate bonds or your corporate bonds is what we suggest in the next slide, where we incorporate just the portable alpha strategies to change the risk return metrics in our portfolios. So essentially, you're combining enhanced cash, your shorter dated bonds, you combine them with structures that are aligned to your MSCI, all country weighted index, and then by combining cash and derivatives, either total return swaps or futures, that should be able to give you the index return plus alpha from a cash fund whose success metrics are a lot better than what you get in the large caps. So if you go to the next 2 slides, just to conclude just to show the benefits of combining the portable alpha is we've seen, I'll just take a step there. We've seen that with a 60-40 portfolio, the evolution over the past 20 years has been incorporating alternatives rather than having a 16 equities and 14 bonds. You've seen that investors, they take the 10% in equities, add in alternatives, another 10% in fixed income, look for alternatives. Of course, the range varies there. But what we propose, what we think the most efficient way to do is to allocate a bit of equities, global equities in the AA funds, multi-asset funds, to a portable alpha strategies to be able to enhance risk return metrics there. So in terms of just looking, running in the next slide, just running an efficient frontier in terms of return. We've got the curved line, which just using the US, you've got your US equities and your US fixed income, that's the Bloomberg Aggregate Bond Index, running the efficient frontier there. With passives, your 60-40 gives you the return, that's expected return of just under 6 and your volatility of 10. If you move that into just active strategies with your active equities and active bonds, the return profile there moves to the dot number 1. And then if you then add alternatives, in this case, it's your private 50% in private equity or 50% in hedge funds. The risk return matrix it lowers the volatility, and that's dot number 2 with a lower volatility and high expected returns. And then if you use another alternative portfolio, like I've said, where you just allocate again 60% in equities and 40% in bonds, but part of that equities is applied via portable alpha, that should give you a higher return profile with the same expected volatility. Again, this is just it's more of a simulation using historical returns. So our outlook is that there is value in emerging markets. There is value outside the US, and in the fixed income space, there is value in emerging markets. So, but we think the most efficient way of being able to capture that value is to use dedicate a portion in portable alpha strategies to change the risk return metrics within portfolios. I think thanks Jonelle. That's our bit on our end. I'll hand over.
Thank you very much. Thank you. Paul, over to you.
Perfect. Thank you, Janelle. I'm just sharing my screen. Give me one moment. Fantastic. Yeah, thanks, Janelle. Thanks, Eugene and Tanya. Always good to be part of these conferences, and thanks everyone for your time on the chat today. Just a little bit of an introduction. My name is Paul Fouché. I'm the co-founder and chief investment officer at New Road Capital. And really what I want to talk to you today, well, just maybe a bit of background. We run 6 mandates. It's all multi-asset. So we run everything from multi-asset income all the way to a global multi-asset flexible solution. But all multi-asset is our speciality. We're more of a quant-based manager. We've got a lot of engineers and mathematicians in our team. And essentially what we're trying to do is we're trying to use quantitative and portfolio construction to optimize a portfolio. So that's what I'm going to talk to you a little bit about today. So I'm not going to get too much on the views, and we can talk about views later. We obviously have our macro views. But really what I wanted to get across today is something that I think is overlooked in the markets a little bit. It's actually portfolio construction. So if you look at multi-asset, and that's the section of this conference, multi-asset, the reason you own a multi-asset fund is because you want to offset risks in your portfolio. If you didn't want to offset risks, you would probably just own a pure equity fund, because that's long-term going to be your best, most likely your best returning kind of solution. But obviously that's going to come with heavy volatility. So, what you're trying to do with a multi-asset portfolio is you're trying to offset risk. It's almost like a hedge fund in that way. And that's really how we think about multi-asset. So not going to talk about Iran, not going to talk about inflation. We can cover that in the questions, but really just a little bit of detail around portfolio construction. And I think it's an overlooked part of the sort of investment landscape at the moment is how do you actually, different ways of think of putting a portfolio together. So just a little bit of a story. If you look, everyone has a view. So everyone has a view in the markets. It's important to have a view. If you don't have a view in the markets, you can't build a portfolio. But the crucial part of the portfolio construction is actually what do you do with that view? So now you've got a view, how do you incorporate it into a multi-asset portfolio? And there's infinitely many ways you could do that. And this kind of analogy is just showing you these two investors essentially have the same view. They can both see clouds rolling in. They can see that, a storm is about to come and it's going to start raining. But you can see the difference in reaction is massive, because the one investor has been more prepared than the other investors. You can see the little boy, he's got his shorts and his t-shirts and a slops on, and he's now obviously running in to get warm, to stay dry. But you can see the girl, she's ready to plant some seeds because she's prepared. She's got her umbrella, she's got her boots, she's got her rain jacket, and she's really prepared for the rain. So you can see they have the exact same view, but what they're doing about the view is very different. And this comes to the importance in multi-asset portfolios is being prepared for events that you don't see coming before they come. Because if once the market sees them coming, it's kind of, your risk mitigation, anything you've put in place is pointless if you're not prepared properly for it. And I think a big sort of misconception, or a big kind of spoken thing in the markets, is you almost get this confirmation bias in the markets where, you have this misconception that conviction equals control. So everyone has a view. They take a convicted call on that view, and they almost think that investors naturally think this, and this is what confirmation bias is that if we do more work, if we do more research, if we try and understand the markets a little bit better, we try and understand the specific stock we want to buy a little bit better, macro a little bit better, that it almost gives you the sense of control, that you have control over the outcome of your portfolio. But really speaking, we don't have any control. I mean, ultimately the future is unpredictable. We are working with incomplete information, and we need to understand that we're working with incomplete information going into it. And I think people over-rely on the work that they do in their portfolios, building out those views, and it gives them that confirmation bias. And you see this a lot. So, on the top there, the little boy, he's got a belief. So he's got a belief system that it's going to be sunny. That's then going to inform his strategy. So what's he going to wear for the day? He's going to wear shorts and a t-shirt. And then you can see what happens a lot of the time is that strategy then informs, you almost select evidence to back up your strategy, which backs up your belief in a way. So you're looking at the selective evidence. So you can see, it's raining, it's bucketing down on him, but you can see there's that little bit of blue sky. And he's saying, there's the blue sky. I told you there was going to be blue sky today. And it's important to be humble and to realize that, we don't actually know. We can do all the research we want. We can look at the numbers. But things unforeseen come, and you have to be able to be prepared for that going in. So you can see at the bottom, that's more the process we try and follow at New Road. As you look at the empirical evidence, you see what's happening out on the field, in the markets in the world. You let that inform your strategy, and that should inform your belief system. So you're gleaning a belief system on the back of your strategy rather than your belief system informing your strategy. And we think that's very important. And that goes into really, if you look at it, there's two kind of traditional processes of building a portfolio out. This can be single asset, multi-asset, doesn't really matter. But they're building their bedrock, they're building the foundations of their portfolio on a lot of incorrect information. So the first sort of process would be your bottom-up process. So you've got guys who are focused on security selection. They understand finances really well. They understand, about how to look at a balance sheet, how to look at an income statement, and they really do a lot of work on security selection. Then they kind of build up the asset allocation. It's generally a strategic asset allocation, and then they'll overlay their macro views on top of that, and then they'll probably tactically shift around that. But the bedrock and the kind of foundation of that process is actually on the security selection. And there's a lot of unknowns when it comes to security selection. You can take China, for example. China has been had pretty good GDP growth over the last 20 years, or 10 years, but their markets have not done well. And that's just because of one unforeseen event, and that's been share issuances. So management teams in China have decided to issue a lot of shares to fund operations. It kind of just started. So you can look at the stocks all day, but if you never foresaw that coming, you're kind of not going to understand why the equity markets haven't really moved that much until recently. Top down is the other sort of traditional process. So guys will look at the macro view first. They'll try and get all the macro. They'll try and look at all the information they can around macro, try and understand that as much as they can, and then from that inform an asset allocation, and then from there feed into their security selection or not as an afterthought, but as after the fact in the process. What we're saying, we've got a bit more of an integrated quantitative process on the right, is we're saying, forget about your views, forget about the foundation you're building your views on. It doesn't matter if it's asset allocation, macro. First of all, what you got to do is you got to get your portfolio construction right, understanding how asset classes work together, and not incorporating your views on top of it. So building out a very robust process in terms of asset allocation, and then incorporating your macro views, your indexing and your thematics into that. We at New Road, we use indexation a lot, we use thematics a lot, and we use security selection. You know, that's the universe available to us. We're not just we do have stock picking capability, but we also think that there's a massive space for thematics in a portfolio and a massive space for indexation as well. Thematics, you know, what's nice about thematics is you can get exposure to a theme without having to predict too much what happens within the theme at the stock level. So, for example, you know, social media has been a great investment over the last 20 years. However, if you had invested in MySpace, you probably wouldn't be doing too well. Another thing at the moment is looking at semiconductors. You're seeing a shift in semiconductors. So I think, you know, the theme, the semiconductor theme, the AI theme is still very much in play, but you've seen the likes of your big GPU manufacturers, your likes of your NVIDIAs being overtaken by your memory chip makers. Now, that's not something you can easily foresee by just owning the specific stocks. So you want to have a nice thematic exposure, and you actually want to get the exposure to the theme rather than just the stock. So we look at all of that, and it's the important thing is it's very integrated. How does this look in practice? We've only got 10 minutes, but I'll give you a couple sort of practical examples. Is if you look on the left, that would be your sort of traditional equity manager. So what they would do is they would go and look at all the ideas, and they would have to build a portfolio of, let's say, I don't know, 40 stocks. If it's really concentrated, maybe 20 stocks in the portfolio. But understanding that, you know, those views, it's very hard to have convicted views on that many stocks at all the time. Sometimes in the market, you know, it provides a lot of opportunities. Other times it doesn't. And I think we need to be honest with ourselves about that and understand that at any one point in time, your really good ideas are few and far between. The really convicted good ideas are few and far between. So as I said, important to have those conviction ideas, but remember that you're dealing with unlimited information and you're not going to get things right all the time. So you've got to limit those ideas with build your portfolio on that bedrock of your portfolio construction methodology first, and then overlay your views and macro. What we try and do on the right is we'll have those good ideas. Those might be thematics, they might be single stocks. But instead of trying to build out a whole portfolio within that carve out, we'd say let's index. So let's index the rest of it. And what it allows you to do, it allows you to take a lot more active risk with the holdings that you do want to look at, because you kind of anchoring yourself back to an index. So it's a very good risk mitigation strategy to be able to do this, instead of just trying to build the portfolio up from ground roots all the way. So definitely something different that we're doing in the market. If you look at another example, we call it a risk barbell or a risk seesaw. You've all heard of a barbell approach in fixed income, where guys will take like very low duration, let's say credit or cash, and then they'll barbell it with your sort of high duration bonds, for example. You can do that within asset classes and around asset classes as well. So this is just an example. It's just the last 10 years. You've got S&P's got a specific risk return relationship. Okay, and if you just invested in the S&P 500, you would have done really well over the last 10 years. You would have done almost 16%, and that would have been your sort of average drawdown through the period. So it's coming with its equity volatility. What you could do is you combine US long-term treasuries and the NASDAQ, which we know is a higher beta index. So generally it'll go up more when the S&P 500 goes up, but it'll also tend to drop more when the S&P 500 goes down. But if you combine those in the right way and you actually seesaw and you pivot around S&P 500's risk characteristics, you can actually build a portfolio, as I say, with similar risk characteristics, but you're actually getting quite a lot more alpha. So you've actually increased your return over the last 10 years by, more than 1.5%. with no extra risk. Even though you're using a higher beta index, you're just offsetting it with US treasuries. Now, this is a very simple example. It's two asset classes. What our quant's process tries to do in the background is the same thing, but with all the different asset classes, thematics, single stock opportunities available to us. So, for example, if we added a stock into the portfolio, it wouldn't just be a case of, okay, let's add a stock into the portfolio. We'd actually reweight and rebalance the whole portfolio, given that stock's risk return characteristics, given its statistics and what it looks like. We'd actually incorporate that into the portfolio in a whole, and not just adding ad hoc a new investment or opportunity into the portfolio. So how we think about it, it's often the things you don't have a conviction on, and the things you don't see that can be the problem, and that can be the undoing of a portfolio. So being very cognizant and very aware of that. So, we wouldn't make, if we decide that, or if the model says to us, you need to upweight treasuries, it's not just a thing of upweighting treasuries and selling something else. Your whole portfolio gets reshifted and rebuilt in light of the fact that you have a higher treasury allocation. That's very important. So when I talk about the integrated process, we're looking at everything in time with everything else, which is very important. And obviously, we require a lot of modeling and quantitative methodology to do that. The human mind can't think, can think in binaries. This is a binary sort of outcome, but it thinks in sort of more dimensions, and that's how it builds a portfolio. Just quickly, not to take too much of your time, if we just look at performance. So, I always say, we're all going to sit up here and talk today, but you got to look at the scoreboard. What are the numbers actually telling you, and is what everyone is saying, does it actually match the results? So I first want to just go through performance a little bit. We run 6 mandates. Performance and risk metrics are pretty consistent across the mandates. So I'm just taking global flexible today, but you can look at any of our funds. You'll see a similar kind of properties coming out. But if you look at this, performance has been phenomenal since inception, particularly over the last year and year to date. And if you remember, you would know, it's been very volatile, especially year to date in the last year. And you can see that's where a process like ours, having a very fixed, robust process in the background, focused on portfolio construction, can add a lot of value. So we've taken advantage of the volatility to be able to add a lot of value in times of stress. So it's been a very good, since we've started, it's been good markets, but really over the last year, phenomenal outperformance, and it's taking advantage of that volatility we've seen in the market. But it's not just about the returns; it's also about how you get the returns. So in portfolio construction, you want to make sure your portfolios are efficient. So I've just done this is an ex post. So this is actually the last 3 years, just real world data. So this is 3 years returns. This is our fund, the New Road BCR Global Flexible Fund there. All these gray dots would be other funds in that ASISA category. You can see the global multi-asset flexible average would be over there. Here's MSCI World. So that's just a passive index of equity. And you can see what you want to see. And this is, no one could predict 3 years ago. No one saw what was going to come. We've had a lot of unforeseen events. But what you want to see ex post through this is you want to see what we want to see in our process. You want to see getting good returns, but at the same time managing that drawdown. So we look at it as an efficient curve, but instead of using volatility on your x-axis, it's using maximum drawdown. We prefer to optimize against that rather than volatility because, good positive volatility you actually want. It's good. The penalty is actually the negative volatility or the drawdown. So you can see in 3 years we've done phenomenally good returns. It's been a bull market. MSCI World has done well, and this is in rands. It's done about 17% a year over the last 3 years. We've been able to beat that with less risk. And the important thing is we've only done it over time with about 80% equity. So we've had about 20% in bonds. A big differentiator you will see in our portfolios is we do own some long-term US treasuries as a hedge. And get more into that in the question and answer sessions. But you can see we've been able to beat world while still having less drawdowns. And you can see just how inefficient a lot of portfolios are. So this is kind of the category average. So anything below here, you're kind of giving up return for the same drawdown through that time period. And anything sort of to the right, you've got the same return, but you're taking a lot more risk in order to get that return. So you kind of want to be up in this top left here. The holy grail would be 100% return with no risk, right? No drawdown. So you can see, that's what our portfolio has been able to do. And as I said, it's very similar across all our portfolios. But that's important takeaway is that we are getting good returns in the market, but at the same time managing our risk, managing our drawdowns, and doing something differently to the rest of the market. So just to finalize, everyone has a view, and sometimes the view is good and sometimes it's bad. But importantly, remember that your portfolio construction is the most important thing. And you can see, obviously, now these two investors, they can see it's a good day. They're taking advantage of the sun. But you can see the girl, she's still prepared. She's still got her rain jacket there. She's still got her umbrella. She's got her boots. And what she's been able to do is she's been able to reap the rewards of the rain. She's actually, because she came into it prepared, she was able to plant seeds. And she was able to reap that reward going into that sunny environment. And that's what we try and do at New Road as a simple analogy. So just be prepared understand you're not going to know everything. Understand that a lot of your conviction is built on incomplete information. And then try and remember that and try and be prepared for those unforeseen events, just like this little girl is. So, yeah, thank you. That's pretty much me. Take it away for questions.
Thank you, Paul. So we've got about 5 minutes left for questions. So JD, maybe the first question to you on your current positioning. Do you believe that the traditional correlation between bonds and equities still hold in the current market environment? You don't have any bonds at the moment. Traditionally, we know when equities went up, bonds were short of a protection. Does that still hold, or is it a new regime?
No, so we definitely think there's been a breakdown in that regime. I think it's probably one of the most challenging aspects of managing a flexible portfolio in the current environment. So when you've got inflation, which is a dominant macro variable, we've now seen situations where bonds and stocks, sell off together, and the traditional 60-40 hedge doesn't completely work. No, so we definitely think there's been a breakdown in that, particularly in the US where you've got good corporate margins, that supports the equity side of it, but you've got this unsustainable fiscal situation, war currently dragging out, and bond yields in general, or across the curve coming under pressure.
Thank you. Fanuel, maybe just to you, what would make you change your portfolio? Something that dramatically happens in the economy market that will make you change your portfolio and reposition it?
Thank you, For us, I think I'll just, I think from JD's presentation in terms of liquidity, I think if there are the shocks in terms of supply shocks, if it goes beyond the current Iran-US hostilities, I think that also is a core thing. What impacts liquidity and how that would filter through both from developed and emerging markets. That's our call. That's what you're watching at. That's what you're looking at. Yeah.
Thank you. And Paul, maybe touching on your approach on the thematic using of indexation, we've seen that a lot of these micro companies that's positioned and building on the AI has actually become macro. How has AI changed your investment process to the better?
Janelle, I think massively. I think that's the beauty of AI in just in the world, is that you're able to get more efficient. So our analysts can do a lot more, especially with things like data processing. So being able to aggregate data, being able to kind of visualize it, and to be able to process it, to be able to put it in a model, it's massive. So we use quite a few of the different. We use Perplexity quite a bit, and we use a couple of the chat. We use Claude. And we think it's just able to make the analysts just a lot more efficient. They can just do so much more. So you can actually run, I think going forward, you'll probably see you can run portfolios with probably less headcount than you used to be able to, just because of AI, or if you kept the same headcount, they're just going to be so much more efficient as well.
Thank you very much. We've unfortunately ran out of time. As I said, the multi-asset panel is always one of the best to host because there's such different views and how people position the portfolios to get alpha, especially through this turbulent time. So thank you very much for joining me.
Thank you, Janelle. And thanks, everyone. Thanks, Eugene. Thanks, Tanya.
Thank you so much for having us.
Yeah, bye-bye.
Yes, bye.
Thank you, gents. And really a good conversation there. Thank you for your time. And you're at the right spot if you have time for a quick brunch. Very jealous. But we're moving on before we break for tea. Our first hedge fund panel, which proves always to be very interesting. Joining us online now as the moderator to the session is Managing Director at Apex Investment Consulting, Pierre de Klerk. Good morning, Pierre. Thank you for joining us online. Are you well?
Good morning, Eugene. Very well, thank you. And thanks for the opportunity again.
Oh, it's great to have you on board as well. Pierre will be joined by Johan Kutz from Terebinth Capital, Pooja Tana from Perpetua Investment Managers, and Andre Retief from Novare Investments. Pierre, with that, I'll hand over to you. Thank you so much.
Thank you, Eugene, and good morning to the audience and to the panelists. Thanks for joining us this morning. After that introduction of the speakers by Eugene, I would like to say by way of introduction that I've set for the topic for the panel hedge fund strategies in an overall portfolio context. And the reason why I chose to do that today was to make it a very practical session on the one hand. And I think on the other hand, most investors or many investors and allocators are quite convinced about the merits of hedge funds and hedge fund strategies based on the knowledge of the managers and the quality of the managers and their processes and even the performance of the hedge funds. But investors are often uncertain exactly how and where a specific hedge fund strategy should and could fit into their overall portfolio. So in an overall portfolio context. And therefore, when I communicated with the panelists before today's session, I encouraged them to cover this aspect in their presentations, or we can pick it up in the Q&A afterwards. So this aspect of where does their strategy fit into an overall portfolio context? How should investors think about their strategy that the speaker are going to present? Is it a risk diversifier? Is it an income generator? Is it a capital protector in an overall portfolio? Or is it a return enhancer? And obviously those things are not mutually exclusive. It can cover more than one of those bases. Also, what investors' key expectations should be from their strategy in terms of its return profile, its volatility, its downside, and also the term or the time period that should be given to the strategy to work properly. Also, what type of investors is the strategy most suited to, and what market environments is best and worst suited to the strategy? In what market environments does it do best or not necessarily well? And then lastly, what is typically misunderstood about their specific strategy and the contribution it can make in a portfolio? So trying to make it very practical today. Hopefully we cover much of that in the presentations and in the Q&A. And with that, Johan, you are first up. You can have your presentation. Yes, thank you.
Okay, so I think the first thing to say is not all hedge funds are created equally. There's many different hedge funds, many different styles. And we are very different from, for example, what we refer to as the leveraged beta hedge funds. But for certain allocators, that could be quite useful to have a levered beta fund. But if that is what you're after, that's not us. We are very much in the kind of alpha environment. First thing to note is that the environment at the moment is interesting. There's quite a lot happening in the Middle East, and that is shifting the investment landscape and how allocators should be looking at their portfolios. Every few years or every decade or so, you get a bit of a stress event. All of a sudden, beta has very sharp moves, and that necessitates a closer analysis on portfolio construction and how to combine the different kind of beta sources, let's say equities and bonds, income funds with hedge funds to create the kind of right risk return profile that suits the environment. So last week, the South African Central Bank raised the interest rates. The market did a victory lap in that they viewed it as a very dovish hike. Well, there is a school of thought that it is the first of many. The market pricing currently, if I look at my screen, is pricing another 2 interest rate hikes of 25 basis points. And let's quickly just look at the process that got us to this point. You had the Iran-US or the US attack on Iran and Israel, and all of a sudden that changed the kind of perception of the markets of what's happening to interest rates or what's going to happen to interest rates, because you've got a potential spillover to inflation risks. If you look at the top right-hand chart, you'll see that the kind of monetary policy part of the interest rate curve, the 2-year interest rate swap, this shows the movement from before the conflict until 22 May when I put the slides together. And what you'll notice there is that South Africa interest rate moved second most, so close to 120 basis points from the point pre-conflict to now. South Africa does tend to be we call it a high beta version of many of the markets. But it also, one has to keep in mind that it had a very, very low starting point. Before the conflict, we were still expecting interest rate cuts. So what's important for the allocator is obviously what the bond market is doing, because most allocators will have a substantial allocation to bonds. 2025 was super constructive. A lot of good stuff happened for South Africa. You had the adoption of a new inflation target. You had rating upgrade, you had debt issuance reduction. The market celebrated this with a very strong rally into, I think, middle February on the bond market. All of a sudden that changed. The events took place, and you've got the 10-year interest rate swap, which is reflective of bonds. This is the chart at the bottom that moved significantly, where South Africa took the most pain. Once again, the starting point for South Africa was one of a lot was priced in, and the market was very bullish. Now, what is the process taking place here, and what should an allocator be thinking of when he tries to map the economic environment going forward? It's very straightforward. You had a oil price shock. If you look at the flow chart on the left, from that you had fuel, fertilizer, transport that moved. That spills over to food prices. Inflation rises, inflation expectations rise. Market is normally quite slow to adjust its anticipation of what inflation expectations will do, but the policymakers are more forward-looking, and they tend to change their reaction function to start protecting the inflation target that they have set. So that necessitates interest rate hikes. Similarly, there's another event that's busy developing in the world. Ocean temperatures are rising to a certain level where the models from the smart scientists out there shows a very high probability of a major El Nino event. The long and short of that is you'll have severe droughts, most likely in the South African region, which will have a knock-on impact to food prices. And if that is the case, same kind of thing. Inflation rises, inflation expectations rises, and policymakers have to adjust the monetary policy setting. Now, this has a knock-on effect for all your markets. It could have for, let's say, food retailers, food producers, anyone that transports anything. There's so many different angles to this, and this is where you have to consider, what will my bond portfolio do in this environment? What will my equity portfolio do in this environment? And if I'm into a bond portfolio, what type of mandate should I be giving out? Surely if inflation is rising, inflation-linked bonds becomes interesting. If inflation is rising and as a consequence monetary policy rises, surely then floating rate notes become interesting and income funds. So, allocators need to very dynamically be aware of the environment and adjust exposure to best reflect the view on that. So during these turbulent times, hedge funds, what kind of hedge fund do you want? As I say on the slide, allocators need to differentiate between true uncorrelated diversifiers that offers downside protection when markets crash. And sometimes you have leveraged alpha funds masquerading as hedge funds. I'm not saying that's a bad thing. There's definitely an environment where that is something that will benefit an allocator, but that is not what we do. We are pretty much in the downside protection and alpha generation camp. What we offer is we offer market agility and capital preservation. This can be seen in our stats over a very long history. Market agility meaning that as opposed to a long-only fund that sits close to the benchmark, we are happy to go either way. We're agnostic to market direction. We entered 2026 with a long position in bonds interest rate swaps. And within a couple of days, when we saw the US fleet closing in on the Middle East, we swung the portfolio to a short position. We don't have a bias. We go either way. So our approach is pretty much a consistent, repeatable investment process. It is very research driven and it's very dynamic and real time. So we are very agile and we have a tactical risk management process. So we run the stats on many times a day, look at our portfolio risk, look at the value at risk and dial risk up and down, depending on the kind of, let's call it the headline ping pong between Iran and Trump. And then also based on our conviction and what our investment process tells us. So our investment process is our guiding North Star, as the picture shows there, that sets our asset class targets with a 12-month horizon. But, asset prices don't move from the current level to the predicted level in a straight line. There's many zigzags on the way. And this is where our relative value and our active and dynamic approach produces a lot of alpha on the way to that. Then the kind of brief of this presentation is sort of summarized in the slide. The asset allocator needs to decide on the portfolio role when he considers various hedge funds. What do I want as an allocator? Do I want to diversify, return enhancer? Do I want leveraged beta, as I said? Do I want capital preservation? Do I want income? And from that, you can create a shorter list of your target hedge funds, and then you go further. You look at what's my expectations? What kind of return profile volatility do I want? If you want a very high vol hedge fund, then we probably not the hedge fund for you. If you want something that's more mid-range to low vol, then we should be on that short list. So in this way, you can get your list even shorter. You will have to look at your investor types as an allocator. Which investors is this fund suited to? And very important for me is environments. You can take the various hedge funds on your list. You can map the performance against different regimes and environments, whether or business cycles or inflation cycles. And once you have a firm view on the kind of environment that we are faced with going forward, then you can look at the hedge funds that you mapped against that and make a selection. Then obviously there's misunderstandings about hedge funds, and that is something that we'll address a little bit later. But the important point out of all of this that our CIO always likes to say is that little line at the bottom: whoever protects the downside best wins over time. And this is so true. If you as a fund manager are able to limit the downside, then you get the benefit of not having to recover from a deep drawdown, and you have the compounding effect of alpha building up over time. So, just keep returns steady, and it will compound. Quick glance at our hedge fund. Since 2013, long track record, alpha of close to 6%, Sharpe ratio 0.69. Typically, the large international allocators look for alpha of between 5 and 6 and a Sharpe of 1. Just to mention, you will see that some of the hedge funds out there will have a very low volatility and a high Sharpe. Then you need to, as an allocator, investigate why is that the case. Because sometimes the higher Sharpe hedge funds are more credit funds. So there's a lot of, as we refer to it, coupon clipping involved. Meaning that you could have a default event and a large sudden drawdown. So just be aware what creates a certain stat that you are staring at. Out of this slide, the part that for me is most important that allocators should consider when looking at a balanced portfolio is correlation. Our correlation to the All Bond Index is 0.27. So, I'm not a professor of statistics, but I can tell you that pretty much means there's no correlation. You want a hedge fund, if it's part of a portfolio, that's not correlated to all your other asset classes. I'm going to skip over a couple of these slides. So the primary role of this fund is a diversifier and risk-adjusted return enhancer. So allocators should look at these 4 points. Our fund, for example, from a diversification perspective, as I mentioned already, it's got a low correlation to bonds, but also to equities. So it is a genuine return stream, not a replacement or substitute for the other allocations that you have, but I would say it's an additional return stream. So maybe look at it from that angle. Does it enhance return? Over history, in the past, obviously not a predictor of future, but over history it has had equity-like returns, but at volatility similar to the bond market. Then from a capital preservation perspective, that is what I referred to earlier about protecting the downside. Our fund is one of the only ones that has got mandated stop losses written in. So if we draw down 2%, we halve risk. If we draw down 3%, we, as we call it, clean the deck. We close out all positions, take a trading break, reassess, do our analysis, and re-enter. And hopefully not exactly the same positions unless our deep research confirms that it was the right positions. But one needs to sometimes, as a PM, clear your mind before and reassess before re-entering. And this is the big difference between hedge funds and long only. If you're in a long only fund and the market draws down, you will draw down. There's no getting around it. Long only managers don't really risk manage on an absolute return basis. They are relative. Where hedge funds, if markets go bad and you're not a deer in the headlights type manager, you will protect the downside and you will live to fight another day. Income generator. Our fund although it's not an income fund, our income fund team manages the actual cash in the portfolio. So indirectly, you have got additional alpha from efficient cash management, and that gives us an additional buffer to use as risk budget on our more tactical and strategic views on the hedge fund itself. Evidence of diversification. I compare the fund here to the SA multi-asset spectrum, and you'll see across the spectrum correlations are very low, once again showing there's diversification benefit. One point is what we call the asymmetric capture. If you look at the little block in the bottom right-hand side, we looked at 102 months where the all bond index had bull markets or had positive returns. In those months, 86 of those months, the fund also had positive months. The same with the Aussie. Aussie had 94 positive months in this period of analysis. Our fund had 74 periods of positive months. However, when there's negative returns, we participate only in a small number of that. So the all bond index had a bear market 50 months. We had negative months, 18 of those. So the asymmetric capture is important when an allocator looks at all the different hedge funds and put them side by side. You need to ensure that you compare apples with apples. I'm going to skip over this. Just long-term returns. Top one is Terebinth hedge fund. Light blue is equity. So very similar returns. Volatility is just a lot lower. Who's the portfolio best suited for? As I say in the slide here, multi-asset and balanced portfolios that need a diversifier and positive expected return. Conservative to moderate end of the spectrum. So there's a few different investor types that I think it is very suitable for, but you need to look at the environment. What environment? Let's first look at does not work for us. A trending, slow, gradual, predictable environment where the market agrees with the central bank forecast path of interest rates does not suit us. We need volatility. We need regime change. We excel when we are at inflection points in monetary policy and fiscal policy. We've got a very research-driven process. We do a cycle analysis, scenario forecasting. We look at the economy from all angles, and based on that, we make predictions. And where we extract value is when our predictions differ from market pricing and from what policymakers are saying, because that's where you get the kind of asymmetry from. That's where you get a lot more upside. So volatile environments works for us. Dislocations between market expectations and policymakers work for us. Where there's a stress event, that works for us. We are quick and agile, and we do our research and homework. We don't make decisions just based on price action. Common misconceptions. I'm just the first two I think is interesting. There's very often the kind of myth that hedge funds are opaque and illiquid and risky. Well, our industry is a regulated industry. We've got monthly MDDs. There's a high level of liquidity. We pretty much view the portfolio as not our portfolio, it's the investor's portfolio. We are the custodian of your portfolio. You are welcome to any information on it. So definitely no secrecy. I think it's very open and well regulated. Our fund is a retail class fund. The QIF funds are maybe a little bit less liquid, but it's worth obviously for allocator to also weigh up what type of fund and what kind of depth of information you require. And then leverage amplifies risk uncontrollably is myth number 2. Once again, the regulatory VaR limit is 20%. We're running at the moment about 4%. We're happy to dial it up to slightly above 10%. But that is when you've got high conviction, you see opportunities in the market, you dial up risk. And if you don't, you dial down risk. If you compare that and had to calculate the VaR on a equity fund or a bond fund, it will be multiples of what the hedge funds run. So statistically or mathematically, one needs to be very careful to think the hedge funds are leveraged bets, because if you do the math compared to a beta fund, it is not. So allocator needs to be very aware of that when they combine it with their portfolio. It actually will most likely bring down your portfolio volatility. And just a quick glance before I switch over. A starting framework for allocators when they think about the fund, what kind of allocation should they make to a fund like this? Not necessarily our fund, but a fund suitable to them. If you're a conservative and a balanced type investor, we have a range of 5 to 10%. And as you get more risky, the range obviously moves a little bit higher. You may find that some allocators will opt for the more directional hedge funds. If you have a higher volatility hedge fund, obviously you'll make a slightly lower allocation. And with that, I think I'm happy to end it right there. Thank you.
Thank you very much, Johan. That was a whirlwind. I would recommend that the viewers, when they receive the slides afterwards, have a look at some of the slides that Johan skipped as well, because there were some other very good slides about the characteristics of their strategy. The next presenter is Pooja Tanna from Perpetua. You're welcome to get your slides up. And just to the audience, I neglected earlier to say that you're welcome to post questions in the Q&A box, and we can take that afterwards. Over to you, Pooja. You've got until about 11:10.
Thank you, Pierre. Thank you. Good morning, everyone, and thank you for the opportunity to present. Pierre, I tried to answer a few of your questions, so I'm going to go straight into it. Can you see my screen?
Yes, thank you.
Great, fantastic. Okay, fixed income in a world where the old playbook no longer works. And what I want to touch on today is why hedge funds, specifically fixed income, should be part of your portfolio construction, and where should the strategy fit in an overall portfolio context. So one of the most common discussion points coming up in our meetings is whether the 60-40 model still holds. The challenge is that this model was built for a world that no longer exists, a disinflationary low-vol environment where bonds reliably hedged equity risk. Traditionally, fixed income has been the go-to diversifier, but that relationship has broken down. And in order for fixed income or fixed income hedge funds to deliver the required returns in this environment, you need the right tools and, importantly, the ability to use them effectively. So the old playbook where bonds meant protection, correlations were stable, and volatility was temporary is broken. As a result, traditional portfolios, often without realizing it, are effectively short optionality. They're exposed to outcomes they are not built for and therefore cannot control. So the issue isn't necessarily the assets themselves, it's the way portfolios are constructed. Now, given that we are calling into question our 60-40 playbook, where equities generated the return and bonds provided the protection, the challenge today is that those relationships have become far less reliable. So if you look at where we've positioned ourselves, it's intentionally between diversification and return enhancement. We want to generate attractive risk-adjusted returns, but to do so in a way that strengthens the overall portfolio rather than simply adding more risk. So one way to look at it is we're offering another building block for portfolio construction in a world where traditional building blocks are becoming less reliable. And we believe setting realistic expectations is critical. So what should investors expect? The strategy targets a return of approximately cash plus 4 to 6% through the cycle. So this should comfortably exceed inflation over time, and you're still maintaining a strong focus on capital preservation. And importantly, we're not seeking to maximize returns at any cost. The objective is to generate those returns with as little volatility as possible. So what it results in is an attractive risk-adjusted outcome and a compelling Sharpe ratio over time. And I did note what Johan mentioned about Sharpe ratios and vols in his previous presentation. Drawdown should be meaningfully lower than traditional growth assets as preserving capital becomes central to the investment process. This is achieved through diversification across multiple return drivers. So you've got active risk management, the ability to dynamically adjust exposures as market conditions evolve. The hedge fund structure gives us a broader toolkit. We've got leverage, we've got shorting, we've got derivatives. It allows us to access opportunities and manage risk more effectively than traditional long-only strategies. And then obviously, as with most hedge funds, the strategy is best evaluated over a 12 to 24-month period. So it allows for the various return streams and the portfolio construction decisions to work through a full market cycle. Which brings me to the world we find ourselves in, the old regime versus the new regime. The old regime or the post-GFC era. So that was when central banks suppressed volatility through QE. Inflation remained persistently low. Bonds and equities diversified each other quite reliably. And simply owning beta worked exceptionally well. So investors became conditioned to buy the dip. And then the pandemic came along. and the aftermath. And what was the aftermath? Massive fiscal and monetary stimulus, which changed the landscape. Inflation returned in a way many investors had not experienced for decades. Central banks were forced into the most aggressive hiking cycle in modern history. And for one of the first time in decades, both bonds and equity sold off together. So where are we today with these heightened geopolitical tensions? We see three key risks: increased inflation risks, uncertain monetary policy, and concentrated AI, which is a narrow base that's driving growth. And I see Johan did a great job at sharing, at painting the macro landscape, which is great. And we speak to that. We see exactly the same kind of risks coming through into the system. The question then becomes, how do you navigate that environment? And our answer comes from combining two very different perspectives. And the slide is really a reflection of my own investment journey. I spent the first 13 years of my career on the sell side in investment banking, learning how markets trade, and then the last 7 years on the buy side, learning how portfolios compound. And the edge comes from combining these two disciplines. The sell side teaches you how markets trade. You develop a deep understanding of liquidity, positioning, derivatives, market structure, and how prices move in the short term. And then the buy side teaches you how portfolios behave. The focus shifts to capital preservation, diversification, risk budgeting, and then ultimately client outcomes. So what I've found over the years is that some of the best opportunities sit at the intersection of those two perspectives. And then that brings me to the way of how we think about constructing a fixed income hedge fund portfolio. The first step is you establish, and this is how we think about it at Perpetua. So the first step is establishing a strong cash plus return base. This is the bread and butter of the portfolio and largely reflects the buy side mindset. So you're taking a step back, understanding the macro environment and positioning accordingly. Examples would be duration, curve, carry. Really, you're just taking it back to fixed income basics, which is coupon, carry, income generation. The second step is protecting and enhancing those returns. So this is where hedging, cash enhancement, active risk management comes into play. You cannot foresee the event. So you need to be able to put strategies into place to be prepared for any event. And the objective is to preserve capital and improve the quality of the return stream. So this is where we think the buy side and the sell side mentality effectively intersect. And then the final step is where the sell side perspective becomes particularly valuable, because now markets frequently overshoot, they become dislocated, they create temporary opportunities. We selectively exploit these dislocations, whether through volatility or tactical opportunities, and this is how we generate our incremental alpha. But importantly, this is not where we take the bulk of our risk. The core return engine remains the foundation, and the dislocations simply provide an additional source of return. So one of the questions we're often asked is, what environments are best and worst for a fixed income hedge fund strategy? And the answer is actually quite simple. We don't build a portfolio around a single macro outcome. Unlike a long-only strategy that may require falling rates or tightening spreads to perform well, our objective is to adapt as conditions evolve. Naturally, there are environments that create more opportunity than others, so periods of elevated volatility, market dislocations, policy uncertainty, changing macro regimes, they create a richer opportunity set as they emerge more frequently, especially in times like these. Stable carry environments can also be constructive because the portfolio benefits from its core return engine. So where returns may be more muted is probably during like strong one-way market rallies where almost everything moves in the same direction. Similarly, if you see sudden liquidity shocks, our focus will shift from return generation towards capital preservation and risk management. The important point here is that we're not trying to predict which regime comes next. We're trying to build a portfolio that can adapt as regimes change. I just want to go through some of the misconceptions around hedge funds. And one of the most common ones is that they're simply leveraged, high-risk strategies making aggressive macro bets. In reality, leverage, shorting, and derivatives are just tools. The value comes from how those tools are applied within a disciplined risk framework. For us, the objective isn't complexity for complexity's sake. It's about building these diversified return streams while managing the downside risk. So the ability to go both long and short allows us to seek opportunities in different market environments rather than relying on a single directional view. And I think part of the misunderstanding lies in the name itself. So when investors hear the word hedge fund, they often think leverage, complexity, risk. But the word hedge is actually the important part. The original purpose was to hedge against adverse outcomes, to reduce dependence on a single market direction, and to create a differentiated return stream. And this is precisely why we believe hedge funds deserve a place in every investor's portfolio, because the idea is to hedge against adverse outcomes. that a typical beta fund would not normally cater for. And who's the strategy for? The simple answer is almost any investor seeking diversification and resilience. So this isn't a replace for beta strategies. It's not a replacement for equity or bonds. It's a complementary building block designed to improve your portfolio outcomes. Whether you're a multi-asset fund, a retirement fund, family office, institutional allocator, the common objective is the same: generating attractive returns while reducing reliance on a single source of risk. But as with any investment strategy, it's equally important to understand the risk management framework, and whether it can withstand and adapt to these changing regimes. And this brings me to, very importantly, how we think about risk, which is why, while I've spoken a lot about flexibility and the broader toolkit that's available within a hedge fund structure, none of that matters with a robust risk framework. In many respects, we're actually risk managers first and portfolio managers second. And really, there's 5 steps on how we think about risk. The first step is defining risk before entering the position. So every investment idea is assessed through a risk-reward lens, the general target of at least 3-to-1 reward relative to risk. So if the downside materially outweighs the potential upside, we simply just don't do the trade. Secondly, risk must be measurable. So we utilize traditional portfolio risk metrics such as DV01, value at risk limits, to understand how the portfolio behaves under different market conditions. The objective is ensuring risk remains intentional rather than accidental. Third and fourth would be risk management is an ongoing process. Positions are actively monitored and controlled, stress tested, and reviewed on a daily basis. And finally, fifth, very, very important, adaptive. This is the most important part. So finally, risk management is not static. The ability to adapt exposures as opportunities and risk change is one of the greatest advantages of a hedge fund structure. We don't believe risk should simply be measured. We believe it should be actively managed. In some cases, you can actively harvest alpha from it as well. Ultimately, the purpose of all of this is not to eliminate the risk, it's to navigate it more effectively. And finally, if there's one message I'd leave with you today, it's that the traditional 60-40 framework was built for a very different world. A world characterized by falling inflation, abundant liquidity, predictable central banks, and stable correlations. And that framework served investors exceptionally well for decades. But today's environment looks very different. Inflation is less predictable, fiscal policy has become increasingly important, geopolitical risks are rising, and traditional correlations can no longer be taken for granted. So the old playbook isn't broken because equities and bonds don't work or no longer work. It's broken because investors need more than just equities and bonds. And we believe the future of portfolio construction actually lies in the ability to adapt exposures, exploit dislocations, and manage risk dynamically. The objective is not just simply to generate returns, it's building resilient portfolios for today's environment. And that's exactly where we believe fixed income hedge funds can play a meaningful role in investor portfolios. And I think that's me. Yeah. Thanks.
Thank you very much. That was excellent information, and hopefully we've got some time at the end to pick up a few questions on that. Thanks, Pooja. The next speaker is Andre Retief from Nexus, associated with Novare. We can see your slides. You are welcome to do your presentation. We move on from fixed income hedge funds to long-short equity now. Thank you, Andre.
Thanks, Pierre. Can you see my slide in full screen?
Yes, I can. Thank you.
Cool. Thanks, everyone, and thanks for the time to be here today. My name is Andre, and I'm presenting on behalf of Nexus today, and we manage a equity long-short hedge fund, which has been quite interesting year to date for us. I thought I'd kick it off in a different way to kind of just show you how we think about the world, what we do, and kind of how we take on short positions and long positions, what we've called and what we've missed, and we kind of the opportunities that would arise in the future. So just by kicking it off, we thought we have some 3 slides for you where we play a guess game. Most of you investors would know it, and I'll just leave you with 5 seconds to guess the stock on your own. But the first stock is a car company, and I hope all of you have it. It was all over the news, and you probably, if you rented a car, you have probably driven one before. But the first one is Avis Budget Group. Now, Avis, briefly 3x from the short levels, we did the stock at 275. And we have to tell you that when we got into this stock, we thought there was a lot of irrationality in the market. And we argue is once the retail market gets in, the US retail market, there's a flood of liquidity. And more often than not, we like to take the opposite trade of that. This slide showing you that we're not always, our timing is not always perfect. We shorted that at about 8th of April at about 275. And in the next 2 weeks, it 3x from that. So what I'm basically telling you, every night I drove home and the stock went up 50% per day, basically for the next 2 weeks, and almost cried myself to sleep. No, I'm just joking. It's part of the job. We also actually contacted the Security and Exchange Commission and said this is very irrational, where almost two investors owned via swaps and the spot market and the option market owned almost more than 100% of the stock. And this is one of the biggest short squeezes we've seen in the market. We decided to take the opposite trade. At the end of the day, it worked well for us. The next one is we can call it a semi or we can call it AI. But this is one everyone has been talking about for the last month. And if you guessed that right, that's memory prices on your left-hand side. We've just seen a massive boom over the last year in memory prices, and you've seen it in the stock prices like Sanders, Micron, and Samsung. Well done for all the managers who had big positions in that. We actually did not have big positions in that going into the memory. We only most recently added a little bit to one or two of these positions, as we still think there's some way to go. The last index we have here is in the metals space, and if you followed the Iran war, you would know that this metal probably goes in most of the defense stocks, and this would be tungsten. So tungsten is a critical mineral used by the United States government in basically all of the defense, in their rockets, in the hardware. So we think, and we know that as the Iran war actually goes on, there's just an increased demand for that, and obviously tungsten goes in semiconductors. So the reason why I'm showing you these three graphs is we've shorted one, we've longed one, we were late in the one we've longed, we shorted one, we made money, and the tungsten one we've completely missed. But the nice thing with an equity long short fund is we are starting to think of where we can take the opposite trade, where there's irrationality in the market. We think something like a tungsten, we understand that the prices has to go up, but we think that you're near a peak where you have to take the opposite view and short this. So what we're saying is if we're only a long manager, we've missed this and we're completely sitting out. But as a long short manager, we have the opportunity, if it arises, to actually make money from it again. Just moving on, we think that AI contribution to growth has been astonishing. We think that you're missing out if you're investing in AI. If you're not investing in AI at the moment, we think that the US market, a large part of it has been driven by AI, and we want to be in those markets, but we don't want to be irrational. We want to have a rational type of exposure that makes sense for us. If this turns around, we still know our investors are fine. And then just moving on, EM is still consensus for us. We feel South Africa, as most investors know, that South Africa has been hit quite hard year to date on the retail, especially the Dis-Chems, the Clicks, the Pepkors, those stocks have been completely carried out. But we still think that there's opportunities once the war has kind of died down. We see there's some escalation this morning again. We do think we'll get a kind of consensus on the war probably in the next month or so. We actually hope more so. We think once that is done, you'll see precious metals picking up, and on the right hand, you'll see that there hasn't been that large cuts to earnings revisions in EM. So we still think you find there. We just cautious investors always when we say EM. Yeah, investors need to know that three stocks make up almost 50% of the EM index. That's Taiwan Semiconductor, SK Hynix, and I forgot now the last one, but it's about three stocks. So almost a third of your price movement plays out through three stocks, which we think is risky if you're looking for diversification. We think you need to understand the markets a bit more than just taking a broad view there. And then moving on, we ask ourselves always is two questions. One, if we're negative, are we at peak negativity? And the second one, is this bullishness justified? So where we used to debate was in the lows of the war. We always need to ask ourselves is if we are negative, or how far are we from the market actually turning around? And then just on this question, we actually think that this growth has been justified in the US. You saw a quarterly growth of about 20% plus in earnings, which we think is amazing, driven by technology. We still think there's some leeway there, but we think investors need to be cautioned. On the left-hand side, we see that there's a lot of fund managers piling into equity. We're seeing a lot of allocations moving into equity, but we still see that the systematic fund still has some cash on the side. Just on a brief outlook before we go to questions, we think that we expect EM to struggle if bond yields continue to rise. We think the dollar may strengthen in the short term. We do use oil as a hedge against escalation. We are nimble around this. We believe oil would be a lot lower in the next year as the Strait opened. We're reducing AI exposure, even though I told you we like it, we're still reducing it to a more sustainable level, which we think in a year from now or maybe even closer as demand from the hyperscale starts dying down. We think you can probably have a problem there. We're reducing our US 10-year short. We had a US 10-year short just to reduce risk on the portfolio. We always thought as inflation escalates, we thought that the dollar would strengthen as the US 10-year yield would go up. That worked well for us, but reducing that position. And we expect precious metals to make a comeback once the dollar has weakened and this war is done. And as we end all of our presentations, we always say, remember, don't be negative for too long. That even though we're an equity long short, that we are believers of a long market in the long term, a bullish market in the long term. And we think the most important thing about our fund is we are opportunity fund, and we are never forced to short. We short where it makes sense. The latest short we've done this week was on Virgin Galactic. Most of you would probably have seen it, but it's an interesting look if you haven't. Virgin Galactic has been pumped by the retail market due to the ticker being the closest to the SpaceX ticker that's coming out in the middle of June, and the retail market said that they believe that a lot of people are going to get the SpaceX ticker wrong and accidentally buy Virgin Galactic. And due to that, Virgin Galactic price probably 4x. So we've shorted that. We made some good money this week, but we always control, when it comes to the retail market, we always control our shorts there versus the retail market, because you never know how long. There's a saying that the market can stay longer irrational than you can stay liquid. But yeah, thanks for that. Just in summary, we are a medium vol fund. Yeah, I assume we'll get to the questions now. We are a medium vol fund. We are opportunity fund. We like taking active positions. We have a lot of positions in the fund between 3 or 4%. It's predominantly local with a 45% offshore allowance. We prefer our offshore allowance at the moment. We think earnings growth is magnificent in the offshore. We like Japan as well. And we like certain rare earth opportunities as well where momentum presents itself. Thank you.
Thanks, Andre, and thanks to the other speakers. We've got a bit of time for some questions. I think, Andre, let me start with 1 or 2 questions for you, given that you're online. And just zoning in on your strategy a bit more in terms of the expectations that investors should have. You covered a bit of it at the end, but just in terms of if one view the product maybe as a equity substitute to a degree in an overall multi-asset portfolio, what what degree of net long exposure, for example, should investors expect? You did say it's a medium kind of volatility fund, but just talk a bit more about the level of aggression of the fund.
Yeah, thanks, Pierre. So the VAR, which is basically just a substitute for risk, is at about 7%, which is not a lot for hedge funds. And the net exposure in the fund is about 97%. We do have some very nice derivative structures in terms of Richmond. If it doesn't move, which is low vol structures, if it doesn't move between a certain 20% upside and a 20% downside, we eat the premiums from that. So we do diversify the portfolio, even though it's an equity portfolio, a long equity portfolio. We still like to harness premiums where we see there's a dislocation in the market. So we are not a leveraged, as Johan also said about their fund earlier, we are not a pure leverage long equity play. I mean, that's not us. We sit in the medium term bucket, even though we have some nice positions of about 3 and 4%, probably about 10 of those positions, 10, 12 of those positions, we like taking a view. We are also easy to cut that view if we think we're wrong or if the market moves against us. We'd rather take off early than sit longer and give us investors some drawdowns.
Thanks. And maybe picking up on that last thing that you mentioned and going back to that example of Avis, I just want to understand, can you maybe tell us a bit more about how you managed that situation while it was playing out from a risk management point of view? Because clearly you were short, and you, in theory, at least could have gotten carried out with a stock that moves against you, until it turns. How did you manage that at the time?
Yeah, Pierre, that is a great question. It's almost like Virgin Galactic as well. When we shorted it on Monday, it briefly went up 20% before yesterday it collapsed about 50%. So the management behind these retail stocks is you need to manage your weight in that. So I can give you an exact figure on Virgin Galactic. We wouldn't do more than 1%. Especially when we start, we would start most likely at a 75 bips and up our position from there. And the same is with the Avis. So the managing behind that is twofold: is your stock position, your initial stock position, and your emotions. Because sometimes as that stock moves up, even if it's a small position, you see a mark-to-market movement, and especially we as humans say, let me rather get out. But there's a fine line where if you're very convicted in the trade, you need to sit through it if your risk sizing is correct. I mean, obviously, if your risk sizing is incorrect, you're mentally gonna lose the game. You're gonna sell out, and you're gonna realize that loss on your portfolio. So for us, it's twofold. For us, like I said, it's position sizing and the mentality behind that. Sitting mentally through it, we believe, is the toughest thing on some of these trades.
Thanks for that. I want to move back to Johan. If you can maybe switch your camera on again or come back online. Maybe Pooja as well, we can direct a question to you. But Johan, I just want to, again, sticking with the point of risk management on the funds, go back to your mention of the stop losses, which is fairly unique, I suppose, the way you applied in your process. And I just want to check the understanding. Does that apply at the individual position or instrument level and at the overall portfolio level? Maybe just clarify how those stop losses work exactly or are applied.
Oh, I was hoping that you'll skip me with the Q&A.
No.
The stop losses, as in the mandate, is written on a portfolio level. So that is when all portfolio managers on the portfolio cleans the deck. When you get to the half risk level, that is a value at risk. So in other words, if your VAR is whatever 10%, you will reduce positions in a way that will get it, or a hedge that will get your VAR to half of that, to 5%. If you get to the clean the deck level, that's just all line items gone. You can reduce your VAR with various ways. So we have got models to stress test the portfolio. You could have hedges, overlays. There's many different ways of getting your VAR down. And then, okay, so that's on the mandate. So individual portfolio managers also have informal, let's call it stop loss levels. If you lose a certain amount, then you'll have a discussion in the team about your conviction level. You will dial down risks. It's not you get to a certain level and you suddenly bail. As we like to say, when my P&L is red, it means the market is screaming at me that I'm wrong. So, respect your P&L. If you're losing money, you're clearly missing something. And very often people get deer in the headlights. Something goes against them, they will sit come hell or high water. That is not us. We are very agile. If we're wrong, we cut. That is at a PM level. And then for each PM, they also watch stop losses on the individual positions. So if one of my colleagues, for example, has a certain trade on and it loses money day after day, the colleague who will get to a level where they'll say, okay, I've reached my preset stop loss level, I cut it. Even if I may have the offsetting position. So, your investment horizon per PM differs as well. So offsetting positions may be protecting the portfolio, but be structured in a different way, have a different time horizon. So it is, like I said, there's a certain mandated stop loss policy on the fund, but within the fund, if you look under the hood, there's a lot more dynamic risk management going on.
Thanks for that. Quick last question to Pooja. You spoke about the importance of capital protection in your process and strategy as well. I hope I didn't miss it, but can you maybe just give us a bit more specifics about the expectations that investors should have around that, specifically relating to, the degree of downside that the fund might experience, the VAR that you typically target, and so forth, something concrete?
Yes. Okay, Pierre. So just quickly, we are in the process of launching the hedge fund. So that's why I don't have like firm stats for you,
Yes.
but that should happen over the next 2 months. But just quickly, I'll give you a few examples of when I say capital protection, what do I mean by it? And we did this across our global balanced funds and our balanced funds as well. So one of the things we do is with our global balanced funds, the global fixed income exposure, we manage the currency risk with optionality. And how we manage that, it's not just hedging the risk with a sort of dollar rand forward, for instance. You're going and putting zero cost collars in place. But what people fail to realize is when you put these zero cost collars in place, you've got a zero cost collar. The reason you've got that is because the put, it requires a premium to enter into because you want protection against downside. And then you offset it against a call because you want to free up that put. But that put is not free yet. When the market starts moving in your favor, that put does start becoming free. So what you do is, as the market moves in your favor, that call, you've captured most of the premium on the call, so you unwind that call. But very important, what you've done is you've freed up the put and you've gotten positive gamma on your portfolio. And that is what every option strategy should ultimately aim to achieve. And these are kind of like the steps of process, because what happens when you've got positive gamma is that as markets rally in your favor or move in your favor, your exposure just increases. It's the best possible position to be in. And this is what I mean when I say not only, so when you entered into the strategy, you thought about, yes, you want to manage risk, you want to manage the currency risk, but now not only are you managing the currency risk, you're dynamically managing it. But not only are you doing that, you're actively harvesting alpha from it. And there's this 3-step process to this, and that's where I say that the sell side and buy side mentality sort of intersect, because you're not just thinking of how I'm going to hedge this risk, because the sell side comes into play and say, actually, no, I'm not just going to hedge this risk. I'm going to actively harvest alpha from this risk, and so that's one of the strategies we used quite successfully within our funds, and something that I'll probably use in the hedge funds as well.
Thank you very much for that. We've run out of time. Thank you to the panelists. It was a really great discussion, and I highly recommend that the viewers go through the slides in a lot of detail to get the information about your strategies. Thank you very much. Thanks for your time. Back to you, Eugene.
Thank you, Pierre, and exactly what you said. Very interesting discussion and a great format to get some good insight into the positioning and the workings of some of these funds being run by a lot of smart people. Right. Thank you all for joining. Johan, Pooja, Andre, really good insights and information you shared. And as Pierre mentioned as well, I think there's still a lot of information on those slides. So if you want to go through it, you're more than welcome. For our second hedge fund panel, we'll be looking at why hedge funds belong in retirement portfolios. And we are joined online by Gareth Montana from Corian Capital, Offrey Column from Visio Fund Management, Wessel Hubert from Oystercatcher, and Kobus Potgieter from Southern Cross Capital. A really busy panel, but here to moderate the panel is none other than Rob Ensign from Strategic Capital. Rob, we've had you on many of these panels as well, so thank you so much for joining us this morning still, and looking forward to your discussion. I will hand over to you.
Yes, thanks very much, Eugene, and absolutely agree, busy panel ahead of us. But for everyone that has joined this call, a warm welcome to each of you. For those of you who listened to Pierre's panel, I think he did an excellent job, and the panelists, in framing hedge funds within a broader portfolio context. In this session, we're going to get a little bit more focused and narrow it down and look specifically at the role hedge funds can play in retirement portfolios. I think at the heart of the discussion is the simple question: why should hedge funds belong in retirement portfolios? The starting point is an important one in that it is well documented that many South Africans are retiring with insufficient capital to sustain their income needs. I think we also know that clients starting to draw more than around 5% of their capital at inception of retirement risk, increase the risk of running out of money significantly. So today, what we want to explore is whether hedge funds can improve the odds for retired clients. And more specifically, can hedge funds play the dual role of helping portfolios deliver inflation-beating returns over the long run, whilst at the same time providing better capital protection during market stress? To help us unpack this, as highlighted, I'd like to introduce our first speaker, Gareth from Corinne Capital. Gareth, over to you.
Thank you very much, Rom, and thanks Fundrock for having us and again highlighting and showcasing hedge funds. Rob, is the presentation up?
Yeah, we all good.
Great. So I think importantly, we'd like to take you back in time. The year was 2001, an important year as this was the birth of our business, although the name Corian would only really come to light about a decade or so later after a management buyout. But importantly, our business was set up to provide solutions to institutional clients on this, emerging industry in South Africa, the hedge fund industry. We had a handful of managers, and the institutional money was starting to take note, differentiated strategies and the promise of differentiated return profiles, and capital started flowing. I think it's important to go back to what attracted all of us to the hedge fund industry in the first place. And I think there's a few basic premises which should still hold true today. But back in 2001, the promise was really about agility. The promise was about looking for under-researched ideas in sometimes inefficient markets, whether it be specific companies or it's different sectors. But the ability to go and move money where you weren't constrained by large assets, to move into spaces and really explore small caps or less liquid counters, and to be able to profit from that. I think the next element, importantly, was discovering new investment strategies. And this was the first time that short selling really, which had only previously been in the domain of prop desks on banks, started coming towards the retail market and the broader institutional market. The ability to hedge portfolios, and in some instances, even being able to profit if markets are falling. We also had gearing coming in, and gearing brought a different element too, where you didn't have to have exposure to the broader market, but rather concentrated ideas and using leverage to enhance returns and also at the same time hedge out some of that market risk. And probably something that isn't spoken enough about is unconstrained mandates. Being able to have mandates which in certain instances could be very dialed in or very specific, but just not being bound by your traditional long-only asset markets and directions. So this really gave us the ability for clients to invest into solutions and into portfolios that our return profile wasn't dictated by the direction of capital markets only. And I suppose none of this could really have been possible without these managers, really the mavericks and the genesis of our industry, some senior investment professionals who backed themselves, who saw the opportunity, potentially recognized how good their stock picking capabilities was, and who had an entrepreneurial spirit to leave banks, these institutions, to start hedge funds, to start looking at this opportunity set, but more importantly, to actually participate alongside our client money through performance fees. The only problem was the investment vehicle was pretty clunky. We were at that stage, I think a lot of allocators spent too much time worrying about the investment vehicle than the investment strategy itself. There was the likes of variable rate debenture structures and on-common D partnerships that were housing these differentiated strategies. But it was only much later where we've moved to one of the most formidable regulatory environments for hedge funds in the world. But back in that day, it was a big challenge, and I think a lot more time would have rather been spent exploring investment strategies than worrying about counterparty risk or the investment structure itself. So fast forward to where we are today, and I'm sure we're all acutely aware of how fast things are changing, and there's been a lot of evolution, and our hedge fund industry has evolved too. But with evolution, we do need to be mindful. Sometimes there are concerns, and what we do at Corian is to try and hold core to what we do from a day-to-day basis, and always remind ourselves of those key principles of why we initially invested, and just to be very aware that we don't want to make some of the mistakes that potentially could lead us back into uncorrelated solutions again. So one of the things that has really been great and off the back of formidable performance is the fact that the hedge fund industry has grown, and especially over the last 6 or 7 years. I think not too long ago, the hedge fund industry was struggling to break through the 50 billion rand mark. But where we are today is we are seeing that there's, a single fund that is managing, a single fund and strategy managing close to 30 billion, and a handful of funds getting you past that 50 billion alone. So when you're looking at the overall industry of, depending on double counting, etc., anywhere between 150 to 200 billion of assets, one of the things that does concern us is, do we have that same agility, the same ability to hunt in the under-researched, undercovered spaces of the market? It's something that we are mindful when picking managers that go into our solutions. And again, with that scale and with the asset size within the hedge fund industry comes the concern of correlation. One of your key benefits of why you want to bring hedge funds into a client's portfolio or into a multi-asset or balanced portfolio is to give that differentiation. We want to avoid correlation to equity markets, specifically, the higher risk capital markets, but just generally any of the more traditional asset classes. But at times you can see that there are funds, and these are some of larger funds that at times can be quite highly correlated to markets. And I think a lot of that stems from the scale of the assets within the hedge funds, but also the fact that a lot of our hedge fund managers have launched broader asset management businesses. The product line has increased. So it's more around now you're trying to shift around not only the hedge fund assets, but the long-only assets on the back of it. So it's something that we are really acutely aware of when bringing in different strategies. We need to make sure that that dependency and correlation isn't coming through in the funds that we invest in. And, one of the principles, and a lot is spoken about performance fees and the cost of hedge funds. As from a business at Corian perspective, we've always believed that performance fees are good because there is alignment of interest with our clients' money. That skin in the game is an important part. We want our hedge fund managers to be aligned to that performance. We want them to be rewarded should there be outperformance, especially when markets are difficult. And the other concern is we want them to be also focused on hedge. We want to make sure that they're designated hedge fund managers, people who are concentrating on hedge fund strategies. Unfortunately, when you have, a broader product line and long-only assets too, it can. We're not saying that it does, but it can also dilute the hedge fund strategies because suddenly you are moving around a lot bigger assets across multiple portfolios and can potentially change the shorting focus or the hedging capacity of hedge funds. But there's also benefits from scale. And I think one of the things that we've seen is a lot of the archaic fee models are largely out the window, performance fees from zeros. There needs to be appropriate hurdle rates and therefore reward our hedge fund managers appropriately when they do outperform relative to the risk that they're taking on. So where does this leave us? And I think importantly, starting with hedge fund regulation, hedge fund managers regulated in their own right, but also a great regulatory structure in the form of CISs. So, we don't believe there needs to be any form of reinvention, but rather restoring and making sure that our model still exists today. That model that attracted us right in the beginning, the key attributes which make up and why we believe they should be part of clients' portfolios. And really in our solutions, we focus on making sure low levels of correlation. We want true diversification coming through in the market. A lot of that can only be achieved as long as we keep that agility, as long as we, as hedge fund managers in the industry, are making sure we're sourcing returns in differentiated places, that agility to move around markets, whether it be looking for new opportunities or the ability to reduce exposures during times of strife in the market, being nimble is a key criteria. And alignment of interest, we still look for. Performance fees, the nature of hedge funds, they should have less assets. It's more of a highly skilled solution. Performance fees, we believe, are appropriate, but there needs to be that, make sure that there is alignment with those performance fees with the outcome for our clients. So, what does it look like and what do the solutions look like? So we've got first of all, what we're looking at here is Corian Absolute, which was the genesis of our business. Started, in October this year is our 25th anniversary of this fund. And we're proud to show that we've got low dependency on the direction of equity specifically and bonds. This is a more conservative hedge fund, so you would expect it to have a lower dependency. But even if we look at a higher risk hedge fund in the form of Corian multi-strategy, the betas to the major capital markets are constrained. It's something that you look for. But you don't want to have a solution that is not correlated or not dependent and it doesn't deliver in terms of performance. So what does it look like and what does it translate to? And this really is the slide for us that tells us that, first of all, South Africa's got remarkable hedge fund managers. But if you look at the risk return profile of the solutions that we offer, which is a package of underlying investment hedge fund managers, what we are comparing ourselves to here is the South African ASISA multi-asset income in light gray, your low equity category average, and your high equity category average. And it is irrefutable proof that if you're looking at these risk return characteristics, that not only are we delivering returns that are very pleasing, but we're doing it at much lower risk than you would expect from your traditional multi-asset solutions. And because of that less dependency on markets, you're not only getting the lower betas, but you're getting reduced volatility, which provides a dampener and a more predictable return profile to clients' portfolios. So where we are right now is concerning. I think what we are all faced with is an ever narrowing return drivers driving our client portfolios. Hedge funds can give you that differentiation, give you that diversification. We're not here to replace traditional assets, but rather augment them and to deliver a more predictable return profile. And that's it for me for now, Rob.
Thank you very much, Gareth. I think we'll move on to our next speaker, who we Ofri, over to you.
Cool. So I thought at the beginning we'll actually take a bit of a step back and look at the trends in the market. The first trend that we are seeing is around passive. Passives have been really good for investors. I mean, it's been a low-cost way to get exposure to the market, and performance has been amazing. So I think it's fair to say that a lot of active managers have struggled to keep up with index performances. But we're kind of at a point now where the passive AUM is actually bigger than the active fund AUM. And that has a few implications. One of them is that you're seeing outflows out of the active managers who are becoming forced sellers in the market. And then they are going into these passive funds, which would go and buy pretty much, the same list of stocks, pretty concentrated around the S&P 500 and, like some of those big indices. And that is causing quite a bit of concentration in the market. Also, when the passives are going out and they're buying, they're not really price sensitive. So, you get a portfolio and you go and you buy all of those shares. Now, what's actually been happening over time is that you're getting quite a big discrepancy between the valuations of things that are in these big indices, like the S&P 500, and everything that's not in there. And it's not just like a US phenomenon. You would actually see it in emerging markets. So, you know, a lot of passives are actually going into the US, and countries like emerging markets, just like South Africa and China, are actually on pretty attractive valuations. The second thing that we see is around retail investors. In the US, the retail share of daily trading is actually now bigger than any of the big banks, and it's bigger than any of the hedge funds. And the impact of that is that you're actually seeing the market trading a lot more around momentum. So, you know, things start going up, more people are starting to chase it, and it kind of increases the volatility of everything. Everything just keeps, once it starts moving, it's moving a lot. And one of the underlying problems with this is that some of this is funded with leverage. So it exacerbates the move. So as you're moving up, things are moving up quite a lot. But at some point when this thing turns and you have to close out positions, when you start getting margin calls, then that volatility is really going to spike. That's when you're going to see this kind of party end. So where do the hedge funds fit in? Hedge funds can generate returns in areas outside of these trends. So, you know, we're not dependent on the increasing concentration or momentum, for example. Hedge funds can, in a portfolio, it can be a bit of a stabilizer because it has lower correlations to a lot of these asset classes. But also the aim of the hedge funds, especially, you know, when you look at some of the South African hedge funds, we aim to deliver equity-like returns over time. So we won't keep up with the market all the time, but over a period of time where we're going to be equity-like returns, but with materially lower drawdowns and lower correlation. So if we show that here you can see on the left-hand side during the bull month, when the Aussie is returning 3.6% on average, when the Aussie is up, our hedge funds would only be returning about 1.6. But when you're looking at the bear month, when the Aussie is down, on average, it's down 3.2% in a month, the hedge fund is roughly flat. Now, that doesn't mean that the hedge funds are not down at any point. Like they do have drawdowns, and they do have, but they're not necessarily correlated and don't happen at the same time as when the wider market is down. That's part of that's why they're like kind of uncorrelated in that sense. And then the average return per month, this is since November 2006. The retail hedge fund returned 1.1% versus the Aussie on an average per month of 1%. Here you can see the correlations of the fund over time. It averages just under 0.4. It does go up and down, but on average, it's pretty uncorrelated. So just kind of like summing it up, you know, hedge funds have the opportunity to play where the returns are. We're not 95% invested, and you have to be involved. We have flexibility, and we can play across different asset classes. For example, like, you know, during the financial crisis or during COVID, we found a lot of distressed debt, bonds, and they give you equity-like return with much lower risk. So you have that kind of flexibility. You also have the flexibility to reduce your total equity exposure in those times. Hedge funds are not benchmark cognizant. We look for absolute returns, best ideas, pretty concentrated, and across asset classes, and it is fundamental based. So we are bottom up. We do have a very good fixed income team that helps us with the macro overlays on top of that. That's our overview. And if we have just a quick look at the track record of the 20 years, the one thing I would just point out here on the table on the bottom right-hand side is the Sharpe ratio. You can see the Sharpe ratio of 0.8 versus the Aussie at 0.3. And quite the important part, the deepest drawdown of 12% for the funds versus 40% for the Aussie. That's it. Thank you.
Thank you very much, Offrey. I appreciate that. And we are running perfectly on time. So I'm going to move over to our next speaker, Wessel from Oystercatcher. Wessel, over to you.
Hi, Robert. Let me quickly see if I can share. Okay. Is that it?
There we go. If maybe you can just put it in full screen mode.
I think it should be.
There we go. Right. I think we're good to go.
Yeah. So maybe I'm from Oystercatcher Investments. We run a couple of different hedge funds. Our flagship product is a long-short hedge fund. And contrary to a lot of other hedge funds in South Africa, we run a very aggressive strategy. So we've got a all-share index benchmark, and we try and outperform the all-share index by 10% per annum. And you're more than welcome to go look at the fact sheet for performance over the past couple of years. The only thing to note is we aren't that concerned about downside volatility. For us, volatility is second to performance, and performance is the number one thing that we target. So I won't specifically talk about anything hedge fund related today, but we have had a lot of questions from investors on how do you play AI when you are a South African focused fund? So I thought I'd give a brief overview of AI and what's been happening in the markets, and then how you can get kind of exposure to that in South Africa and how we do it from our side. So maybe just to start off is what's happening in the global AI stack. I broke it very simply into three different categories. You've got your pick and shovel, effectively, suppliers, your silicon and equipment. Then you've got your hyperscalers, and then some, call it third derivative beneficiaries of that, or ancillary companies, power and robotics companies. This list is a lot longer than the ones I've got up here, but just to give you a brief overview, NVIDIA, SK Hynix, and Samsung all produce chips or RAM that goes directly into producing large language models, or does a lot of the hard work. And TSMC and ASML are big suppliers into these players. And then you have your hyperscalers, who effectively use a lot of the hardware coming from the silicon and equipment guys to deliver the services to the market, i.e. us and the corporates at the end of the day. Us with our ChatGPT and Claude. And they also on-sell additional capacity to some of the other players. And then you have the, I would call them, and this is where South Africa sits, the ancillary players, like Constellation Energy. Building data centers consume quite a lot of energy. So they've picked up quite a lot of work from Google and Microsoft and Amazon and the likes. And then other players like Tesla, where all of a sudden autonomous driving and building robots that can think for themselves become a lot more attractive and a much bigger possibility. Then where does the money flow out of all of this? To simplify it, I broke it into three waves. As I think we all know by now, you've seen the first wave generating most of the returns, the NVIDIAs, the SK Hynixes, the Samsungs. And that's in the hardware. Everybody's been increasing CapEx in anticipation of a massive AI ramp up. And that has gone into chips and processing. Initially, we saw NVIDIA taking the most of that. More recently, we've seen the bottlenecks in memory and storage, i.e. SK Hynix and Samsung, taking the brunt of the returns there. And then somewhat to a lesser extent, we've seen this chip equipment, the data center build out, copper and platinum that goes into energy and hardware storage. And then, as I mentioned, nuclear or power and nuclear, and then which we haven't really seen come to market, but there are in the, I suppose, in the, we will see two potential large language model companies coming to market before end of the year. And then cloud services, where Amazon and Google and the likes have benefited quite nicely of. The second wave, and that's kind of your first derivative, the most direct impact. And the second impact is your advertising, the guys who actually use a lot of these services to enhance their own products. And that sits, a large portion of that sits in advertising. We've seen that from Google and Facebook specifically, or Meta and Tencent. They've been able to more directly target specific clients with specific ads, which means you as an advertiser spend a little bit less to get to the exact right client, which means that spend is worth a little bit more to you. Your ROI is better, which means they can charge a little bit more for it. They've been the biggest beneficiaries of actually applying AI, I think. And then search and recommendations. I'm sure we've all used ChatGPT, and you would have seen on Google search, they have an AI search functionality that enhances the service to their clients a lot more. And then robotics, as I mentioned, Tesla and consumer-facing AI agents. I'm pretty sure all of us have now dealt with some of these. Sometimes you don't even realize it anymore. And then the third wave, which I think is where the largest benefit for South Africa comes from, is the cost out. And these are the companies that have a lot of longer term ambitions to use AI to make their businesses more efficient. It should filter through more to margins and less so to revenue in the South African case. And then just to give you a rough idea, in the early stages of ramp up in AI, most of that spend had to go through data centers. They had to go through NVIDIA. That has really gone through their revenue line item. It will be less so going forward, but this is just to give you an estimated idea of the spend, the magnitude of the spend that's been happening. NVIDIA's revenues increased 16-fold since 2022, and most of that has gone into data centers. Then there are some less obvious stories, pitfalls that I suppose we're very, very aware of. As you can think, originally the AI spend went, it's going to make everybody a lot more efficient, and a lot of people are going to lose their jobs and so on. And that is the belief so far. But what we've seen, initially, it has done that to a certain extent, but it's had more negative effects on a lot of companies and a lot of industries. The first, I think, and the biggest initial thought was that software as a service would disappear. If you think about it, originally it took you a couple of years to roll out a software product and a very, very big team of programmers. Today, you can do it with a very small team of programmers and a couple of months, if not a couple of weeks, to roll out similar services. Mark Zuckerberg made the comment that they believe that by the end of 2026, you might find that they won't have anybody coding anymore internally. It will all be done by machine. We do think that's a little bit ambitious, but it does definitely reduce the moat to any business that had a software platform as a competitive advantage. Then, contrary to, I think, what everybody originally thought AI is going to do, everybody originally thought we're going to have this massive increase in efficiency. And initial studies from Meta actually showed that even though the programmers thought they were being more productive, in reality, they were actually less productive. And what often happens with these things is that people think it feels like you're doing it a lot quicker and it feels like it's a lot easier, but they tend to spend a lot more time doing other stuff that's unnecessary. The more time you have, the more time you have to waste. So it is something that we are very cognizant of and that you have to keep an eye out for. There are some clear, tangible benefits. Designing and engineering is definitely a big beneficiary of that. We've seen it in China. Their military development has accelerated significantly, specifically in bearing design. It sounds very mundane, but they have reduced the times there by about 80% of what it takes them. And they've built that model around bearing design, but it will filter through to structural design in tanks and structural design in boats, and it will vastly reduce the time to actually manufacture a lot of things. And then I think one of the biggest things we are a little bit concerned on for a lot of the South African businesses specifically is how AI has changed the fraud landscape. Now, you know, South Africa has about 30% of the index is financial services. That is most at risk of this, we think. And that is filtered through to things like phishing. I'm sure we've all seen the Nigerian prince SMSs coming through over the past 20, 30 years. That has now reduced, and it has gotten into much more sophisticated phishing emails. We've also seen voice clones. It takes about 30 seconds or a 30-second voice note or a voice recording to clone somebody's voice, i.e. pretty soon you might find a phone call from your son or daughter to just please transfer some money into a friend of theirs account. The bank, for some reason, their bank account isn't working. Quick to do, they gave you the call, right? And it's a quick transfer and the money's gone. And then deepfake videos. I've got a slide or example on the next slide of that. And then insurance repricing. So that is the big price impact that we've seen. But your cyber security insurance costs are skyrocketing because of these effects. So back in 2024, end of 2024, just as AI started taking leaps and bounds, we saw a company, Arup. They are an engineering firm, much similar to WBO in South Africa. One of the senior finance employees jumped onto a call with his CFO and other senior colleagues, and they made a quick decision to transfer money to a supplier. While they were all on the call, it got approved, and $25 million disappeared out of their bank account. And it was only discovered a few days later, after the employee realized that the people on the call weren't his colleagues. They looked the same, they sounded the same, but they were all deep fakes. And we expect this to increase significantly. I mean, the only better place it seems to be than NVIDIA and SK Hynix at this point is the fraud market in the US. How do you take hold of that in South Africa? Now, 6 of the ways that we found doing it, or some of the opportunities that I think are a little bit bigger than others at this point in time, are some of our companies. The only problem is a lot of our companies, Naspers Process through their holdings in Tencent, sit in that second wave. The rest of the companies mostly sit towards that third wave. So first of all, you've got Naspers and Process, and I've mentioned they have most of their holdings through Tencent. Tencent only yesterday came out saying that within their infrastructure, they are building AI agents, a Claw infrastructure. We've known about this a while back. We were a little bit surprised that the market only picked up on it after the FT article yesterday. But they have been seen as one of the biggest AI laggards in the market, hence the big pressure on the Naspers Process / Tencent share price. But yesterday, with the announcement that they will release a Claw agent is effectively similar to ChatGPT, but you can ask it to book tickets for you to Cape Town. You can give it your credit card details and it can go ahead and act as a true assistant. That within the closed ecosystem in Tencent might be quite valuable. Then we've seen other beneficiaries, like the likes of Capitec as an example. They have their models, as you can imagine. They group people according to income and default risk. With AI, you can make those models a lot more targeted. Credit losses or credit risk on a unsecured book run as high as 15% quite easily. You can imagine if you can bring that down by just 1% or 2% by having a lot more targeted model and a specific model to a specific person, it means quite a lot of upside to your bottom line. They also have a very big staff complement, call centers and the likes, and we think call centers are one of the biggest beneficiaries of AI or agentic agents in the near future. You can cut that workforce down quite a bit. Then Optasia is very similar to Capitec in terms of they run micro lending models across Africa. They get the similar benefits from AI, but I also think they have been it's a very young company. They've been able to build up this business with a lot of automation, more machine learning than AI, but AI should further enhance this. But it's a proper sized company run by about 300 people. And they're all mostly programmers. So you can imagine the cost benefits that they will have going forward. Then we have our copper mines. Glencore, you can imagine, will have the biggest field day there. We've seen it reflected in the copper price more recently, which has gone up. But obviously demand for energy is increasing. That's not only on the AI side, but also on renewables. It's just been further enhanced by the AI side. And the demand for copper that goes into data centers and so on is increasing exponentially. And it's very difficult to see solutions for that in the near term because it does take you about 20 years from planning a mine to actually getting copper from that specific mine. Then we have Bytes Technologies, and Data Tech falls into the same category. They are on sellers of products that go into AI. So on the one hand, they've got servers and things that you hardware effectively that get sold to corporates who want to have in-house AI models. And then on the second side, on the Byte side, they do sell licensing for the likes of Microsoft, as an example. So you will have, if you've got a big corporate business, and you want everybody in your corporation to access your what do they call these? I forget the name, but their in-house AI model. Your licenses will get activated through Bytes, most likely if you're UK-based or SA-based, and they will get a revenue share on that. And then lastly, we were on a call with Bidcorp yesterday, and they just mentioned that there a lot of pieces in their business, like ordering, phoning in, speaking to your agent, ordering a new order of meat and croissants, will go through a human. There is a lot of scope for that to get automated, and you can use agentic AI to do that, which means your costs reduce by about 80%. That is our rough estimate of what the cost is of an agent doing it, AI agent doing it, versus a actual person doing it. Same goes for telemarketing. They've already seen benefits of that just from normal automation over the past couple of years. Yeah, and that is me. So, I mean, the last quote I can leave you with is, there's always a revolution. There's always an obvious trade in a revolution. And then once the obvious trade is a little bit crowded, everybody goes to the biggest beneficiaries of that in the end. AI will be the same.
Fantastic. Thank you very much, Wessel. I think that leads us to our final speaker of the day, at least, but not certainly Cobus. Looking forward to hearing your views. So I'm going to hand over to you.
Perfect. Thank you, Rob. Okay, I assume everyone can see.
Yes, all good to go.
Okay. The brief I received from Fundrock was to be informative, not to market. So I won't be spending too much time on our fund per se, but focusing on the type of opportunity that a hedge fund and our fund in particular can uniquely exploit as a diversifier, both amongst hedge funds, but also relative to traditional asset classes, which is the brief I received from Rob. So convoluted holding structures and Taylor Swift. Briefly, Southern Cross. What makes us unique within the hedge fund space is really our expertise in corporate structure and corporate action arbitrage, equity arbitrage, as we call them together. This essentially means that we have a deep understanding of corporate structures as well as the corporate action process, coming from that background, and a focus on electronic and algorithmic order management. Very important in terms of doing a lot of the heavy lifting for the type of trades that we specialize in, and essentially combining these expertise into a systematic equity arbitrage process. And this forms the core of both of our hedge funds, both the market neutral fund, which is a purer expression of this equity arbitrage process, as well as the multi-strat fund, which essentially combines this process with directional equity and fixed income exposure to produce a riskier but still well protected and attractive return series. So just to briefly mention the categories here, we have corporate structure arbitrage. That's really the bread and butter. Probably 70-80% of our activity is corporate structure arbitrage, and that's what I'll be an example of such I'll be focusing on today. Then within the corporate action space, that's essentially any kind of a takeout, restructure, unbundling any type of secondary offering that a company is doing that allows us more than one entry point to exploit in a market neutral fashion relative to one another, or perhaps simply just mispriced because of that action. And finally, convertible bond arbitrage. So our case study today is Vivendi. This is the Fundrock Global Conference. So I thought let's give it an international flavor. This chap on the left, Charles Napoleon Bonaparte, was the first elected president of the Second French Republic in 1948. The First French Republic was disestablished by Emperor Napoleon I, his uncle, heralding the First French Empire. To give you a bit of foreboding, essentially, I suppose these sorts of ambitions are genetic. And ultimately, President Louis Napoleon staged a coup against his own government in 1951. And a year later, 1952, installed himself as the Emperor, Napoleon III of the Second French Empire. This was during an era of rapid modernization of French industry and agriculture, which led to rapid, as you can imagine, urbanization. I suppose, the AI theme, there are some comparables here. So Vivendi was established as, and forgive my French, the Compagnie Générale d'Eau, which essentially means the General Water Company, by imperial decree in 1953 by said Napoleon III. The company was co-owned by a cohort of his family and friends, as well as some famous French financiers and private equity interests. Amongst them, a certain James de Rothschild, the founder of the French branch for the Rothschild family. Essentially, the company was founded to provide water and sanitation to the city of Lyon on a 50-year concession. But in time, given that it was well positioned, they managed to I suppose, win the tenders for cities like Paris, Venice, Nantes, Istanbul, and Porto. So even companies within cities within the spheres of influence of the French Empire, but perhaps not part of the French Empire at the time. By 1976, the company started diversifying under new leadership, and they expanded their investments into waste management, energy, transport, construction, property. They were a founding shareholder of Canal Plus, which was essentially Mnet, the first paid TV channel. It was incredibly successful in France. I don't know if they had Igorli to leverage like Mnet did, but it had 1 million paying subscribers within a year and would eventually grow into the enormous conglomerate that is Canal Plus today. They acquired Avas and some gaming assets, and eventually, born out of that, Blizzard was established. And they renamed themselves to Vivendi to reflect, the more diversified nature of the holdings that they now held. In the early 2000s, they acquired a Canadian holding company called Seagram, which was the holding company for Universal Studios and what would become in time Universal Studios as we know it today, as well as the Universal Music Group. In 2008, they merged Blizzard, essentially Vivendi Games, with Activision to create Activision Blizzard, to rival Electronic Arts and essentially compete against the other major studios. This would ultimately lead to the largest acquisition in history when Microsoft acquired that business. And just to roll back a second to 2002, in the wake of the .com bubble, and they had significant exposure there, the company became financially distressed and embarked on a simplification and restructure program, which essentially meant combining some of their businesses with others and unbundling those to shareholders. So there's a storied history here that I can't even get into, but the wealth that is created from this holding structure, similar to a Rembrandt becoming Remgro and Richmond and Reinet and all of the spin-offs, RMI, RMH, FirstRand, all of those underlying insurance businesses. A very similar story to Remgro we have here from Vivendi. Now, in 2015, Bolloré, a French holding company for a billionaire family, started acquiring shares in Vivendi somewhat sneakily because they had interests in some of those companies that Vivendi had interests in. So some would argue that they used this interest to exercise more control over the companies in which they had minority interests in a somewhat covert fashion. In the 10 years from 2015 to 2025, there were a series of further simplifications. This was still in the wake of the dot-com simplification. And they sold off a bunch of assets. They took on some hostile, some corporate raider type opportunities in the form of the game acquisitions, acquired shares in Ubisoft, and eventually sold them to the founders at a massive premium to get them out. That was quite hostile, not quite as successful in the other gaming interests, but a similar thesis essentially playing out. And of course, during this period, Canal Plus announced the acquisition of MultiChoice. So now it was turning into a very, very convoluted, almost holding company with significant discount to NAV. And in December of 2024, they announced the unbundling of a lot of these assets and the simplification of the structure. And essentially, that left us with 4 holding companies. We've got Canal Plus, which listed today on the JSE, the new holding company for MultiChoice. We've got Avas, we've got the Louis Hachette Group, and we have Vivendi for the remainder of the assets. And that's what I would like to focus on today. This is Vivendi's current net asset value. As you can see, 2/3 of it is locked up in Universal Music Group. They have sold off the Universal Studios component to NBC if you wanted to get exposure there, but they've retained UMG, and we're going to spend some time on UMG as well as the core asset inside of Vivendi. They've got Banny J as well. That's listed on the Amsterdam Euronext. They've got Media for Europe. That's a traditional media company, TV and radio, listed on the Borsa Italia. And as I mentioned, they still have some gaming, other investments, and significant cash holdings. And essentially, this is a very simple NAV structure. You'll notice this is far simpler than the likes of a Remgro, for instance, which creates for a market-neutral hedge fund a fantastic opportunity to exploit value, because I can enter the holding company at a discount and short out the underlying exposure and track that discount very, very tightly. This is UMG, the core asset. Now, it's the largest label in the world. And I wanted to get you Taylor Swift. They have an incomparable catalog of artists. And this includes all the new music. This is her new label. She famously moved away and re-recorded all of the music when allowed to get away from the owners of her original content, and that's where the Taylor's version album essentially came from, re-recording all of the old content as well as any new content. And she is by far the most streamed artist of all time. Second most streamed artist of all time is Drake, and all of these are in the top 10. Some of them I haven't listened to. I'm sure your children do. Billie Eilish, The Weeknd, Sabrina Carpenter. These are some of the most streamed artists in the world and of all time. And essentially, this is an incredibly attractive business that have managed to, call it in the post-record era, really monetize the IP that is music creation. Some concerns around AI, but I feel they've actually done incredibly well to navigate that. They, amongst other things, have licensing deals with all of the underlying platforms, the likes of YouTube, TikTok, and that includes for content creation. So they are essentially being paid license fees of when AI is used to create content from their catalog via platforms like TikTok. An incredibly attractive business. They have grown earnings per share by more than 100% since listing in 2021, as coming out of Vivendi. But for whatever reason, the share price has languished, and we'll get into We'll get into that reason in a second, because listing at a share price of 30, at a valuation of 39 forward, perhaps a little bit rich, but a company as quality as this, with such incredible earnings growth potential, as well as very, very defensive earnings, shouldn't be trading at a PE of 15. It's actually cheaper. I haven't updated the slide, but it's actually trading at an even cheaper multiple than what I'm showing here currently. But this is the type of business, sort of a core blue chip holding that you want in your portfolio, and it's trading at a PE of 15. What is going on here? And this brings us back to Vivendi. So post the separation into these four constituent components, some of the minority shareholders inside of the Vivendi structure, and you remember I mentioned Bolloré started acquiring shares within Vivendi in 2015. They had moved that up to an incredibly significant holding by 2024, and they also have significant holdings inside of UMG. So some of the minority shareholders essentially accused Bolloré of exercising effective control, and even though initially the courts did not side with the minority shareholders, the appeals court in July of last year did, and we saw this discount to NAV narrow massively from around 45% to around the 35% level. Of course, Bolloré not wanting to be forced into a situation where they have to make a mandatory offer to underlying shareholders ran to the Constitutional Court, which eventually sent it back to the Appeals Court on procedural grounds. This suppressed the UMG share price somewhat perversely, because the market assumed that Bolloré would have to liquidate a portion of its UMG holdings to finance the buyout of the Vivendi shareholders and retain their cheap entry point into UMG. Essentially, the market is betting on some sort of outcome where the discount becomes unlocked. Now, it's been kicked back to the appeals court, but in the first place, the state has taken the view that Bolloré is in violation. Pershing, the famous Bill Ackman, has in the meantime initiated a buyout offer, trying desperately to alleviate the situation and create the liquidity necessary for Bolloré to acquire those minority shares, but Bolloré has rejected this, maintaining they don't have effective control. And last week, one of the French publications published an internal email from a Bolloré employee to one of the regulators, essentially saying that we have de facto control over Vivendi back in 2017. And the market is again narrowing this discount off the back of that, UMG selling off and Vivendi narrowing. So now I've got two sets of opportunities I can exploit here. This noise is music to my ears as a market neutral manager. I can buy the underlying when it gets wide. I can sell. I can buy the shares, the holding when it gets wide. I can sell the underlying and bet on a narrowing of that discount. I'm sure you'll agree, given the mechanics here, 45 is incredibly attractive. And this is something I can exploit in a market neutral fashion. But in my multi-strat fund, where I take significant directional exposure, not only do I love UMG as a blue chip that is at a suppressed valuation, something that I expect to wash out over time, because Bolloré does have a history of creating value through their corporate actions and unlocking them over time, but they are long-term investors. They are not short. They don't have a short time horizon historically. So I want to hold that stock. I can buy it at a 15 multiple. Sounds incredibly attractive, and I expect the situation to come out on the wash. Or I can buy Vivendi and get it at an enormous discount plus all of the other Vivendi assets for free, betting on perhaps some sort of an outcome from this legal situation. So there's your long-only expression, your riskier expression, buying a quality asset, but not at a 15 multiple. Given the implied discount here, I'm buying it maybe on a 9 multiple forward, which is just ridiculously attractive. But from the market neutral perspective, I can continuously exploit the noise. I can be particularly active. I can go in and out and trying to exploit the noise within this discount itself in a market neutral and protected fashion, without being subjected to those enormous swings in the underlying share price.
Great, Chris. I'm going to stop you there because I think we've got 10 minutes left and we want to get into some panel discussions. So for my other panelists, can you guys just put your screens on and we can get straight into it? Before I kick off, just firstly, gents, thank you very much. I think super interesting presentations from all of you. And what came through quite strongly was the difference in styles and how hedge funds differ. So I think that's certainly a takeaway that the average South African retail investor has come to understand, that you've got certain camp of managers that are far more focused on protecting of capital. And then there's another school of thought that is on the enhancing return side of things. I think to kick things off, I'm going back from the future straight to the present. Gareth, obviously you made a strong point that hedge funds have come a long way and are now in the space of retail clients. If a retired investor allocated capital to your strategy, what portfolio challenge are you effectively helping them solve in your mind? Maybe can you unpack that for the audience a little bit?
Yeah, thanks, Rob. And I think it really speaks to going back to our core principles of why we like hedge funds and what we look for in managers. And quite simply, it's a diversification element. Especially approaching retirement, you need to, in our view, find different sources of returns. You also need to protect against what is, I mentioned it earlier, a very narrow market, and it's a global phenomenon with the AI stocks. But in South Africa, we've had it with the gold stocks. We've had it with Naspers and Tencent. And when you've got very specific return drivers dictating a big part of your portfolio, diversification in the traditional asset space is important, but we think hedge offers that extra edge. Having the ability to short and to dampen drawdowns, protects against the so-called sequencing risk. When people have got the ability, the need to draw income, but at the same time they still need capital growth, you can't just simply shift to low risk assets. So hedge funds gives still the ability to get meaningful returns, potentially not as much as you would get from traditional beta, but it gives you that protection. And that's why we think, not for just retirement portfolios, but all portfolios, that it plays a significant role.
Again, I would tend to agree with that. Cobus, I want to go straight back to you. As I said in my introduction, that not all hedge funds are the same, and you certainly, particularly when we talk about your market neutral strategy, we lean into capital protection there. You also touched on a uniqueness in terms of your merger arbitrage strategy. Can you just give us a sense how the strategy has behaved in drawdown markets? What can merger arbitrage bring to a portfolio that maybe the equity long only or fixed income side of the market can't?
Diversification and capital protection. I suppose it's that's an old chestnut when we talk about hedge funds, but it is some of the purest expressions of that diversification. And I must say, it's not only relative to the other asset classes, it's also within the category itself, where that really does diversify. And when you take low risk equity hedge funds, market neutral equity, essentially, you'll find that within the space, the names tend to be particularly uncorrelated as a category relative to others. So that not only do they combine incredibly well within an existing portfolio, and you can imagine when you're talking living annuity or discretionary, where income is being drawn from a portfolio, it's an amazing component to diversify against those drawdowns. And also in combination with other funds, you'll get even more. You'll get an even more protected profile, which will allow you to bring down your time horizon still further. But to answer your question more directly, the corporate structure opportunities in particular dislocate when there's blood in the streets. We've seen this becoming incredibly attractive during things like the financial crisis, the taper tantrum. COVID was one of the best periods for the fund. So in my market neutral in particular, that's sort of our our crisis fund, our long volatility fund, the fund that you expect to do well when there's blood on the streets. The multi-strat does similarly, because that is, of course, still a core part of that process, but that'll provide more relative downside protection, whereas the market neutral provides it in absolute terms, and in fact gives you a bit of that optionality on the chaos, generating additional alpha, additional opportunities to get into during those difficult markets.
Fantastic. If I wrote it down, there was a slide that definitely caught my attention. I think you labeled it Goal 1, Absolute Returns. Can we just touch on this again? What should investors realistically expect from your strategy in difficult markets? Is it more sort of smooth returns, downside protection, or just uncorrelated returns? Can you just give us a little bit of insight there?
Yeah. Yeah, in more difficult markets, the first thing you would expect is that the drawdown's not going to be as deep as it is for the market, and the bounce back, typically back to where you were, should be faster than what it would be for the market. The correlation, yeah, like during times of stress, I mean, correlations do tend to spike a bit more, but you wouldn't have that permanent loss of, well, you wouldn't have the loss of capital, you wouldn't have those drawdowns to begin with.
And I think that's an important point just to raise, in that a big function of a hedge fund is because they can dampen those drawdowns. You're often compounding off a shallower base, so your sort of return to where you started can be a lot quicker. So it's not always necessarily a function of sort of supercharged returns, but it's just the hard work that a hedge fund has to do is sometimes toned down compared to long-only portfolios that suffer big drawdowns. And to Gareth's point, in a living annuity or someone who's drawing capital, that sequence of return is just so important, particularly in the early years of retirement. I think I've got two quick questions, and then time will be unfortunately up. But Wessel, I think it's fair to say your flagship long short leans more into the enhancing side of the camp. In terms of what kind of environment would it not make sense to invest in your strategy and rather just focus on a long only Aussie portfolio?
Yeah, sure. So in theory, on our fund is, if you ask me what fund you would have to replace ours with, you rightly touched on it. It's a equity fund, effectively replacement. So in times when the markets run, we tend to outperform. And in times where the market goes down, we hopefully still outperform. But obviously, if the market's down 20, we are going to be very happy with a -10, as an example. So our kind of neutral is all share index. In theory, we should always outperform the all share index. We do have blips over rolling 12-month periods where that does not happen. We are in one of those periods, as an example. It's usually a very, very specific culmination of something that goes wrong. So we don't run big downside protection. You pay away insurance over the long term. So when events happen like the Iran war that comes out of nowhere, we usually take a bit of a knock on that. But in theory, over most periods, we should outperform the market, but we do have a lot more market volatility or market-related volatility than most other hedge funds. It just forms our flagship fund falls nicely into a hedge fund of funds where you have a lot of market neutral funds, but you don't want to fall too far behind when the market keeps on running. That's effectively where it falls a nice gap.
Right, thank you. Well, I think we are coming to the end of our time. Unfortunately, I wish we had another 20 minutes, but I think a takeaway from here is that hedge funds certainly can provide something different to a portfolio. They are not replacement strategies, but they're complementary strategies to a holistic portfolio. I would encourage you to get in contact with the various managers on this call, discuss what the use case is for hedge funds in a broader portfolio context, and certainly take them into consideration when you're constructing a portfolio for retirees who are drawing capital. So with that, I'm going to end it there, Eugene, and hand back to you. Thank you, gentlemen, for your time.
Rob, thank you so much, and a very strong panel indeed. And it was very interesting, and I tend to agree. It can definitely be a portfolio enhancer, and it does change the outcomes of the overall portfolio. We've tested that a few times as well. I see there is an open question from Dean for Kobus that we will send through to Kobus. If you could maybe respond to that for Dean as well. Interesting question, but unfortunately we couldn't get to all the questions. Thank you, Rob, Kobus, Vessel, Gareth, Offrey. Always good to have you on these sessions. And again, thank you for your time. We are moving on swiftly to our last hedge fund panel discussion. And joining us as moderator to the session is Chief Investment Officer Devonga Shivize at Apex Investment Consulting. Good afternoon, Tav. Thank you so much for joining us. I know this takes a lot of time from your busy schedule, so we're always grateful. Devonga will be joined by Jean-Pierre Verster from Protea Capital, James Corkin from Stein Capital, and MJ Dippenaar from Peartree. Good afternoon, gents. And again, from my side, thank you so much for your time this afternoon. We're really grateful. And I'll hand over to Tav. Thank you.
Thank you so much, Eugene, and thank you so much to all the panelists for joining me this afternoon. And again, thanks to the audience who've been with us pretty much since yesterday. I think my reference point, I think, for the discussion of today is maybe to go back again to a DFM, multi-manager asset consultant, and just have a basic look at how we construct portfolios. So if I maybe make this a little bit more specific to Apex Investments Consulting, South Africa, we're pretty much at a very simple level looking at 4 betas, being equity, bonds, property, and cash. And we're looking at those 4 betas across 4 geographical regions, being South Africa, emerging markets, developed markets, and mainland China. And where for the most part, we're just looking for positive exposure to those betas. And our understanding, as far as hedge funds are concerned, is you're giving us an opportunity to interact with the negative side of these betas across 4 geographical regions in general. So my understanding of this now is that in a year, for example, where one of those betas, let's just call it the JSE, is up 40%, if we have positive betas, which is what we are looking for in portfolio construction, that means that we are up by 40%. However, if we have negative beta, that means that we will be down by 40%. And if we have a hedge fund manager interacting with SA equities, as an example, their starting point is -40 because they're targeting the negative side of that beta. So if you give -40, you pretty much have matched the benchmark, and anything better than -40, you have sort of added value. That's a very simplistic point at which you're sort of trying to look at this. So I think I'm sort of engaging with you with that sort of understanding and sort of hoping that you would educate us and our portfolio construction on how to depart from that very simplistic point to the point where it is not as linear as I've probably positioned it. We obviously construct portfolios in 2 ways. The one is a specialist building block approach where we control all of those betas. And then the other is a multi-asset strategy where we outsource to balanced funds. In this particular case, if it's a specialist building block, JP and James, you would be the managers would allocate to. And if it's the multi-asset, MJ, you become the manager that would outsource to, and just leave all of this up to you. So starting off with this particular panel, I have JP focusing on long-short hedge funds, but in the global space. When I started the industry, JP, a lot of our debates was around, can a South African asset manager manage a global equity portfolio from South Africa? And now with this very extreme example I've given of in a year where a beta is up 40, your starting benchmark is -40. So anything of -40 and beta is better. You can imagine how much more scared we become if it's about hedge funds in the global space. So I'm hoping that throughout your presentation, you can maybe allay our fears to say, can a South African asset manager achieve better than that linear -40 in global markets from SA? Like, do we really have those skills? So I'll hand over to you, and then I'll come back in when you're done. Thank you so much.
Great. Thanks, Devonga. It's my pleasure to present at the Fundrock Global Investment Conference. And thank you for that introduction. As you correctly said, The key question that I will help to answer is, can South African hedge fund managers compete globally? And already hedge funds are quite a niche allocation in many portfolios, as the previous hedge fund panel also indicated. So now we are talking about a niche within a niche. We're saying that a hedge fund allocation is niche, but what about that hedge fund allocation, and what about a global allocation within the hedge fund allocation? And if you do decide to do that, should you appoint a global hedge fund manager, or should you consider a South African hedge fund manager? I would guess that a lot of participants in this conference are also not constrained by whatever mandates we typically have in South Africa, including Regulation 28 and including exchange controls, and might have carte blanche to really allocate money globally, and especially money that has been externalized already, into any opportunities, whether long-only funds or hedge funds. And the good news I have for those participants is that Protea Capital Management does have a product, a hedge fund which is domiciled in Malta, which they can consider. It takes investments in dollars, euros, and pounds. And that is a product that you can compare against other global hedge fund managers. And it's my job today to, within 10 minutes, tell you why you should consider a South African hedge fund manager when considering a global hedge fund allocation. So let's get into it. I'll take you through some different hedge fund strategies where South African hedge fund managers cannot compete, the South African edge, and then conclude. So I think the first point to make, and this is a point that I think the South African hedge fund industry tries to make every time we have the opportunity to present to investors, is that hedge fund strategies are not homogeneous. Different hedge funds do different things. Different hedge funds have got different risk profiles. Some are return enhancers, some are risk diversifiers, some focus on South Africa, some focus global. You get equity-focused hedge funds, fixed income-focused hedge funds, multi-strategy, even crypto hedge funds. So it is different in terms of the collection of funds. It's not one homogeneous type of fund. The second point to make is you also have different strategies when it comes to these hedge funds that can be categorized in two broad different approaches. The one being a trading strategy, and the second one being an investment strategy. And in South Africa, just about all the hedge funds are investment type strategies. Internationally, though, if you compare South African hedge funds and hedge fund managers to global ones, you will come across many trading strategies. And most of them are in high frequency trading or ones that do venue arbitrage. And those types of trading strategies don't look at the fundamentals of companies. And they don't invest with the multi-year investment horizon. They're all about, I'm buying something and I look at the microstructure of bid and offers in an exchange. I look at shares that are maybe listed across various exchanges, and I look to arbitrage that, and I look to arbitrage various instruments that might be referencing the same underlying. And in that way, I'm trying to make money from trading, not investing. So that's one differentiation between global and South African strategies. And I would say that South African managers would find it very tough to compete with global hedge fund trading strategies. Another point to make is the return enhancing versus risk diversifying. So again, if you're looking at hedge funds, you get the types that are less volatile than average, but try to give you above average returns. And in that way is a good risk adjusted return opportunity. Or you look at funds that say they look to get a better return, even taking similar risks in the market. And in that way, give you better risk adjusted returns. So just be aware of that, that you do invest in the type of hedge fund that you want in terms of your risk profile. Hedge funds are often perceived as risky, as cowboys, maybe offshore, but in South Africa, they are strictly regulated. They've been collective investment schemes now for more than 10 years. And the South African industry, I would say, leads the global hedge fund industry when it comes to the regulation of the hedge fund managers and the products, which is good news for investors who might be interested in hedge funds. So where can South African hedge funds not compete? The principal area is where proximity, speed, and compute are critical. And that's high frequency trading and venue arbitrage, like I mentioned. So if you think about Hedge funds like Renaissance Technologies, I mean, the most profitable fund ever, compound annual return of about 60% for more than 20 or 30 years, even better than Warren Buffett. I mean, Jim Simons passed away, I think it was last year. If you think about Jane Street, which is known as a market maker for ETFs and also has gone into algorithmic trading strategies. They were in the news because of the way they made money in India, arbitraging the cash equity market against the options market. And Citadel Securities, one of the two businesses owned by Ken Griffin, the one being Citadel, which is the hedge fund business, just Citadel, and the other one being the market maker, being Citadel Securities. Those types of funds, South African managers cannot compete against. Very quantitative. You need your own GPUs, you need your own data centers, you need to be close to venues. So South African managers cannot compete there. The other area where South African managers cannot compete is where you need access to elite networks to determine your access or the opportunity or to be successful. And there, the best example is private equity and venture capital. If you're not sitting in San Francisco and engaging with the likes of Anthropic and OpenAI, you're not going to get a pre-IPO allocation and you're not going to make money. It's about who you know. And South African managers cannot compete with that. Another area is where there isn't fair disclosure or equal access to information. In developed markets, like the US, for instance, you do have regulations that ensure fair disclosure, like Regulation FD in the US. That protects investors. Some frontier markets, a bit less so. In some frontier markets, if you know the families that normally control those types of economies, you're in the know. And if you don't, well, you are one of the last to know about transactions or whatever might be happening. So South Africans probably should think carefully about frontier markets where access to networks are very important. Some emerging markets you can still potentially take part in, and developed markets are relatively secure when it comes to equal access to information rather than unequal access to those that are very close to business people in those different countries. So far, where South Africans have also found it difficult to compete versus global hedge funds is in the marketing or distribution or even perception. So if you think about the equivalent story that happened to South African long-only managers, in the long-only side, as Thabang also mentioned, 10 or 20 years ago, people were saying, can South African long-only managers compete against global long-only managers? And hopefully in the last 20 years, South African managers have been able to answer that question. If you look at 91, if you look at Orbis, where there's South African founders, for instance, South African managers have shown that they can manage money when it comes to global long-only. And now the challenge is for South African hedge fund managers to also prove that they can manage long-short money in global markets and be on a comparative footing to their global counterparts. So where do South Africans potentially have an edge when it comes to the global hedge fund industry? The world is becoming more like South Africa. So if you look at political instability, labor ructions, FX volatility, higher interest rates, higher inflation, these things that a lot of people in developed markets are grappling with for the first time, we as South Africans have been grappling for quite a while. So we do have some better insights potentially than some global hedge fund managers. South Africa does have a proud history of producing world-class stock pickers, like Mr. Alan Gray, who started Alan Gray and Orbis, Kerr Nielsen, who started Platinum Asset Management in Australia, and other South African long-only firms with global operations, again, like 91, for instance. So South Africans are good stock pickers, not just of South African stocks, of global stocks. And then, like I mentioned before, the regulatory environment in South Africa is very good. More than 10 years, it's been proven. And the one thing we're still waiting for is that we are waiting for long-only unit trusts to be allowed to allocate to hedge funds. That will hopefully come soon. There's a review happening with that board notice, and we can't wait for that so that long-only unit trusts can also access hedge funds in the same way that the man in the street can access retail hedge funds, or in the same way that UCITS work in the European context. So where can South African hedge fund managers compete? If you look at all these points I'm making, it seems to be on stock picking, both long and short. And there, again, you can pick stocks and you can play the quarterly results surprise game, as many stock pickers do. And that is, you just focus on the next result and try to think, is it going to be a surprise, positive or negative, and you position your fund for that. That's difficult again for South Africans to compete with, because some of this needs alternative data. It's very expensive, but some might be able to be successful in the quarterly result surprise game. The real place, I think, where South African hedge fund managers can compete is not in all the strategies, but in multi-year or fundamental stock picking. So similar to what the long-only managers in South Africa have shown, good stock picking, and South African hedge fund managers have been picking stocks for a long while. They've proven they can pick stocks in the South African market. A lot of South African hedge fund managers have started picking stocks in global equity markets over the last 10 years. And this is where I believe South African hedge fund managers can have an edge, can compete against global asset managers, and therefore should be a consideration for people who invest globally. So thank you. That's it from my side. Our contact details are also on the slide. So if you want to contact us, if you have any questions, I know there might be questions for the panel after all of us have presented. So Tavonga, I'll just hand back to you. So thank you very much.
JP, thank you so much. So far, I think you sort of allayed my fears in one context only, in the sense that if you are going to sort of like passively track the betas I'm talking about, then I think aiming for -40 when I'm aiming for 40 is really going to complicate our lives. But I think you've sort of given us one answer to say it can only be fundamental stock picking. So we'll come back and explore that a little bit later. And I think also thank you for keeping the time. It makes it easier for the discussions to come through. Our next I think speaker coming up, I think, is James, coming on from Stain Capital. The product of focus, as much as I understand, is an SA retail equity, long-only equity hedge fund. Obviously, there's a context of the fears we have around portfolio construction. James, my understanding now is that in this particular strategy, where there is an allowance for 45% offshore, you have decided to differentiate yourself by combining SA equities and EM equities. So again, if you just kind of look at the concerns we're trying to address, and it's now really been penned down to stock picking, I love how sort of JP has pretty much handed this over to you to say it's a stock picking conversation. Help us understand how the stock picking, when you're interacting with the negative side of the betas, we interact with is going to add value. So over to you. Thank you.
Absolutely. Thank you very much, Tavonga. So, yeah, as I was mentioning, so Stain Capital manages 21 billion across essentially 4 different strategies. So South Africa, where we manage long, short, and long only. Emerging markets, where we manage a long, short strategy and long only, as well as Pan Africa and frontier strategies. All the strategies have outperformed since inception. And as I mentioned, the topic for today is our South Africa long-short strategy, but taking advantage of the opportunity set within a global emerging markets in that strategy. We can flip over to the next slide. And I think just kind of framing that emerging market opportunity set, this slide really is a very good summary of that. And essentially it shows the performance of emerging markets going back to the inception of the emerging market index versus the S&P 500. And I think what's very striking is that it's clear that this relationship between, developed market or S&P 500 outperformance followed by emerging market outperformance is a very cyclical one. It runs in these long multi-year cycles. I think just 2 very interesting observations are, the first is that until recently, in 2025, emerging markets had been in a, almost 15-year bear market relative to the S&P 500. And in fact, that ratio had gone to such a level that it was at an even more extreme level than the depths of the Asian financial crisis in kind of 1997, 1998, where, many people thought that, many emerging markets were going to fall over. And in fact, since the beginning of 2025, we've seen emerging markets begin to outperform. Our contention is that, that these are long multi-year cycles. They don't typically go in 1 to 2 years, and that we are in the very early innings of what we see as, a multi-year period of emerging market outperformance. Of course, 2 things that often accompany that are commodities prices, which we've started to see take off, and generally a weaker dollar, helps emerging markets. And I think there's a very compelling case why we might see a weaker dollar going forward. So kind of just, framing what we see as actually a very interesting kind of macro tailwind for emerging markets. I think it sets the scene very nicely for what we see as the opportunity. And if we flip over to the next slide, I think that because of this, the last 15 years of emerging market underperformance, this has led to, an extraordinary under-allocation of investors to the space. So for, a region of the world that constitutes 80% of the global population, generates around 40% of global GDP, its weighting in the MSCI All Country World Index is around 10%. And most investors surveyed by BlackRock in a survey last year had less than half of that weighting in their portfolios. So, not only are the valuations in emerging markets incredibly attractive, but they've been starved of a lot of investor capital for a long time. And we're slowly starting to see that reverse. And of course, as that continues, that is obviously a further tailwind for emerging markets, very broadly. If we flip over to the next slide, there's another important question that needs to be answered, and that is, of course, obtaining this exposure passively. But I think that emerging markets are also interesting in this context because getting passive exposure to them comes with its own challenges. What I've highlighted on the screen there is that effectively by buying the MSCI EM index, you're really gaining exposure to essentially 4 countries, being China, Taiwan, India, and South Korea, which together constitute around 80% of the emerging market index. And of course, if you look at that table on the right-hand side, 2 of those constituents, being Taiwan and India, are in fact not that cheap, even in a global context, which leaves, of course, an entire long tail of emerging market countries that are not adequately represented in the index, and where frankly not very many investors are looking, which of course creates a very, very ripe hunting ground for stock pickers like us to be able to find ideas that are in these unloved markets, and take advantage of buying these extremely high quality businesses at very attractive valuations. And if you flip over to the next slide, that's essentially what we spent 13 years doing. So, if you take the global EM and frontier universe, there's over 40,000 companies, in that universe, which is an impossible number of companies to work with. So we spent 13 years essentially going through every company listed in every single emerging and frontier market where we wanted to be active. And we had an analyst go through the business model and earnings drivers of each of those companies, and exclude all companies that didn't meet our definition of what we see as being high quality businesses. Essentially, it took us 13 years. So this was a labor of love for the team. But essentially over that period, we were able to whittle down that emerging market universe from over 40,000 companies to a high quality universe of just under 4,300 companies. And now this is not our coverage universe. We don't follow each of these companies, but that is our universe that we then use to screen for investment ideas using our internally generated proprietary screens. And so what that does is it's given us a proprietary high quality universe to then focus our screening attention to then really try and uncover these hidden gems in this universe. And out of that, we then pick the stocks for the long side of the book, at least. Our short side of the book follows a very, very different process. But as I'll come to, it's an equally compelling, opportunity set in emerging markets. And if we flip over, I've just kind of, put on screen there, a couple of the, as we like to call it, the hidden gems that we've been able to generate, globally using this process. You need a way to be able to focus your attention and to really, be able to identify, these opportunities, across the world. And through, the use of our screen, we've been able to identify these, super high quality businesses like, monopoly stock exchanges in Latin America to, dominant mobile money and telco businesses in Africa, port businesses in Greece, consumer goods companies across Asia, and companies, frankly, listed in emerging markets which didn't belong there and were therefore mispriced, like Mandarin Oriental and Group L'Occitane. And so through using this proprietary screen and this high quality universe, it really allows one to be able to identify these, very, very high quality businesses in unloved jurisdictions and be able to accumulate positions for our funds in them and take advantage of the extreme mispricing that we perceive in many of these markets. You can flip over to the next slide. But of course, it's not all roses, and there are, within emerging markets, there are companies to be aware of, and of course, running a hedge fund strategy allows us to take advantage of those companies that are misrepresenting their financial reporting or engaging in financial fraud or poor quality business models. And I've got on screen an example of a company, Energy Absolute, that we were short in Thailand, which I think is a very, very interesting example of this. We dubbed it Thailand's Enron because it shared many of the same characteristics that Enron had it engaged in. So, essentially a accounting profitable business, but deeply cash flow negative. And they'd been, boosting profits through mark-to-model accounting, incredibly levered business, lots of related party transactions, customers weren't paying, an impossibly low tax rate. So there were a variety of warning flags here, but I think it just really does illustrate that, across emerging markets, it really opens up a huge amount of opportunity for the hedge fund on both the long side, which I went through in identifying these very high quality businesses, but also on the short side, being able to identify those businesses and open up a much bigger opportunity set to access and take advantage of companies on the short side of the book. Ultimately, Energy Absolute came unstuck when the CEO and CFO were investigated by the Thai SEC for accounting fraud. And I've got a number of examples like this of very interesting shorts that we've been able to take advantage of in our hedge fund strategy for our clients. And of course, if you flip over to the next slide, what really the aim, that we're trying to do with this is to introduce diversification into our South African strategy, and to do so in a way that we can articulate our edge in markets. So, as quality value investors on the long side, and utilizing forensic accounting on the short side, we're aiming to generate alpha for our clients on both the long and the short side of the book. And being able to do this in other inefficient markets like emerging markets has been really additive to our South African strategy over time. Of course, ultimately what we're trying to do with the strategy is to outperform the South African index, or All Z index, but to do so with much lower, with downside protection, much lower volatility, and by generating alpha on both sides of the book. And with that, I think my time is up.
Thank you so much, James. You actually closed on a very good note. I think one of the things I'm very curious on is when we look at your strategy, could we split it up into two specialist building blocks, the long book, the short book, and evaluate them separately? But that's something we'll explore when we come into the question and answer segment. I'll go on to the last speaker on this particular panel, which is MJ. I'm going to use the acronyms because they're a lot easier for me. You make our lives very easy because you sort of bring all of these betas and into a multi-asset solution where it appears you'd engage with the long side and also sort of engage with the negative interaction of those betas. It's a very interesting strategy because we see that you're bringing in pretty much all basic asset classes are cash, bonds, property, equities, but you're also interacting across South Africa, DM and EM, which is quite interesting. So let's hear, I think, what you have to say, and then we'll break this down in the question and answer panel.
Thanks, Tav. Well, thanks, everyone, and thanks for being here. I appreciate your time. I appreciate it's also the graveyard shift. So today I'm not going to take you through a macro call or how we see the macro landscape. I'm also not really going to talk to our fund, the Wild Fig Multi-Strat Fund. What I'll rather do is explain to you how we see the world in terms of hedge funds and playing an infinite game of opportunities. And just a quick word of thanks to Fundrock and the BCI or FCI team, Olga, Eugene, Pierre, Tanya, and Tav. Really appreciate being here as always. And let's jump in. But first, if I can ask you, let's play a game. If you can take a second to imagine, we're playing a game and you're winning. What do you see? Well, I'd assume most of you saw a scoreboard or some sort of a point system on the table. James Carse famously defined two types of games, though, a finite game and an infinite game. With finite games, there are known players, fixed rules, it's time-bound, there are known constraints, games are played to win, and it ultimately leads to a winner and a loser. With infinite games, though, the results are known and unknown. There are unknown players to the game, the rules are changeable, there's no end, there's no point where the game unfolds, and success isn't necessarily a score, but it's rather the ability to keep on playing. And in life, an example of such a game, an infinite game, is a relationship. Every married caller or attendee on this call would know you can definitely succeed at a relationship. And even more so, sadly, you can definitely lose at a relationship. But there's no scoreboard. The rules keep on changing based on different phases in your life or different players, different people. Success isn't necessarily a score, but rather it's the ability to keep playing and keep moving forward. It's infinite in its nature. Now, why am I applying this framework to investing? Well, a finite investor tries to beat the benchmark. They define risk as a single tracking error, some sort of a score, and they keep score versus peers. Whereas an infinite investor, such an investor optimizes to generate absolute returns across multiple cycles. They define risk as a permanent loss of capital or the risk of not being able to play anymore, so to lose your seat at the table. And the scoreboard is compounding over time and compound annual returns over time. Now, how you define your style of game determines how you play the game. James Carse stated, "We are all players of infinite games, and in most areas of our life. Trying to win at an infinite game, though, leads to disillusion." Now, applying that visually, what I try to do is just construct this thinking, this framework to financial markets to illustratively explain how we can use this to our advantage as hedge fund, using hedge funds as a tool. And what I try to do is layer this in through a thematic theme over the next couple of slides. In theory, markets are simple and they cycle around the mean. There's ups and downs. There's a predictable oscillating performance chart, monthly return, if you will. It goes up and it goes down, and according to certain cycles. Sometimes you win, sometimes you lose. But in practice, reality as markets is not a wave. It's more of a dynamic field, if you will. Think about water or a surface. There's many cycles all at once across multiple vectors. They're dynamic across sectors, themes, and factors, or what we call collectively as a regime. And each one of these have a different driver of return and its own amplitude of success or outperformance. Now, using a finite view of investing, you would have a certain fixed approach that captures performance at certain crests of outperformance. That outperformance is indicated by these little bubbles, these dots on the chart, where your view intersects with the market. And it's paired by cycle or regime or opportunity set. Applying an infinite view on the markets, though, is much more dynamic. You have multiple sources of return, multiple drivers of return due to multiple sources of outperformance, and various drivers of these various diversified sources capture diversified sources of individual crests at different points in time and according to different sectors or drivers of underlying outperformance. Now, why does all of this matter? Why is it applicable? Well, because we live in a volatile world, and the data has never been more contradictory. Economic data, to some now, resembles fiction rather than fact. And as I said, I don't want to make this a macro call or dive too deep into how we see the current landscape. I think the previous speakers throughout the course of the day did a wonderful job of doing that. But to summarize very briefly, because it sets the tone for the next couple of slides, if you want to assess this through a single lens, it's global yields. Global yields are rising as we firmly enter the new macro environment or regime. Yields are rising across major developed countries as well as developing countries, and it's driven in the short term, and most would agree by this, due to inflation expectations around the ongoing war, cost of oil, etc. But additionally, there's longer term drivers, which we see in the 30-year and 40-year bonds as well. Fiscal spending, policy uncertainty, issuance versus supply versus demand issuance, And all of these are driving ever higher the end term premium associated with these bonds. It's not necessarily only on the short end of the curve. And it's causing a structural backdrop of the last 40 or so odd years of a bull market in bonds to unwind. And this is essentially the driver of all major considerations around asset pricing, future cash flows and discount rates, and a lens through which you can assume risk assets. Now, paired with this, additionally, global yields, which are rising, the fact that global growth is stalling or decreasing in certain areas at the same time, leaves us in a precarious situation. And depending on your view on GDP and the capex spend of hyperscalers and monetization of AI, we are somewhere between stagflation or stagflationary regime on the top left, where the S&P or stocks or risk assets decline and rates increase, or bond values also fall, and overeating between the section on the right in orange, where both rates increase and stocks keep ticking higher up to a certain point, both presenting definite risks to risk assets and traditional portfolios. And we've seen this before. It's not a new phenomenon as well. It's based on historical evidence over time, illustrated on these graphs, which essentially are rolling stock versus bond correlations, and previous speakers spoke to this as well. There's a breakdown in stock and bond correlations and the protection that you get from these asset classes. The orange shaded areas specifically indicate where there were higher levels of cross-asset class correlation, both globally on the left, as well as on SA on the right, which historically already has quite high levels of cross-asset correlation. And during the 2000 to 2020s, diversification was almost free. Essentially, you picked up free diversification between stocks and bonds because of the negative correlation between the asset classes. But now we've entered this new regime where this is flipped. Higher correlation it's higher correlation. So correlation is cheap, diversification is essentially gone. And you need to actively think about your portfolio construction and asset class combinations to achieve a balanced approach to investing. And not to go into too much detail, we can see this also, the effect that this is having on a portfolio and a problem it's causing for allocators. During high inflationary periods, low growth and stock bond correlation benefit breaks down. So the chart on the left, essentially, you can see the relationship is benign. The red circle towards the left at target inflation. And essentially what that means is it's not predictive. There are no, or is no relationship between high inflation, meaning that bonds can't serve as an equity hedge anymore. And the chart on the right, we can see that given the S&P 500 and 10-year correlation over various periods of time, we've entered this new regime where there's a higher cross correlation between these asset classes. And we know that the cross asset diversification breaks down. It essentially means there's a problem for balanced portfolios or the traditional 60-40 portfolio. So allocators sit with this problem of being structurally challenged when constructing a portfolio between these two asset classes to enhance portfolio returns, but specifically focusing on the risk management component. And when looking at the equity bond return composition, this is data from JP Morgan recently, April 2026, implying a 6% 10-year annualized return given the current earnings and coupon yield to be expected from bonds and equities. Now, the options to diversify are limited in the long-only space, and it's more of the same. It doesn't mean more diversification. And it's no one's fault, by any means, any lack of skill by managers. It's purely the mechanics of long-only products and how the regulation drives the portfolio construction ability. Even at 30 different general equity funds, which is indicated on the left, incrementally adding the funds on the x-axis, you see that your portfolio correlation remains effectively above 90%. So there's no additional correlation benefit from adding more of the same products to your fund or to your portfolio. And the chart on the right rather shows you that when you add uncorrelated return streams that act differently during the same periods and the macro environment, you get this diversification benefit really driving down the portfolio risk as you add uncorrelated streams. So what does that mean for investors and portfolios? Well, more of the same, as we said, doesn't really, you can't expect a different outcome doing more of the same, but volatility is increasing. So we need to find different sources of diversification. We need to find the ability to really add efficient diversification to client portfolios. And this brings me to the benefit of alternative returns. I'm involved in our Fairtree hedge fund multi-strat solutions, as well as some of the alternative products around real estate, private equity, and credit. And I'm quite passionate about this space, but hedge funds specifically bring a liquid form of alternative drivers of return to traditional portfolios. And the drivers of returns, or to rather say, the source of return is different because of the underlying drivers of return. And the true components what drive hedge fund returns in aggregate. It's a combination of short-term interest rates, which would involve your rebates as well as your cash yield, the equity market volatility, the ability of managers to pick up that volatility within their stock picking and the specific selective opportunities they've identified, and the level of equity dispersion. These three components essentially drive the bulk of hedge fund returns. And you can see on the right, I've shown that over various periods of time, we're entering a period where all three of these seem to be much higher than previous accounts, especially during the 2010s, and more likely outperforming the historical accounts of the early 2000s, where hedge funds achieved a close to 13% return, outperforming most asset classes. Now, Ray Dalio famously is a renowned hedge fund manager from Bridgewater Capital, one of the largest hedge funds in the world. He coined this term, the holy grail of investing, which essentially is a series of blends of uncorrelated return streams to achieve what he coined the holy grail of investing. Where you add uncorrelated returns to the same portfolio, you see that it brings down significantly the standard deviation of the portfolio. At various levels of correlation, which each line indicate, when you add more assets to the portfolio, it doesn't have a significant drop in the overall standard deviation, which is on the y-axis, but rather when you add lower levels of correlation, you get that significant benefit over time as you continue adding more different assets to that portfolio. And when you swap that around, essentially keeping your standard deviation the same at the same Sharpe ratio, but a low correlation, you can see that the combination of all these portfolios and these asset classes combined into a single lens outperforms all of the underlying building blocks as a multi-strategy or as a blended portfolio. And the reason for this is you have a positive Sharpe ratio. You're compensated for the volatility within each driver of return. But because of the uncorrelated nature, they fire at different times. So they keep on building and aggregating and compounding on that base to achieve an ultimate outperformance, which is undeniable. And that's essentially what the approach we've modeled and we've taken with our fund at Fairtree, the Wild Fig Multi-Strategy Fund. We take a blended approach to internal Fairtree strategies, both across equity, fixed income, and commodities. And since inception in August 2010, we've generated over 20% annual returns compounded annually. And I would argue this is what playing an infinite game looks like. It's built to compound across multiple cycles, and we aim to continue doing so, playing this game of investing in financial markets for the foreseeable future. Thank you very much. Happy to hand over to Tavonga and take any questions.
MJ, thank you so much. Thank you so much. I think we'll sort of get straight into the questions. We've got about 8 minutes before we get like a heads up from Eugene, so I probably can squeeze in 1 or 2 questions. I think the first part maybe is to maybe go straight to the short side of this conversation. I think maybe to all speakers to say, how do you go about shorting? Sort of you produce a much better outcome than the extreme that I sort of envisaged. So if you're obviously participating in the negative side and the beta is like sort of up by 40, it means if you do anything better than minus 40, you've done very well. And I guess in that particular scenario, we're probably looking at least 0 and above, which is the absolute side. So just to maybe get some comfort, JP, around how easy is it to short on the DM side? Given that we're starting off with very expensive valuations, does that make your job a lot easier? Or like it's not, shorts are not directly correlated to valuations? And I guess I would extend the same question to James as well, to say like, how do you go about short and how is the short side performed? And then we'll finish off, I think, with the short side in a multi-asset context.
Thank you. So to kick off, yes, our Protea Global Retail Hedge Fund domiciled in South Africa focuses on developed markets, and our Protea International Hedge Fund domiciled in Malta also focuses on developed markets. And in developed markets, especially if you stick to the larger liquid shares like we do, it's easy to short. There's no lack of scrip to borrow, and we generally stay away from shares with very high short interest. In a lot of other stock exchanges around the world, short interest is actually published. So you can see the short interest in individual shares. So it's relatively easy to short for us. When we do attribution analysis historically on our portfolio, our short book has broadly broken even. That is on the profit and loss basis of the shares themselves. In addition to broadly breaking even, one must keep in mind that a short book, when you short, it generates cash. So if you can break even on a profit or loss basis, your short book should still generate an additional return for you from the cash yield you get on the cash generated by shorting. So a short book that can break even is still very handy, firstly, from the cash return you get, but secondly, also it allows you to have a bigger long book. That is why you can have a short book of, say, 30 or 40% of a portfolio, and it means your long book is not constrained to be 100%. You can maybe have 120% long book, and that means that you have more longs, and that's where most of returns are generated for most portfolios. But the short book is an enabler to have more long positions. The last point I would make is it's when shorts go down is important. To use an example of the minus 40% beta, a short book can be very handy, even though it breaks even over the long term, if it makes money when betas are negative, therefore when markets fall, even though it might lose money when betas are strongly positive when markets rise. So the timing of when returns happen is also very important and is another benefit of a short book.
And maybe just before I leave you is how easy then is it to execute research to short ideas again from a South African hedge fund trying to express this as a global hedge skill set? How do you go about it? How do we derive comfort on the ability on your ability in that aspect?
Yes. So the technical act of shorting is easy, but the idea generation is not necessarily as easy. So what we do to get these short ideas is we also have screens, we do individual stock analysis, but we also make use of short-specific research. We've partnered historically with two, and we just added a third short-only research provider that helps us to identify shorts in developed markets. And we also have subscriptions to expert networks, which allows us access to ex-employees, and competitors and clients, for instance, of companies, so that you can build a short thesis about a company, and that really helps us with the idea generation on the short side.
No, thank you. I'm gonna move on to James. James, just to maybe understand, if we split up your strategy as a long only and a short only, how would we characterize the long only versus maybe the JSE? I know you've kind of given us a hint at that. And maybe another question I'd want to ask, which I would have asked JP and I forgot, is could we still discern like the dominant style characteristics of your long book, as in quality, growth, momentum, etc., if we do that? And then how does it look like also if we look at your short and we look at the performance, and is breaking even like an exceptional outcome already?
So I'll maybe go first. Yes, quite right. So in our long short strategy, we run an independent long book and an independent short book. So we don't do pair trades as part of the strategy. So we are actually trying to generate alpha and returns for our clients on the short side. And in fact, the function of the short book is several fold, but really what we're trying to do is not only generate positive returns on the short side, but of course, if you can do that, it's a little bit like having an insurance policy that pays you, because when markets go down broadly, your short book provides that protection. So maybe just kind of breaking up that attribution of our hedge fund strategy, our South African hedge fund strategy since inception. So since we launched the hedge fund in 2009, our short book has generated around 0.5% positive return over that period, which is, I think, similar to JP, that is in the context of a short book, is a really good outcome, because if you want to think about the inverse of the market, which is really what your benchmark is on the short side, that's, over that period, the JSE did around 15%. So that's a little over 15% alpha on the short side. But with, what it provides to the portfolio, in addition to that, is that downside protection. And also, as JP mentioned, it allows you to really size up the long side of the portfolio as well. And if you can also generate outperformance on the long side, that's really where you get that strong hedge fund outperformance. And we've been able to do that. So we've been able to outperform the market on the long side on a gross basis. And that kind of gets you that kind of net performance after fees, where we've been able to outperform the market by about 2.5 points per annum, but with much lower volatility and with that strong downside protection. I just want to make one more point, is that we don't do valuation shorts in our strategy. So all of our shorts, what we're aiming to do is identify companies that are engaging in some form of accounting chicanery one way or another, and our catalyst normally for that is earnings. So the holding periods are a little bit shorter, and we're looking for that kind of to materialize in unmet market expectations, or where companies underperform, or if they're fraudulent, where they ultimately blow up.
Yeah, and maybe before I sort of finish off, I think with MJ, I want to ask one question. So the starting point for emerging markets that you noted is very cheap. Makes sense from a long perspective. Does that make your job extremely difficult in terms of generating short ideas in a rolling EM cycle? Is that going to complicate I think the idea generation, and sort of how successful have you been on the short side in the emerging market space?
Yeah, you're quite right. So when you do have very strong beta tailwinds, obviously it does tend to make markets rise. So you do have a bit of a headwind on the short side. That being said, our shorts tend to be quite idiosyncratic. They also tend to they perform quite differently to the market. And because what we're trying to target is, a very specific type of company. So, where there's, where there's poor earnings quality and the like, and our catalyst ultimately tends to be earnings. It tends to kind of not move alongside the market like that. And so, over time, we've been able to generate, very strong performance on the short side, in the emerging market strategy too.
Thank you. MJ, I'll finish off with you. The most comforting side from us is that the overall asset allocation still lands up very close to a 60-40 sort of. If I look at that compared to the strategic asset allocation of a normal long only balanced funds, that's quite similar. I think you're sort of sitting at about 64-36 or something like that, where 64 is growth assets oriented. And could you maybe just talk us through how diverse the uncorrelated part, the uncorrelated returns are, maybe within the fixed income carve out, which I think is about 36%. And then if you also move on to the growth side, and there maybe there's a very specific focus on how you bring in commodities into the strategy.
Yeah, 100%. It's quite a nuanced or layered answer, to be honest, Tab. So cut me short if I go into much detail. And it ties into your question around the short book as well. Seeing as we're a multi-strat, we've got different building blocks or components to the portfolio. Essentially, what we do is we blend the internal allocations or strategies on our balance sheet to achieve the portfolio objective of absolute returns at equity-like volatility, so JSE-like volatility to target absolute returns. Now, that being said, the bulk of the book is generated by market-neutral strategies. So we would try to isolate idiosyncratic opportunities in pair trades, versus a traditional long short or directional strategy, even though we do have a 15% allocation to directional. So it's a completely driver to JP's point. It's a completely different driver of return. All these strategies, all these hedge funds per se, have different drivers of return, and they will act differently according to different market cycles and opportunities. And it's not homogeneous. So the diversification that we pick up across our portfolio is across the portfolio construction, that strategic asset allocation, where the market neutral book has a gross leverage of 140% and a net directional leverage of between 0 and 10%. So there's really no beta being picked up. And just to maybe clarify that point, your reference around the market beta, something like 40% in aggregate as a reference. What you also need to do is you need to take a beta adjusted net view on your positioning to really allocate and take a proper view at how exposed you are to a market. So even though in our market neutral book, we might have a 10% net direction on the book, or on the directional sleeve, which is 15% of the allocation, we might have a and 90% net direction. That doesn't account for the beta. So on a beta adjusted basis, we could have 14% or 30% directional exposure to the market. So what that means is we only pick up 30% of the direction within the underlying beta. The rest of the return is either then hedged out through our short book, on which we then, to JP's point, we take a very similar approach. We use it as a hedge. We generate a cash rebate on that. And that has a different protection mechanism within drawdowns or when the market goes against you. So all these drivers of hedges and protections and different sleeves essentially compute and aggregate on a portfolio level to a diversified portfolio where the uncorrelated nature of these strategies essentially build up to the wild fig net direction or net level of exposure to the market, if that makes sense. So it's very layered. Maybe just to touch on the commodity strategy as an example, commodities completely different to what we see in the equity and the listed public stocks in South Africa specifically, because the commodity strategy is a 15% allocation to soft agricultural commodities, things like soybeans, corn, cattle, pork, maize oil, etc. And these are internationally traded commodities. So that's the beauty of the strategy. You can trade South African corn or maize versus American maize across very liquid and deep counters. So it's driven by supply and demand, and it really has no impact or bearing on the direction of the market or South African local market on the performance of those trades. It's very, very pair driven and close to net zero exposure on a directional trade. So it's purely idiosyncratic supply and demand drivers. And that 15% sleeve will have a completely different driver of returns versus our equity component, as an example.
No, thank you so much. There was quite a lot to unpack, and obviously a lot I also learned from this panel, and I can see Eugene is up. But thank you so much for the contribution. I think the key point we get there is that there is a very strong dependence on the stock picking skill of the SA asset managers, which has been exceptional and generated pretty much, I think, since the time I entered the industry about 22 years ago, which I think gives us a lot of comfort around that. We will unpack this obviously at next year's one or sometime later this year, should we have a similar conference. Back to you, Eugene, and thank you to all my panelists.
Lunga, JP, James, and MJ, my head is spinning. I'm definitely going to have to replay some of these bits. I'll let that conversation go a little bit because I think it was extremely valuable to better understand exactly what's going on in those strategies. But like I said, I'm going to do a recap of all your presentations. It was absolutely great. Thank you so much. James, I would like to get your views sometime in the near future on a company like BYD, since you mentioned accounting shenanigans. But anyway, we'll park it there. We are moving on, and we are going to close off with our last session for the day on global equity. And joining us is Gideon Nieuwoud from Southern Right Capital, and all the way from London, Oliver Alston from T. Rowe Price. And as moderator to our session, we are joined by Kim Rousseau from Symmetry. Lady and gents, you are the last session, but it's a very important session just to recap on some of the views on global equity and your views. Maybe for our audience, very quickly, to create some context, Southern Right Capital represents GQG in SA, or rather put, they've got feeder funds that feeds into GQG, which is a US-based investment firm. But Gideon from Southern Right Capital will explain a lot more on that. Kim, I'll hand over to you. Thank you very much for your time.
Thank you, Eugene, and good afternoon, everyone. Thank you for having us, and apologies for being the graveyard shift, but at least we're shifting gears from hedge funds back to global equity. Just want to thank Fundrock and my fellow panelists for allowing me to be part of the conference. To give some context on Symmetry and what we do as a DFM, to Tavonga's point, as an allocator, we're basically looking to focus on following a style agnostic approach within Symmetry when we're selecting our managers. So that means we focus less on backing one specific market narrative and focusing more on combining different styles and managers, so that we can work through different market conditions and cycles and deliver more resilient client outcomes over time. So that makes this discussion particularly relevant. We're investing in a world where there's higher real rates, more macro uncertainty, wider dispersion across both sectors and regions, which in my opinion allows for a broader opportunity set for our active managers. So today I'm pleased to be joined by Gideon from Southern Right Capital, who's going to take us through the GQG Global Equity Fund, and then Oliver from T. Rowe Price, which will talk us through their Global Value Fund. So between them, I think we've got two very distinct but highly complementary global equity styles, which is exactly what's going to make this discussion quite useful from a portfolio construction perspective, and to understand how they complement each other through different market cycles. Yes, I'll hand over to Gideon to kick us off, and yeah, we'll take it from there.
Thank you, Kim, and thank you to Fundrock for letting me present. I am using today the background of San Francisco because this is where I'm calling in from, and I didn't have an early rise. I haven't gone to bed yet, so I'm looking forward to the future. You guys in South Africa and in London may know what the future holds. It's 10 to 5 in the morning here in San Francisco. To maybe thank you, Jean, also for the contextualization. Southern Right Capital took GQG to South Africa and set up the funds with Fundrock about 5 years ago. We firmly believe in the compounding of knowledge and relationships in capital. And I joined the industry, the fund management industry, in the year 2000. And maybe if we can go to the next slide, I can give a bit of context of where we sit now, 26 years later, and our perspective. The Southern Right Capital name comes from the Southern Right whale that we see there on the coast in South Africa, and we believe that, like the mother whale, we need to nurture relationships. We need to compound those relationships with the knowledge, so that we can compound your capital. If we can go to the next slide. So this industry has become almost $150 trillion industry. To give you a little bit of context, how I will position the GQG fund as well as what we do in growth equity. Back in the year 1940, I know that's a very long time ago, but and the asset management industry at the time in 1940 was about $10 billion. So there was only 68 mutual funds, and this is just looking in North America. Today, that same sort of universe sits north of 164,000 funds. So that's quite a profound growth. In addition to that, if one look at the professionalization and call it the industrialization of this industry, back in 1963, there were 268 CFA charter holders. In my organization, we were less than 10 people. We've got several CFAs, including myself. And today we sit with north of 200,000 CFAs. And the same for actuaries. I'm sure there's a bunch of actuaries also on this call. I've worked with a lot of them in my early days. That universe also grew from just over 1,000 to today north of 90,000, and the same for financial planners. Back in 1970, the number, and I think this is only North American, was at 0. Today there's 240,000. So we deal with a very complex opportunity set. With when I joined the industry, the big decision was how much you allocate out of your risky assets, which was equity, into bonds, and it was basically 60-40 of equities and bonds. And now with 26 years of hindsight, one can argue that if one just stayed with that 60-40 split, you might have done even better. But for the industry, it was great because, as we can see, a lot of people have been employed successfully, and that gives a lot of complexity to the system, but not necessarily the best outcomes to investors. So we at Southern Right, we try to be a bit disruptive. When we took GQG to South Africa, it's because they were also a disruptor in their segment, and we basically want to make sure that we continue to move with times and not make things more complex, keep it simple and assure better outcomes. If we can go to the next slide, please. So how do we make it simpler, as opposed to having all those different asset classes? We focus on 4 key drivers. And today we're going to talk about the growth driver. My panelist is coming from the value side, but whether it's growth or value, we believe all equities sit in our growth bucket. And there we also don't necessarily just look at public equity, we look at public and private equity, and that is where we want to be in the long term, for where we want to play for growth. And that growth is sort of been driven by not only GDP growth, but also multiple expansions and contractions at points in time. But we use the broad categorization of growth to do all our equity investments. You will see our target allocation there, or our target approach with our growth assets, is to outperform the MSCI All Country World Index with north of 2%. With GQG, we've done that since inception, which was October 2014. It compounded at 12.2%, where the index have compounded just slightly over 10%. So we believe one should have an approach also where one buy low and sell high. It sounds simple, but a lot of folk try to sell low and buy high in this industry, because it's much easier to chase performance than to lean into complexity or tougher performance years. But we believe that the best years come after there was a bit of a drawdown in the alpha production of a fund management business. If we can go maybe to the next slide. So this is just indicative. Southern Right, I found it, and we started working with GQG back in the beginning of the second quarter of 2017. That is a combination of how we played in our growth bucket. We've never had more than 3 managers in that strategy. And as I say, this is indicative. If people want to compound a bit of our knowledge and on the relationship, we're happy to go more deeper into how we've done that and with who we've done that. But GQG has been a key component of this. You've also, since we've got the feeder fund in South Africa, had the ability to compound with GQG during this or a segment of this time. Maybe if we go to the next slide. So in December 2022, and maybe if one just stands still on the year 2022, that was a year when inflation really came and rates really went up, and inflation became a real thing, mainly driven by what was at the time a pull forward of earnings, and then supply chain difficulties at the back end of COVID. So what we have seen then in December 2022, which I would describe as a game changer and a paradigm shift, was the first release of ChatGPT, the first consumer application of artificial intelligence. So we also think that game changer in that complex world and how our industry is set up, one need to have an open mind and think of both public compounders, public companies, as well as these private companies that's coming to the market this year and will be for the first time in the public domain, but at a much larger scale than we've ever seen before. So back in the year 2000, when I joined the industry, it took about 4 years for the median company before they IPO'd, and then they compound in the public markets. And now today, 26 years on, the median tech company sits in the private markets for 12 years. That gets a lot of private equity only investors quite anxious. People who's familiar with private equity will know the term DPI. So a lot of private investors got quite anxious because private equity vehicles tend to be 10-year vehicles with 2-year extensions. And historically, investors got their money back quicker through IPOs and the like, and hence had earlier DPIs. So there was a big significant shift in terms of DPI, as well as how companies compound in public and private markets. When Donald Trump became the president for his second term, it's the first time in history that one has seen these private companies CEOs fly with the president of the United States to visit world leaders. They all sit around the same tables. And in the context of what a company do and how they sell their products and generate their revenues and their earnings. That has almost nothing. It's completely disconnected with whether it's a private company or a public company. So it's more sort of a reflection of how us as an industry, based on those numbers that I showed earlier, have started to bucket or sort these, call it smarties, among its different colors. If we can maybe go to the next slide. So this is just showing, again, per my discussion, for Apple, since their IPO, it took them 38 years to become $1 trillion company. I know the slide is also quite small, so those who's interested in the slides, I can send it afterwards. Maybe the next slide. So 38 years compared to companies now going public, and Anthropic is the much awaited IPO. It seems like it's between them or SpaceX, who will be first to come out this year for an IPO. We also have seen already where we've had an exposure in Cerebras that came out as an IPO. It IPO'd at I think something like $80 billion. And these private companies is companies, some of them with a few years of history. Here we can see OpenAI and Anthropic. They're both going to come to the market probably north of $1 trillion. Anthropic just completed a round at close to $1 trillion. Still private, still in the private domain. SpaceX, the much talk about story, especially here where I sit in San Francisco. They are coming to the market imminently, have done their filings, and it's going to change again the construct of what this industry have done. There is going to be differences in indexation and how the indices are going to account for that, but that's maybe a presentation for another day. Maybe the next slide. So to bring it back to Southern Right Capital's growth fund with GQG, on the left you will see that is what you get. So you get these public quality compounders with a forward-looking quality approach. It's an adaptable portfolio. I will talk about the characteristics as it relates to downside protection in markets that pull back, and also some participation when markets are shooting up, but the late cycle participation in growth from a product like this is not to be expected. So typical companies that's in there now, companies like Philip Morris, which we can talk a little bit more further during the question and answers. And then on the right side, where we have in our growth or in our equity bucket, but the public and private market growth companies combined with the call it long-term compounders across the public and private markets. So we believe today it's not about public or private, it is about compounding growth in equity. And we seek that resilience through innovation and through our total portfolio approach. Maybe the next slide. So GQG, the product which we've got the feeder on, this is the long-term return characteristics. Like I said at the beginning, I first met Rajiv Jain back in the year 2004. Rajiv at that point have already managed money for 10 years, since 1994 at Vontobel. And when we launched with him in 2017, we've already had 13 years of working and knowing how we invest. And what we believe that one need to know what you own, and know how these portfolios will perform in the future. It's again easy to see how it did in the rear view mirror, and Rajiv got the famous saying of past performance is not indicative of future performance, but indicative of future fund flows. So unfortunately, we see in many markets where we work with GQG that investors buy it when it's high, when it had great performance in the tank, rather than buying it when it had a little bit of a dip relative to the benchmarks and peers. So in that period that I talked about earlier, that when interest rates went up, and we also saw the Russian invasion of Ukraine, that's a period of time when they've showed exceptional outperformance, as they were to be expected to perform when one see headwinds, macro headwinds, that also impact the fundamental bottoms-up portfolio construction. With that, I think that is probably the last slide. If we can go to the next slide. That is just wrapping things up, where we want to show with the complexity in the industry, it requires selectivity, resilience, and flexibility in thinking. So I know as you build portfolios for your clients, there may be constraints that you have as it relates to illiquidity and others, but we believe that the best way to compound long term is to have a basic approach and an open mind and a forward-looking approach as it relates to the specific segment, the growth segment. We can look at the next slide. That's the health warnings. So with that, thank you, Kim. We can looking forward to speak further during the questions and answers.
Thanks, Gideon. That was very interesting. I'm interested to hear your views on those IPOs and the impact it's going to have on the S&P 500 once they come in. But now we'll hand over to Oliver. He's going to take us through the Global Equity Value Fund from T. Rowe. Thank you, Oliver.
Excellent. Thank you, Kim, and good afternoon to everyone. I know I've got the graveyard slot of all graveyard slots here, so I want to be very punchy and speak to you about something that we're very excited about in the markets. It is, of course, the Value Equity Feeder Fund at T. Rowe Price. My name is Oliver Alston. I'm a member of the Global Equity team based here in London, more specifically assigned to the Value Fund. I've had the pleasure of delivering updates to this forum for a number of quarters now over the past couple of years, and the message has only got more and more exciting as we are now in a regime that has changed and value is starting to work. So excellent. So just very quickly, recap on it. T. Rowe Price, we've got around 1.6 or 1.7 trillion assets under management. The majority of that is in equity, active equity. We have some fixed income and multi-asset with around 10, 12 offices around the world. So we have a truly global reach, which puts us in a great position to manage global equities. If we can move forward one slide, please. And I can get straight into why I'm here, or to the following slides, and introduce that theme about why we're excited about value investing. Now, you've probably heard a number of times from your panelists and presenters that we are entering a regime that has changed in terms of the value, in terms of the interest rate and inflation outlook from a number of conflicts and oil shocks. All of this kind of reaffirms this view that we are not in a regime of constantly declining interest rates. And here exactly is a chart that shows what I mean. You can see over the past 10, 20 years, up to the point of COVID, this blue line here is the 10-year US real yield. And we've just gone through a constant period of decline, lower lows, lower highs. And you can see the black lines highlighting how that 10-year average, that decade average, as we've moved through this period, has consistently got lower and lower. Now, if we go sort of post GFC to the pre-COVID era, that continued to the point where it was almost, it was very difficult for a value manager to outperform, because that low interest rate, benign inflation environment was just fueling that cheap capital predominantly to the growth areas of the market. And more recently, you can see that blue line ticking up, and we know why. Out of COVID, those inflationary pressures have fed into interest rate markets, both at the long end and the short end. And of course, more recently, energy shocks and geopolitical fractures and tensions, they are only exacerbating those upward forces on interest rates. And if you can move to the next slide, please. What this slide does here is really bring to life why this is important, certainly as an asset allocator, that as many of you are making your decisions across your funds and portfolios. You can see the blue line, which is the 10-year yield. As that moves higher in history, that has had a very strong correlation with the value outperformance over growth, which is that green line. Now, that green line moving up means value is outperforming growth in whatever period it is you're looking at. More specifically, we've highlighted here 2 periods of commodity bull markets, and that's going to feed into something I'm talking about later, that when we almost have the perfect trifecta of a more normalized interest rate environment, i.e. slightly higher Inflation is returning, so something that investors have to really think about. And you add to that potentially, or we believe, we're at the start of a commodity bull market. That's a really perfect environment, or a really good recipe for value success through the end of the decade. And if you can go to the following slide, please. Actually, we'll skip through this one because it sort of reaffirms what I've just said. And then at the start of this presentation, I mentioned kind of about how value is now starting to work. What do I mean by that? Well, we've seen periods in the past where certain regions have seen value outperform. So on this bar chart here, this shows each region: Europe, Japan, emerging markets, and the US. And a positive number means that value has outperformed in that region. If it's negative, it means that growth has outperformed. And you can see very clearly here that value has been working apart from in the US, which is something that's been wrestling with that concentration of those top sort of Mag 10, Mag 7, whatever you want to call them these days. Those are excellent growth companies that have just continued to deliver exceptional returns. Now that has changed up to the end of April. In the US, value has now started to outperform, which feels to us like the final domino to fall. Now, I appreciate that markets move differently through May, so it would look slightly different now, certainly after growth performed a little bit better. But we're getting more conviction that the market is broadening, and all these factors are being recognized by market participants. And that kind of plays into why we believe a global approach to value investing is absolutely crucial. If you can move forward in the deck, please. Now, if I'm saying to you, well, value has started to perform, the natural question is, well, maybe we've missed the boat. And now what we're doing with this data here is we're taking the price to earnings ratio, a weighted average of the growth stocks relative to those value stocks, to create a premium, a spread, if you will, that gives us a gauge of how close we are relative to history and whether the entry point ultimately is still attractive. Now, you can see what we've highlighted here over history. All the way to the right would be the 100th percentile, which would mean that growth has never been more expensive relative to value. And all the way to the left would be the reverse of that. And we're still to the right of the median here. And in the Russell index, which is the US market, so this is the Russell 1000 value and growth indices, you can see the premium is still 43% of those growth stocks relative to value in the 61st percentile. In EFI markets, which are outside of the US, that premium is even higher at around 60% and in the 71st percentile. So naturally, the answer to that question of, okay, well, if value started to work, there is still plenty of room to run, and the entry point is still attractive. And if we can move on to the next slide, please. And the following slide, if I just reintroduce how we're approaching that. Sorry, that's the compliance slide. We'll go one after that one as well. How we're thinking about this, and just reintroduce the team to you. The Global Value Equity Strategy is a portfolio run by Sebastian Mallet and Marta Yago, who's the Associate Portfolio Manager. Now, I mentioned at the top, T. Rowe Price manages around $1.6 trillion in AUM. Of that, around $230 billion is actually value equities. So a conception is that T. Rowe are great growth managers, which we are, but we also have a very, very deep-rooted historical presence in value markets, and that's further backed by those names underneath. They're all managing different strategies across the suite, from US to emerging markets to international to then to more quant screen value strategies. So we have value is truly sort of deep-rooted to our history at T. Rowe Price. And if you go to the next slide, please. We'll go straight through to the other one to bring to life how we are delivering that value exposure. And more specifically, how are we doing this differently relative to our peers? Now, the way we see value is in a number of different forms. And you can see in that sort of diagram on the right-hand side, we view value as defensive, cyclical, and deep value parts of the market. And we recognize that actually these work differently at different times. This strategy was launched in 2012, 2013. Not a great time to launch a value strategy with those growth headwinds that I mentioned earlier, but by applying this framework consistently, actively identifying different ideas, we've actually been able to outperform the value indices over all periods, and over almost the only negative period is the since inception period for MSCI World, which of course is the core benchmark weighted heavily to those growth names. And key to that success has been how we've been blending different types of value. So defensive value, typically higher positions in the portfolio, more higher quality, but we still find a way of uncovering some value opportunities. Typically, we'll be looking there at the cash flow, free cash flow yields and things like that for these companies. That tends to be around 50% of the portfolio. As of a few days ago, it was around 47%. The balance is where we invest more actively in cyclical and deep value names. And as this diagram suggests, we tend to be between 20 to 30% to each of these buckets. We're currently tilted slightly more to deep value, but that changes over time. It doesn't change materially. It changes to reflect what we're seeing in the market in terms of dislocations in certain sectors and opportunity sets. Cyclical businesses are quite obvious. You can think of materials, industrials, financials, but also tech. So we talk about this AI supply chain. It's hard to ignore, but parts of that supply chain are incredibly cyclical, and that's where we seek out alpha in that bucket there. So it brings our participation rate quite high, our success rate over a 2 to 3 year horizon, and ultimately since inception, it has been positive because of this way in which we identify different value ideas. If we can move on to the next slide, please. Here's one thing that we don't believe many people talk enough about. Now, a lot of peers and investors will talk to you about how they identify buy names and what they're searching for and why that's important. Well, part of investing is, yes, identifying the opportunity, then you got to work out how to sell it. And then you add in the complex of potential value traps. The sell discipline becomes absolutely crucial. And again, back to the success of how we've delivered this alpha over the full cycle, which has been predominantly growth, and more recently now it's value. This sell discipline has been a key driver of those returns. Now, how do we deploy that? Well, we have holdings in the portfolio that we are constantly assessing. This is an 80 to 100 name portfolio, which means we are declining or rejecting quite a lot of ideas that our analyst platform are putting to us. So there's a real competition for capital. Now, if we have a thesis on the stock that we think is broken or it's flatlining and we have better ideas, we want to be quick to sell that idea rather than to wait for the market to tell us that we were wrong. And as I just mentioned at the start, that's typically when you're looking at a value trap, of which we expect there to be more of as we're going through this AI disruption theme, which should play out over a multi-decade horizon. There will be winners, there'll be cyclical plays, but there will also be losers, that many of them will present as value traps. So this is something that's absolutely crucial to our process, our alpha, and ultimately it's as important as the buy decision as it is as having a strategy to exit and replace it with a better idea. If we can move on, please. And ultimately, this is the portfolio as it is as the end of April. On the left-hand side, it should be no surprise some of the overweights we've got. This is relative to the MSCI World Index, which is our primary benchmark. We're overweight materials. A lot of that stems from gold exposure. We typically hold around a 3-4% exposure to gold stocks and royalty names. But we also have some more names such as copper and aluminium in the portfolio, because we believe that we're at the start of a full commodity cycle that's going to be across the metals landscape, from precious metals into industrial metals, certainly as this infrastructure build out from AI demands more things like copper. Financials, in a higher interest rate environment, in a steeper yield curve environment, many of these financials are starting to be able to earn more on how they deliver their business. Simply put, something like a net interest margin, which is the difference between what they pay on your deposits versus what you pay them on your lending. Quite simply put, there's a few more layers to it, but that difference expands as a margin. Financials are in a better position to outperform. Companies like insurance businesses, when they take your insurance premiums for your house, your car, they invest that in what's called a float, which is typically safer assets. Now, those assets are yielding all of a sudden slightly higher levels of return. So they're boosted their bottom line by that investment income. And all of this is speaking to that regime change that we see a higher for longer, higher interest rate, higher inflation environment. Overweight towards energy, a typical value hunting ground. There's a number of names that we own here. More specifically, we're quite bullish on the oil field services names that we think are set to benefit, certainly as that international exploration starts to tick up and that need for energy security starts to take hold. All the way down to our underweights. Tech, no surprise. Consumer discretionary, these are more growthier parts of the market. However, we do own some tech exposure because, as I mentioned at the top of the presentation, there is a lot of cyclicality, meaning a lot of opportunity for us to own some great stocks, namely the memory stocks in this part of the market and that supply chain. On the right-hand side, we are delivering a global portfolio. Now, it wasn't too long ago where the USA was around 55, 60% of the MSCI World Index. Today, it's north of 70%. We want to make sure that we're delivering for our clients a global value portfolio. So we run an underweight towards the US of around 10 to 15%. It's capped at minus 20%. And that allows us to fund other more compelling ideas, namely in emerging markets across Europe, Japan, and Asia. Certainly Europe and Japan have been value markets where we've been very successful more recently. And if we can move on, please. I'll finish here on the performance just to bring to life, how our approach of blending these different types of value is actually translating into client returns. Now, it's a very difficult job to try and time the sort of value growth regime perfectly if you're an asset allocator. What we want to do is give you a more all-weather value portfolio, which means you can own it in your strategy without having to take meaningful bets and, quite frankly, risk losing your shirt because you are far too involved in the deep value names, which come with increased volatility, of course, as that factor swings in and out of favor. And our performance speaks to that, certainly over the long term, which has been dominated by those growth names. We have remained in touching distance, which is with what has been a difficult index for a value manager to beat. But then, of course, along the bottom there, you can see we've also managed to outperform the value index, which really speaks to the benefit of our approach. Not sure how we're doing for time here. I don't want to run over. Happy to stop and take questions.
Perfect. Thank you so much, Oliver. Let's start with you with questions, unless there's anything in the chat. But my first question is about around your presentation talks about a world where capital has a real price again. What does modern value look like for you today, and how can this environment be more supportive of value for the next decade compared to the last decade?
Yes, absolutely. Well, many people will come on and say this time it's different, and I'm sure a lot of people have done that over the years. Well, what we are seeing is that this time we're returning to a more normal environment, which is why we say capital again has a price. That higher interest rate environment, that higher inflation environment, a lot of this stems from these sectors such as energy, where we feel there's a structurally higher price to be paid in the future. Now, we could debate that price, but the odds seem stacked in the favor that it's going to be higher than it is resorting to more of a 50-60 handle. All of this feeds into that complex of higher interest rates, higher inflation, and that modern value approach very much speaks to what I just discussed in terms of how we blend different types of value at different times, because we recognize that there's some alpha to be had there in terms of how we allocate to those opportunities.
And maybe just to follow on that question, in terms of the buckets that you see within value, defensive, cyclicals, and deep value, how do these buckets behave differently across the cycle? And where are you seeing the best asymmetry at the moment?
Well, the deep value part of the market has been what's rewarded us most more recently. If we think about over the full track record, the start was very much the defensive parts of the portfolio helped us in that growth era, that dominant era of growth investing. We then saw a period as we entered sort of COVID where some of these cyclical businesses started to look attractive to us. And you can see that in the performance, they contributed meaningfully. And now we're seeing again, when we speak about the three dominoes to fall, that deep value part of the portfolio, which is around 27% of the portfolio today, they are being the most meaningful contributor to our performance. So yeah, I would say that's where we're tilting. Certainly over the last 6 to 12 months, we've tilted more deep value. But we recognize, of course, we have to be careful of the cyclical nature and the threats in the economy and sort of those macro forces not to be, to remain somewhat balanced across the portfolio.
Thank you. Yeah, so it's clear that value is not just one thing, and we do need to look at the different types of value and how they behave in the different regimes and we're allocating. So that's quite an important point for us as allocators. I'm going to move on to Gideon. Just a question on your process. So the GQG Global Equity Feeder Fund, it's basically built around looking for high quality businesses with attractively priced future growth prospects. In a market like this, where do you see quality growth working best, and where does it get tested?
Thank you, Kim. Just to double click on that, quality for us means durable, visible earnings at a reasonable price. It works best for us when markets are focused on fundamentals. So when it provides downside protection, pricing power, earnings resilience. So our global composite historically have captured only 92% of the upside, but one get compensated as investors here when there's a pullback, because historically over the track it only captures 70%, 73% or so of the downside, which is reflective of that dynamics that I've just described. So, but where it gets tested is during late cycles. And I think we see some of that now as it relates to AI. And also we currently, where earnings is not as visible, like in China, we underweight China because that's also in markets like this where that sort of regional exposures can get tested. So
Okay, thank you.
dynamically allocating between some of the sectors in which we have exposure, but also country exposures, because visibility of earnings and the quality of the earnings is not as clear at this point in time in the cycle.
Great, thank you. Yeah, so maybe just a question from my side for us as allocators, and how we navigate the different styles through market cycles. So growth can basically lag due to or have underperformance due to the reliance on high earnings growth and elevated valuations. And at the same time, we can have an issue where value can lag when growth leadership narrows. How should both allocators and advisors think about style exposure across a full market cycle rather than at a single point in time? So how do you blend this basically through a full market cycle and think about the different styles? Maybe let's start with Oliver.
Yeah, I mean, ultimately, I think it comes back to diversification. I would then suggest sort of the next layer is to understand exactly how the managers of those funds are seeking to achieve that factor exposure, and also being aware of any style drift, which has probably been very tempting to do, certainly over the last 10 years or so. And that temptation may well come again in this AI era, certainly from the value side of things. But having a robust process, something that's repeatable and something that you depend on in terms of the style, I think is the key things that you should look out for if you're allocating to different style managers.
Perfect. Gideon, from your side?
Yeah, no, and I think the key is to be flexible in your thinking and be pragmatic. And as you say, as an allocator, one can look for complementary exposures. And I think what we have seen almost for the past decade is that the sort of tendency of buying the dip and yellowing into stocks, the Max 7s and the like. And I think clearly the weather conditions have changed significantly recently. I think we talked about the higher interest rates environments, which are here to stay. So one need to be very selective. And a good way, how I view it is, if there was significant outperformance by a specific strategy, and another strategy or manager have had a long walk in the desert, then it's easier to follow the winning strategies rather than to back the ones that going through a problematic period. But if you understand them, I would really aim to buy low and sell high, as opposed to selling high or buying high and selling low.
Okay, thanks. Yeah, and then that really again just anchors on the importance of diversification, and also making sure that the managers that you're selecting actually blend quite nicely, and they actually stick to their knitting and what's on the tin and not have any style drift. So it's important for us as allocators to be testing that and making sure that the managers are delivering. I see Eugene's popped up. Are we out of time, Eugene?
Pretty much, Kim. Do you have one last key question for the conference?
Let's maybe just have one last question in terms of, and I think Oliver has touched on this in his presentation, but just in terms of maybe Gideon, saying that you were on, if you're looking globally today, where are you finding the most compelling opportunities, either by region or sector, and where are you more cautious or most cautious at this stage?
Yeah, look, it's the opportunity. Gina said, I think the recognition that we're in a new paradigm, as it relates to Oliver said, higher interest rate environments, but also AI and the disruption of AI. It's real. It's impactful. It's going to create a lot of winning industries and accelerated earnings again on companies that implemented it well. And then one need to look at and try to find in your sort of metals and key components in the sort of manufacturing and building out of the AI infrastructure. I think there's still opportunities. I think for South Africa it means actually it could be a meaningful resource cycle. And I think with GKG we try to look at where there's higher quality of earnings given that kind of environment. But it's a bit of a barbell, because on the one hand you've got companies like your Googles and Metas and others that were very capital light and have now become capital intense. We see their spending, but we also know that companies like this exist to perpetuate themselves. So it's exciting times. We need to be very much awake behind the steering wheel.
Okay, thanks. Oliver, anything from your side? You mentioned some regional exposure there in your presentation.
Yeah, two very quick ones, sort of following from the Gideon's theme there. Look, we're in a period where we've seen decades of underinvestment. We're seeing capex trends drive higher, and all of this has been exacerbated by this disruption in the Strait of Hormuz. That plays into the energy thesis that we've got, specifically in oil, as we're seeing productivity start to peak. So things like Total, we've got a lot of enthusiasm there. On the other side, financials. So the end of sort of zero or negative interest rates, that's kind of happened. We're moving into a period where net interest margins have expanded. I spoke about that, but there's still more room to go here. And there's a lot of self-help stories, specifically in Europe, as it relates to financials, which just should see higher return on equities come through on some of the names in a more sustainable manner. So we think they are still being underestimated in terms of their sustainable return on equity.
Great. Thank you both. Yeah, Eugene, I don't know if you want to close out. I just want to leave with the last thought to just again say the key takeaway today has been that style diversification definitely matters, and different styles will work through different parts of the cycle. So it's important for us to understand that and to blend them successfully and carefully for resilient portfolios. Yeah. So thanks, Eugene, and thanks to the panelists. Very interesting conversation.
Thank you, Kim, for that. And to our two gents as well, Oliver and Gideon, thank you for coming through. Oliver from London. Gideon, it's time for breakfast for you, I believe. And good luck with your day with the early start. Right. Right. Makes you think of Varsity Days. We just keep going for a couple of days, doesn't it?
Thank you.
Right. Yeah, and maybe to add to Kim's concluding remarks, and it's exactly that diversification, but more so, I think, is finding the right manager to do all the heavy lifting for you. And hopefully today we gave you great insight to what these managers do. And hopefully you jotted down 2 or 3 names of managers that can really work for you in the long only space, as well as the hedge fund environment. We are concluding with our events for this conference over the past 2 days. I know it's been a ton of information. Hopefully we shared a whole bunch of knowledge with you, but not only knowledge, we also gave you a good jump on your CPD points for the new cycle. And we will circulate those certificates in the next 2 or 3 weeks. Like we normally say, don't mail us every day, but you will definitely get your CPD points, and we will make sure that comes through to you as well. While I'm closing off, Dan is going to share the QR code very quickly, or Avi. Again, for those who didn't get it or weren't able to scan it earlier on for that free gift in the AI Masterclass. As for those of you who haven't scanned it yet, you can do so now. If you haven't attended these sessions before, very valuable, good guidance on what to look for in AI on making your lives a little bit easier as well. From my side to the Fundrock team, thank you so much for setting these sessions up and getting all these good managers together for our audience. And most important, to our audience, thank you so much for your continued support. We are here because of you. Thank you so much to all, to Avi and Dan as well, driving the mechanics at the back. We don't always see you, but thank you so much for running a smooth session. And that brings us to the end of this global conference with Fundrock, and wishing you all a fantastic week further. Thank you so much.